All right. Good morning. Futures are down. We have VIX expiration today. You should expect some pretty wide ranges in the market. So we're at lows right now. Yesterday, we had most of the New York FANGs starting off all green. They went red shortly thereafter. Today, we have many of the FANG stocks are down, looking for a bounce. With resistance today at 6,800, support 6,700. Zero-day straddle is just 44 to 65 basis points. That's pretty light given the swings we've seen lately, even with the markets lower right now. Looking for this bounce. Looking for the bounce after the open. I believe Cayman, you went long futures already in Q. Okay, we've got about 10 minutes to go. PPI year over year 3.4%. PPI 3.4%. Forecast was for 3%. All right. Looking for a bounce. All right, let's get ready for the opening bell. Futures are starting to come off the low. Futures are starting to bounce. All right, we got a VIX expiration. There's a lot of calls out there. I imagine would like to take a profit if they have. All right, everything is starting to bounce now. New York Fangs are bouncing. Okay, we got 4 minutes to go. Three minutes to go. Yeah. I got to get this. Hopefully I won't miss the open. I got to get this though. Hello. It is. Good, thank you. Mhm. All right. Just in time. All right. We got a little bounce there. SPY. Okay. Everything's starting to bounce. Low tick alert minus 800. Okay, looking for a bounce. Futures are off 26, 27 handles. We got a VIX expiration. Look for some pretty decent swings. Microsoft with a bounce. Apple taking off to the upside. Apple. There goes Amazon. Okay, a little bounce there. Shorts covering most likely is all that is for now. Apple's on the move. Apple off the low. Apple. Chevron higher. Chevron. Apple off the low. Amazon turning. Google's catching a bid. Google catching a bid. Off the low, Google. Okay, futures looking for a bounce. Lulu, you can take that one off. It's bouncing. Lulu, big bounce. Take the put credits off. Lulu, nice move on Lulu. Okay, Lulu with a nice bounce coming off the low. Google looks good. Lulu, if you took that iron condor, or not iron condor, if you took the put credits off, you can take those off. Okay, Lulu looks good. What's Intel doing? Intel was off. All right, it's starting to bounce a little bit. Futures begrudgingly moving higher at the moment. The New York Fangs, half of them are up. Nvidia is still lower. Exxon Mobil, Chevron. But the market's settled down. Give it a few minutes. Okay, Lulu selling those put credits yesterday, 145, 140. You could make about 75% profit right now if you sold it for 25 cents. Bought them back, rather. Okay, futures continue to grind higher. Let's take a look at the hedge flows and see what that looks like. Okay, hedge flows turning up. Sharp move to the upside. 0 day. See a lot of support down here at 66.50. Okay, looking good. Hedge flows looking good so far. Okay, futures still going here. Okay, looks good so far. Micron, Bitcoin giving some back today. Lulu, nice rally on Lulu. Polymarket. Okay, futures still rising. All right, looking for more stocks to roll back up. Okay, Google, nice bounce. Amazon looking for a follow through. Tesla turning up. Google. Looking for big swings, so don't be surprised if this rips back in the other direction. Bitcoin looking for a bounce in Bitcoin. Bitcoin looking for a bid. All right, let's take a look at New York Fang. I see Russell talking about NQ. Let's see, New York Fangs. New York Fang agrees with you, Russell. Futures continue to rise. Tesla. Okay, let's see what VIX looks like. VIX. Okay, VIX continues to fade. All right, so with VIX expiration, we had a lot of calls. So whatever is above 20, most likely will be taking profits here. That creates a tailwind for the S&P 500 and the equities in general. All right, let's look at Swarmer. SWMR. SWMR. Okay, what exactly do they do? I know they're a drone, swarmer. Contracts, etc. I saw it went IPO yesterday, but I wasn't really interested. Oh yeah, they can manage swarms of drones up to 100 simultaneously across air, sea, and land. Ooh, that sounds pretty interesting. Maybe we should buy some shares of that. They don't offer options yet. SWMR. No options yet. Okay. It's an IPO. Okay, I got to fill 25 cents on these credits. Lulu.
What are you seeing? Look, I think the last time we spoke was last September, and at that moment we were expecting rate cuts in 2026. Like that has totally changed. Now we might get, we've been talking about rate hike. How has that changed?
It also highlights the other advantage. So in addition to markets being exposed to equity downside, retirees and new retirees have experienced your bond allocation, those values go down when rates go up. Another core protection that annuities provide is guaranteed duration. So you can lock in guaranteed.
Are you seeing customers or clients prepare for a recession? How would a mild recession impact the business annuity? And keep in mind, like, I was not talking about recession at all 3 or 4 months ago. Like, these are the realities of the market.
Yeah, we see the annuity.
Okay, sorry. So IBM yesterday looked really good. IBM. Okay, follow through on IBM. Day 3. Move these stops from under today's low. Or 255, they'd be plus 2 or 3 there. Let's see. The low of the day, 253.
Yeah, so how it's changed is just the variety of products. So originally they were just a simple X% for 5-6 years, and that would be. And now what you see are hybrids between principal protection. You still get equity upside. That skews to the younger audience. There's even another type which provides maybe downside.
Okay, Lulu, if you took the Lulu credit spread for earnings, Lulu's on the move here. Lulu looks great.
Videos, podcasts, they watch me every morning, which I'm very grateful for. But they still trade a lot of tech stocks. What do you tell this generation? They might be watching this and they're like, I'm spending 7 minutes talking about the future of annuities. Like, why should it matter to them what happens in this space? If they are interested, how should they initially dip their toes into the world of annuities?
Yeah, I mean, starting with small, try to buy a small annuity. Don't bet your entire savings on it. Allocate 5 or 10% of your portfolio to an annuity, and you'll see over time the protection it provides. To me, as a younger saver, when I look at younger savers, volatility is a huge risk in terms of your retirement path, and annuities protect that entirely.
What this has been a challenging time in all things private credit. Has that rattled anything?
Okay, Lulu looking pretty good here.
Absolutely not. The annuities still are extremely safe play. What makes them exceptionally strong is you have large carriers like Athene, $35 billion of capital, A+ rated, and that's halted to the upside. And that's what customers are looking for. It's that extra protection.
Go out there and get an annuity, y'all. Mike, always good to see you. I'll talk to you soon. All right, it's the
Netflix bouncing.
Traditionally, big ticket purchases for their homes. But this year, that's been even flying with higher gas prices and a growing sense of economic uncertainty. Europeans want to run, putting real pressure on consumer budgets. So what does that mean for demand in the furniture market? Bill Martin is the CEO of Bob's Furniture, coming out with his first earnings report. Public on the New York Stock Exchange a month ago. Report was solid, but analysts had a lot of questions on the outlook. Let's get to Bill here. Bill, good to see you. Just down to the stock exchange talking about sofas and recliners. You got a lot of interesting.
Okay, futures are kind of just oscillating right here. Hedge flows. It's not a whole lot of resistance overhead. Let's see what comes in. They'll probably sell some premium. Looking for options premium sellers to come in and start selling premium. Probably up there around 6,800. If we can't make it back to 6,750, if we get back close to 6,750, watch for premium sellers up here. Not a bad idea to sell premium. 0 day. Lulu's still going. Lulu's still going. Okay, IBM looks good. IBM. Okay, we need to make it through this pivot at 260, IBM. Well, let's see if we follow through here if we roll back over. Don't forget, this is VIX expiration day. So we could see some pretty decent swings in the market. We already had a bounce off the low. We're still off 21 handles, so we got a ways to go. I'd be thinking about any bounces. If we make it back up to 6,750 or so, consider some put flies, maybe end of March. Once this VIX expiration is passed and OPEX on Friday, there's really not a whole lot of support down below this level here. So be careful. The VIX expiration is mostly due to hedges probably expiring. People that had hedges like us, we had the March 20. Which expires today, the 18th. So, yeah, so we got VIX expiration. We got OPEX on Friday. Polymarket still has the conflict in Iran going on until the end of March. So volatility premium will probably pick up again for hedges.
listen, first off, you're a big player. We have contracts with our ocean freight carriers that are, year long. We have contracts with our delivery partners, so we're relatively protected on that.
Okay, let's see how many stocks are advancing here. Okay, number of stocks advancing are only 192. We're up to 400 and something yesterday. We faded during the day. 43 on the Qs. Watching the New York Fangs pretty closely here. Tesla's still holding a bid. Amazon, no follow through. A little bounce, a little short covering pre-market. Microsoft, Apple.
Well, actually, in recent months, we've seen them move into the better category, which we're very excited about. And we think that's in response to our merchants who last fall really leaned in and went back to Asia and our domestic suppliers to really beef up our better and best categories. So in Q1, we're seeing a step up into the better categories. And what's even more exciting is that a lot of it is consumers in the higher income demos.
Okay, watching hedge flows here. All right, Lulu's still pushing higher. Lulu, Google. All right, Tesla.
Well, as you know, our strategy is not to be a trendsetter, but a trend follower. So we follow trends in the industry. We bring out our version of these items that are already trending in other retailers. But we bring out our version with more features and benefits at a lower price. And the affluent consumers respond. In fact, all of the consumers are responding to it. And it's been a winning strategy for years for us.
Okay, watching Google.
Last year, as tariffs have affected so much of the industry.
Energy Vault Holdings. I'm not sure who mentioned this one. NRGV. That one's up. NRGV.
Maybe I'm going to go for something just a little cheaper on the function.
Yeah, actually, it's the exact opposite. A lot of consumers come in because they're attracted to our price points because a lot of what we advertise are their opening price points. And then they see, that for a little bit more, they get so much more benefit in our better and best price points. So we're seeing a trend where they're stepping up to the better price point in a higher proportion than they even did last year.
This looks like a good tax refund season. Is that a major tailwind?
I think that might have been.
It's certainly a tailwind. We see it every year, and we're seeing it now. It's part of, I think,
Gemini.
Dynamics that are at play, but for sure, we're hearing anecdotally that consumers are coming in with their tax refund and they're buying and finding great values in bonds.
All right, NRGV. This one, I believe Gemini mentioned. This is coming out of a squeeze, turning back up. AXTI. Okay. AXTI. Nice trend. Six months.
sometimes a spark is all that's needed. In nursing, it's compassion in action. Every shift builds strength, empathy, and purpose. You're not just helping others, you're growing yourself. It takes heart. It takes knowledge. It takes grit. With high demand programs, affordable tuition, and a community that's been building futures for 60 years, let's build it together.
Swing, strike, slice, adjust. One more. Good. Now again.
When you change your floors, you change how a home feels. It's confidence, pride, a fresh start. At Go Flooring, we just don't sell floors. We help families fall back in love with their home.
RWG.
Thousands on our warehouse clearance sale. No payments until 2027. Install as
LNKS
soon as
Residence
possible. Go Flooring,
NET
floor and floors. It's how
AXTI.
Look now at goflooring.com. Give us a call at 8776.
NVIG.
Go Floors.
Remember your reason why. Ask your specialist about Resdifra.
RGC. Jackpot wins can happen anywhere. At work, in the coffee shop, on the go, or from the couch. Get in on the action at Double
LNKS
Down
Multi to the
Casino
upside.
and join a community of players winning big from
AOI.
all around the world. Download now and start the fun.
The average
NVIG.
office worker uses 10,000 sheets of paper each year. That's an entire tree. Nearly half of that goes unrecycled, ending up in the trash. By taking your office papers,
NVIL.
you can reduce that waste to zero. Be a
CRWG.
champion for a greener world. Take the first step. It's not
All right, futures, just watching the futures here, turning back up again.
learn more at sign now.
Hedge flows turning back up. Let's see if we lift a little more.
With Moomo, turn data into smart trading decisions. RGC trade stocks, ETFs, options, cryptos, all from one smart platform. Sign up now to unlock exclusive rewards. Moomo, North America's #1 broker for stocks.
Millions of slot players choose to play Slotomania, the #1 free slots game in the world. Download now to receive 1 million coins and a free piggy. Slotomania. What will today spin?
MVST. OSS. AXTI. NVIG. NEBX. NVIO.
30 minutes into a trading day, and as we take a look at the major averages, we are seeing a little bit of
MVST.
weakness, but not a lot of weakness, right? The Dow is down 170 points right now, about 0.4%. The S&P 500 down about 4.
Tesla continues to rise here. Tesla looking pretty good so far. Not chasing anything. Lulu's still going. Lulu's still rising here after earnings.
Because of continuing events in Iran after we had the overnight strike against the natural gas facilities within Iran. Iran is now saying that that means that energy infrastructure of what it considers its adversaries see now
CRWG.
fair game. So it seems to be that's one of the things that is pushing these prices higher, and yet stocks are not seeing that much of an effect here. Take a look under the hood of what's going on with the groups in the S&P 500. Energy stocks are up. That's been consistent pretty much over the length of this conflict.
Yeah, thanks for that heads up on Lulu last night, Scott. Amazon was pretty strong yesterday, Mondo. Okay, it's back down to the morning low. Inside day for now. Okay, future's starting to fade. Future's starting to fade.
LNKS maintaining less than a minute. NVIL.
AIM.
Feels strange that
OSS.
stocks have not come down more, even with oil doing what it's doing.
RKLZ.
And
HIMX.
therein lies also the risk. But in that
AIT
case,
may res in 10
the market
seconds.
is behaving reasonably consistent with
IBM, looking for more follow through on IBM.
geopolitical risk over the last 5 to 10 years. If we just take the example of the Ukraine crisis or the Israel-Hamas crisis a while ago.
Okay, so we're still off 23 handles. Just keeping an eye on futures for now, hedge flows. Watch for a premium to start getting sold here. We'll watch for premium sold. 0 day, non-zero day, there's some there already. Overhead is 90 percentile at 67.70.
Global economic growth, even as they recognize that the U.S. is relatively immune because
CRWG.
the U.S. is the world's it's a net exporter of energy, and we actually produce more oil than it's submitted.
But we have to
OSS.
import the kind of oil. We are a net exporter, but we still import oil, the kind of oil that needs to be refined into products that we use, right? And that, in other words, we're not immune from price.
LNKS.
Absolutely. And we're seeing those price pressures at the gas pump already. And so, but I think the way the market is pricing this risk right now, what you said, is that
LNKS.
Lulu, the top of the NASDAQ 100, Lulu.
Tremendous amount of dispersion, a huge amount of rotation, and the kind of rotation we are changing, the seed is changing. So right now, in the face of this crisis, there's a bid for value, which is what we also like.
LNKS.
At this point, we bid for more harder assets.
NVIL.
Bid obviously for
CRWG.
for materials.
AAOI.
So I think on the
NEVX.
surface, yes, in aggregate, it's contained,
NVIG.
but under the surface, there's a lot of movement.
AIRS.
And it's funny, I was looking back at your last period when you last came in, which was a couple months ago. And at
LNKS
that
halted
point, we were
down.
talking about headline risk and chaos seemingly in markets. And we didn't even know what was coming at that point. It's only gotten more chaotic since then. And I think the thing then was sort of like, you need to look beyond the chaos. Although in this case, I would argue the chaos can spill over if it lasts a while. So at what point do you start to incorporate that more into your model?
Good question. Actually, we are in the process of looking at different scenarios, and what's interesting
CRTL may
is,
resume
and the
in less
base
than a
case,
minute.
I think things look pretty good. Because if you look at the
CRWG.
Okay, just watching prices just hanging out here, watching the hedge flows as well. Let's see what Hero is saying. S&P. Basket of equities. Okay. Let's see what SPY looks like. SPY. Okay, so they're selling puts and buying calls. That's positive gamma. At present. NDX. Okay, they took profits in calls. They're still selling puts down there at the low. NASDAQ, they're still selling puts at the low. The blue line is rising. IWM, kind of flat IWM. Qs, same thing. Puts being sold, calls being bought. Calls are the orange, blue are the puts. Whenever puts are sold, that creates positive gamma, so that line rises. Apple looks okay. Okay, futures starting to bounce. Okay, Lulu's starting to come back down from the highs. Lulu profit taking at highs. Okay, there goes NVIDIA. NVIDIA's popping.
may rise in 10 seconds. AIM may rise in 10 seconds.
And as we know,
181 to 183. NVIDIA looking good. Let's see what it. Okay, calls being bought, puts being sold. NVIDIA calls being bought, puts being sold. Hedge flow still pushing higher, so we could get up here to 67.70.
And that happened at a time when the social earnings were over 30%, but the multiples deviated to about 10%. So you still got double-digit solid earnings growth better than the market.
CISS.
We generally expect that kind of a trend to persist, where you see multiples slowly moderating, slipping down, but earnings growth remaining relatively robust. To the extent that the rate of growth of earnings is meaningfully higher than the rate at which the multiples are contracting, you will have a very good scenario, right? So that's the sort of world we're getting used to. So if you think about where they were trading in the group, they were trading at 31 times forward earnings at the start of last year. At the beginning of this year, they were about 28 times. Right now, they're about 24 times. And NVIDIA is the best example. Partly because they're also competed against the law of large.
Let's see what 0 day looks like. Still no selling in here. 0 day. If we get a move to the upside, if this moves to the upside like this, towards 67.50, watch for 6,800. We might see some premium selling or some 67.70s or something like that. We'll see if they come in and sell a credit spread intraday.
And there is no clear sight to when that starts coming down. We think it should start coming down.
LNKS may rise in 10 seconds.
You will feel incremental pressure in terms of PE multiples the market is going to pay.
Bitcoin backing off. Bitcoin backing off.
Step back and say, have you seen this in the past? We have. About 7 or 8 years ago, we saw free cash flow come down.
Okay, let's look at Amazon. All right, 60-minute time frame, Amazon. 60-minute time frame. We're looking for a bounce here. Buyers stepping up. Yeah, Amazon looking for a bounce. Netflix pulling back. NVIDIA starting to fade. Apple hanging in there. Futures pulling back now. Futures. Hedge flows turning back down.
The biggest shift we have seen in the last 9 months is broader acceptance that this is the transformative technology and that adoption also to that extent, when you
Okay, here's IBM. Here's IBM. Okay, IBM. Nice smooth transitions. Higher lows, higher highs. Looks like institutions. Looks like institutions are buyers down here. Okay, it gets above 260. That should be good.
And multiples are actually come down across the board. S&P overall is trading at 22, 21 times already. Big tech, as I said, is leading.
Futures pulling back.
In an environment in which earnings growth actually improves, as is expected, even more than last year, then we can have decent returns as well. A lot depends on the persistence of this current crisis in terms of the oil
VIX
crisis and its spillover impact, and not just inflation, but more importantly, growth. Right? That is going to be the key issue. If growth takes a hit, and actually your Fed can start cutting, but that's a tougher problem to have. Right? Historically, energy prices does get accompanied by economic growth or recessions. We are in a different environment right now, but it all depends on, is this going to be contained as has historically been, or is this different?
Right. Well, we'll have to check that.
UVXY.
See what's happening at that point. But thank you so much for coming in. It's good to see you. Coming up, we're going to take a look at today's trading tickers. You are watching Market Power.
Okay, futures dropping off. Didn't get a chance yet to sell any or buy any put flies. Remember last week, it said all day yesterday, we bounced on Monday, Tuesday, sellers into strength.
Because IBSD is often a multi-symptom condition and talking about it can help.
MSTZ.
How about now? There's a short-term treatment for lasting relief. Okay, let's talk.
It's called Xifaxan.
Does that mean
Xifaxan with an X. It's a 2-week treatment for adults with IBS-D that provided lasting relief from both abdominal pain and diarrhea and helped relieve bloating and urgency. Think of it like a short-term treatment for lasting relief.
Don't take Xifaxan if you are allergic.
UVIX on the move. Yeah, people are hedging again,
Get help right away if your diarrhea
putting hedges back on.
is a serious or fatal condition. Tell your doctor if you are pregnant or plan to be, have liver disease, or are taking other
Expect
medications. They may increase the amount of Xifaxan in your body. Most common side effects are nausea and increased liver enzymes.
right time to talk to your doctor about Xifaxan? Is right now.
expect big swings. VIX expiration.
MPT halted. AFJKU may resume the rest of the
Putting the hedges back on. Let's see what VIX looks like. VIX. Okay, VIX. All right, VIX had dipped. People were taking profits off. What it was left on the 20s, probably they went out to next month, most likely. VLO continuation, VLO. Valero. Since breaking out, Valero since breaking out over here in January. Since breaking out in January, this one consolidated, had a base on base pattern, another base on base pattern, and now we're starting to accelerate. Valero looking good. Valero. ExxonMobil just off the highs of the day. Inside of yesterday's wick. ExxonMobil. Chevron higher. Okay, that looks good. CoreWeave. CoreWeave 84. So Valero looks good. Lots of volume too on Valero. All right, CoreWeave has been making higher highs and higher lows, similar to some of the other stocks we've been watching, like Amazon. Amazon making higher highs, higher lows. IBM making higher highs, higher lows. IBM off the high of the day right now, but looking for a bounce and a follow through. IBM looks like institutions have been picking up shares over the last 3 weeks.
And you know, when you were talking about consumer staples that have done well, General Mills hasn't been. No. They've been that. I think the stock is down what, like 36% over the past year or something.
And still believe in Mark.
Wi-Fi interactive here, and
It's pretty strong.
there you go. 36%, that is from the upper left to the lower right. So indeed, I like to get a 6-year picture just to see what a stock has done through the global financial, through the pandemic. You can see it had a nice bounce here, kind of started in 2022, which was a fair market. Not surprisingly, it outperformed, but it's been kind of on the down slope ever since.
All right, let's talk about the next one. That is SoFi challenging a short seller report and considering legal actions. And the short seller report is Muddy Waters, which has a pretty, it's a well-known research shop, and it is alleging aggressive financial engineering, mismanaged debt. SoFi is fired back as sort of a point-by-point rebuttal to Muddy Waters. You know, some companies, when they get, you know, attacked by short sellers, they sort of like, they don't deign to reply. But SoFi is taking it seriously and is really digging into some of the conversation.
Let's remember, in 2021, short sellers, a lot of them had to totally back away from their business, so they're a lot more careful now. But more on that in a second. So the core accusation is about accounting and structure, which is talking about Julie. Muddy Waters alleging that SoFi uses loan marks and balance sheet structures to make borrowings look better than what they really are, and that it may have about $312 million of debt not recorded as debt. But SoFi, as you said too, pushed back hard and fast. The company called the report, quote, factually inaccurate and misleading, said it reflects a fundamental lack of understanding of SoFi's financials, and said it's considering legal action. One more thing here.
Bitcoin giving back all of Monday, Tuesday gains back into Sundays now. Bitcoin. All right, so we're looking for the 50-day to turn up, looking for the 21-day to turn up. People chasing into the highs that we saw yesterday. Probably questioning their entries. Just give it a few days. It'll probably be fine. Trying to turn the corner. Lots of volume the last week or so on Bitcoin. S&P looks like we're starting a series of lower highs and lower lows, so be careful here. It is a VIX expiration. Okay, MACD, looking for that to turn up. All right, so got a bearish trend for now. Tesla faking us out. Yep, Tesla. Let's see what Tesla looks like. Tesla. Tesla for the last 3 weeks above the 200-day, just holding here. It's got to get above 400 and then 418, the 50-day. Tesla. Watch S&P for a bounce, S&P. Surprisingly, we don't have anybody selling premium so far.
essentially all of their 24, 25 revenue, the company does not expect new orders from that customer going forward. So it's a show me story. But a lot of let's check out the charts real quick on the Wi-Fi Interactive. You can see it's up another 33% today. Here's the max chart from the $5 IPO. It was up 731%. So
And by the way, that software doesn't make the drones themselves.
exactly,
It
software.
allows the drones to work in this way. Right. It's allowed. So dystopian. All right, let's talk about Lululemon. It is issuing weak guidance for the current quarter and the fiscal year. It's dealing with higher tariffs. It's dealing with declining sales in the Americas. And of course, it's also searching for a new CEO. Calvin McDonald exited in January. It's dealing with its founder, Chip Wilson, looking at the company. Joining me now is Adrian Yee, Barclays Consumer Discretionary Analyst. Adrian, it's always great to see you. I love to talk about Lululemon. And it is so fast. I feel like I've been talking to you long enough about this company that like we talked when Chip Wilson was there at the company before.
Okay, Microsoft making a new low. Microsoft still in that base. Microsoft.
Yeah, I think that this is, the case of companies that get very, very large, they become the number one in the space, and it's not that they become complacent, they become safe, right? Because they're not playing sort of not to lose versus to aggressively win. And I think what he wants them to do is get back into that kind of small kind of fighting mindset where they're basically innovating, they're taking risks, and frankly, they're kind of leading the charge on the athleisure space that they frankly created.
That said, I just to linger on the quarter for a minute, the company's overall net revenue was up 1%. In the Americas, it was down 4%. In China, though, they're still seeing plus 20% revenue gains. What, is it just that they're small?
Okay, what's NIO doing? NIO was active to start the week. NIO looking for higher highs and higher lows on NIO. Okay, get back to 7 maybe.
One of the other issues that has happened with Lulu is that new entrants have come into play in their space, and they're growing the most and the fastest in the U.S. market. So in the China market, competitor, they are the kind of one that is growing there. Lots of white space on the landscape there. And it's a new low brand awareness concept, right, in China that's very, very desirable. It's also priced quite attractively there, very differently than it is here in the U.S. So over in China, they raise their prices relative to the U.S. maybe 15, 20%.
All right, futures dropping off here. Futures dropping. Okay, we're dropping through this.
So the relative atmosphere of China, they are very, very good value, great quality for the value, and it's a little bit different here with the higher.
Okay, most stocks will follow suit. Amazon dropping off.
Remember, we made too much. It was like a tiny portion of their merchandise they were still on sale. Now they have sale. Now they have their Lululemon like new. You can buy certified, pre-owned merchandise, so to speak.
Lulu backing off the highs. Lulu. Oracle just can't get anything going. Oracle.
Is it somebody like On Running's Mark Moore, who leadership is nominated to the board? What do you think?
When you have these types of kind of dislocations, there's a little bit of operational and there's also a bit of the innovation. At the end of the day, what we always say is that product matters, right? So if you did put somebody that was more product oriented, you do want to have that strong foundation of operation to support kind of all the things they're doing. Obviously,
Oracle, no bounce. Just continues to fade.
very public. And so to the extent that she might be the person, she's sort of more operational, but you can fix that, right? You can fix that by having a very strong product, very strong marketing, and tapestry do this, very, very well, very symbiotic relationship. So I think you could
Sit tight until the markets find any kind of footing here.
right? And kind of like leave a good power to the
Swarmer, SWMR. It's pretty wild. Being able to control 100 drones all at one time. Swarmer is still going here. I could see this being a $100 stock. What kind of earnings do they have? Let's see. Swarmer.
You know, Lulu's having some challenges. We're not suggesting they're anywhere close to that kind of outcome. But like, as someone who really is steeped in the space, what to you is the differentiator between, you know, a retailer that ends up making it and thriving, and some of these that have that sort of long, slow decline?
Yeah, I love that existential question, and I have you know, been doing this for decades, as you know, and what I would say.
Sorry about that. I was on a different screen. All right, hedge flows are turning back up. Hedge flows turning back up. Actually, they are moving higher. Hedge flows are higher.
Struggling with GLP-1 side effects? The all-new Weight Watchers GLP-1 Success Program is designed to help you lose more weight and get expert support for side effects. Healthy weight loss, expert support, and lasting results. Get started at weightwatchers.com/GLP-1.
The average office worker uses 10,000 sheets of paper each year. That's an entire tree. Nearly half of it goes unrecycled, ending up in the trash. By taking your office paperless, you can reduce that waste to zero.
ExxonMobil bouncing. The
Take the first step.
markets are bouncing.
Say yes to less. Learn more at signnow.com.
AI startup Aru, founded in 2024 by teenagers, is now worth up to $1 billion. Young Finance's John Smithson spoke to the co-founder and president about how the company is transforming market research.
Maybe then start by just explaining a bit about your company's mission, the kind of problem you're solving for, Ned. In simple terms, I was reading up on it. It sounded like, Ned, okay, you created sort of an AI system here that could replace traditional market research. So,
Okay, looking for a bounce. Hedge flow still rising.
am I thinking about it correctly?
All right, so not the best market to be playing around with right now.
Research use case where you're simulating behavior and asking someone's opinion on an advertisement. Rather than you might have on the other side where someone comes to you with a question about how I mitigate churn of my customers. And that's a lot larger than just traditional market research. It's still something that we solve every day with our systems, which is really cool.
Ned, what's the kind of data you're feeding into this AI model?
Yeah, no, it's fascinating. We are in the valley where we're operating at this time.
All right. We gave back all of Monday and Tuesday's gains, Bitcoin.
Large foundational labs that are spending hundreds of millions of dollars on PRGs, the little math problems, and all these sorts of things. And interestingly enough, we kind of operate at the antithesis of that, right? When you think about modeling behavior and simulating populations,
So a lot of people probably questioning their entries on Bitcoin. Should be fine. Okay, who's got earnings tonight? We'll start looking at a potential trade for tonight. Thursday. See, Oklo had earnings, right? Oklo. Let's see. Oklo had earnings. What did they do? Oklo missed expectations. Earnings growth slowing. Okay, so that didn't do very well. Oklo. Okay, got Micron tomorrow. I don't know the expectations. Expect to move 7.4%. Let's see. Earnings. Micron, RCAT, Red Cat, General Mills. General Mills should be pretty decent. Let's see. Oh man, look at General Mills. Consumer staples. People are not eating as much cereal as they used to, it looks like. Been in a bearish trend. Wow. General Mills, JBL, Jabil, and Macy's. That was today, Macy's today. Macy's. Macy's beat. Turnaround store. Didn't they hire a new CEO not too long ago? Omni-channel retailer. 7.6 billion exceeded guidance. Macy's. All right, let's take a look at Macy's. Macy's big gap up. Okay, so Macy's may be starting a new trend.
Yeah, I gotta ask. I'm reading that you guys, I mean, you're young. I read that you started the company like just a couple years ago. You and the co-founder, you're something like 18, 19, right? Is that, I'm curious, is that ever a challenge? Like, you're talking to some CEO of some big company. Is it ever a challenge for you guys to really take the lead on what could be like a mission critical decision and project?
Look, I think it's a great point, right? I just became legally able to drink a couple of weeks ago, and we've been servicing alcohol businesses for the last year, so I think it's an interesting paradox. But absolutely, right? I think it is for every AI company, not just because we're young. A lot of people are putting out a lot of stuff. A lot of stuff sounds really exciting. So we do at Maru, and the reason we've been able to grow so quickly, right? The business is exactly what you said, just under 2 years old. You're 19 when I started this company. My co-founder is 18. Right? My other co-founder is even younger. I'm 21 now, and how we do this is
All right, we're still watching for a bounce here.
so blatantly obvious in a pilot and in the first interaction with the business that if someone's executive who ends up hearing about that pilot being ran doesn't purchase it, we've literally seen people get fired as a result, right? What we pretty much do at first stages of entering a business is, people have sold predictive technology for a while. We say, let's prove it.
Okay, so Macy's. Who else reported? Let's see. Jabil reported. Let's see what they reported. JBL. Jabil, they beat expectations. 53% earnings growth. Jabil, 53% earnings growth, 23% revenue growth. Electronic manufacturing, services and solutions. Aerospace, automotive, and others. JBL. Let's see, JBL. It's been in an uptrend. All right, it gapped down a little bit. Starting to recover. JBL starting to recover. Some decent earnings. Okay, it's been trending along the 50-day. So if it gets back above the 50-day, that could be a good one. Tesla gave back the morning gains. These stocks did this yesterday too. I was hoping that we would get much higher so we could sell some, or so we could buy some put flies, some cheap put flies for the end of March. $200-day. Okay, this is following the pattern that we saw last week where we bounced Monday and Tuesday, fade Wednesday, Thursday, Friday. All right, they're probably going to go down to the 200-day. That's what it feels like. Feels like they're going to go to the 200-day. Okay, so got a downtrend. VWAP is overhead yet again. We saw VWAP above yesterday. VWAP was overhead most of the day yesterday. We just kept fading. Okay. Nice turnaround on Macy's. Used to shop at the one in Wayne, New Jersey, and in the mall at Willowbrook. So they've turned themselves around. That's good to see. Okay, we're still showing a lot of weakness here in the S&P.
Definitely weighed on the guidance. He said prudent, maybe, maybe not the best word to use, but just sort of a cautious outlook, a very calculated approach, and they hope to, achieve better for what they've done. I mean, what is the effect of those higher gas prices so far? Are they seeing anything? Are they seeing a trade down? Are they seeing, what changed for them? So I asked particularly, I said, is there a direct hit to discretionary spending? He sort of turned it around and said that they're ready for all of, any sort of headwind that might come against the consumer right now. He went on to say that he's had experience of the dot-com bubble burst. He went through the pandemic, through the financial crisis. He said, as long as you have liquidity and a healthy balance sheet, they'll make their way through. But what he did say was that this customer is still choiceful. They're still sort of calculating how exactly this will fit into their wallet share. Maybe if there's higher gas prices, then maybe they won't go on a vacation. Maybe then that's kind of good for Macy's, because then maybe they'll end up spending or splurging on fragrance or buying something else. Maybe that was the big that. I'm not going to take a big expensive trip. Maybe I'll buy myself a vacation in my mind. No, I don't know.
Okay, Oracle starting to bounce. Oracle's having I was going to say a PISS, poor response to earnings. People don't seem to be that
And she said it really is about the emotional connection that a brand can build with its customers over years, right? Not overnight. And so, as we talk about
okay, watching the hedge flows as well, Nick. Watching the hedge flows. Okay. Hedge flows still rising.
In the next 3 years, that's certainly still underway. But what he has done over the past 3 years is imagine stores where they're putting more staff.
Okay, Chevron breaking out more. Chevron. Chevron, what a winner on that one. Valero. Shaking my head on that one. Bitcoin still just grinding lower. S&P starting to see the MACD turn. Watch MACD. Chevron. Valero. These are off on the highs. ExxonMobil. Choppy chop. Tesla went red for the past half an hour or so, 15 minutes. See if we get a bounce. Look, know where RSI is on Tesla. Markets do feel a little heavy. Hedge flows are moving higher, though. Hedge flows moving higher. Apple, Microsoft, Amazon, Netflix, Tesla, all of these lower. All right, so It looked good this morning. A lot of Wednesday chop. VIX expiration. NYMO is at minus 50. It hit minus minus 20 yesterday. Minus 87 coming out of Sunday. Sunday night. NYMO was at minus 87 on Friday. Coming into Monday, we started rising. All right, let's see what breadth looks like. And junk bonds. Let's check out junk bonds. Junk bonds. Let's see what we've got. Junk bonds. All right, that echoes what we're seeing so far. Risk off. With junk bonds lower, Bitcoin not following through. Bit surprising on Bitcoin. It is still turning the corner, but it's got to hold the 21 day. The 21 day needs to cross up through the 50 day. Bitcoin. Okay. The last time we did this, we pushed higher to 74,000, created the pivot, faded for 4 days straight, and then rallied for 2 weeks. 8 days. We pushed lower for 4 days, rally for 8 days. Do we do that again back to the 21 day and then rally again? That's what it feels like it's going to do. So if you're a swing trader, you bought shares, it should be fine. Swarmer is kicking ass. Swarmer is kicking ass. SWMR. I can see that as a $100 stock.
In the heart of the African savannah, a male lion defends his pride. What's this? He's called over a brother to prowl the reels. Together they double their chances of winning and make quite the fearsome opponent. Success. But this is just the beginning. Download Double Down Casino and play for free.
Swarmer looking good. Nice IPO.
Get started with our eco-friendly e-signature. Say yes to less. Learn more at sign-up.
The whole idea is pretty impressive, in my opinion. Swarmer.
The U.S. war with Iran is putting bond market safety and status to the test. BlackRock says this cycle favors a more income-oriented exposure, with ETF investments being a viable strategy in more volatile periods. So let's talk to Steve Lately, BlackRock co-head of bond ETF, who joined me now for this week's ETF report brought to you by PIMCO. It has been interesting to see. Maybe walk me through this week, because we have seen, at least in the Treasury market, the Treasuries are now basically down to unchanged from the year, as we've seen yields go up. However, bond ETFs are just like raking in the flows, right? We keep seeing record numbers. It's the biggest, it's also the biggest area of the ETF market, I believe, in terms of flows recently. So, like, is that a disconnect or what's going on?
It's incredible. So we started seeing this when rates normalized. So you go back to
SWMR may res in 10 seconds.
21, 22, and then it was off to the races. What's interesting, though, this year we are 40% ahead in flows than we were last year, and last year was a record.
So what, and it feels like that's happening across the ETF space, but obviously especially acute in bonds. What is it about this year? what's going on?
There is a
LNKS.
thirst for income that is just unrelenting so far. So there are a couple things going on. If you look under the hood, it's not quite as clean as that. So, for example, the majority of outflows this year have gone into ESCO, which is our 0 to 3 month T-bill fund. So it would be tempting to draw a conclusion from that, like, safe haven. Second biggest flow in treasuries, anyway, is our broad treasury fund. So there's a little bit of safe haven in terms of the front end of the curve that people are also allocating more broadly. You go down the stack, you're going to see allocations then to multi-sector, like the ag, to big of our income fund, and then you get into investment grade out. I would say the common theme though is quality. You have quality trade, quality income trade that is persistent.
Can I also ask, there's also a factor of the absolute
SWMR.
In other words,
ORIS.
the investment advisors, the wealth managers, the wealth channel has grown, and like they need stuff to sell to their clients. I mean, it's a little cynical, but like that also seems to be going.
I think this has happily coincided with just an increase in investor awareness. So if you think that there's an investor base that
All right, 52 now.
in the market, you guys are very familiar with this, the direct investor base. Really has discovered ETFs, and ETFs in particular. So as an example, we're seeing really significant flows into our I bonds suite, our defined maturity suite. Why? Through all this noise, you pointed out the 10-year, right? If you look 2 years ago, the 10-year was at 4.30. You look at last year, it was at 4.15. But in the meantime, you're pushing below 4%. You're pushing towards 5%. What works in that environment? Laterally. Just a lock in yield, right out the storm, and those defined maturity ETFs, the I bonds, are perfect for that. And so investors are as well.
Interesting. Okay, so what do you think?
LNKS.
What do you sort of recommend? There's what's happening, and there's what's happening. There's one and the same. Maybe people are taking recommendations, but especially given that we are in a war, that we're in a volatile time, and that there is that safe haven status usually, but it's not that. Although it's not quite working that way over the past couple of weeks.
Yeah, I mean, there's a lot of noise, right? Yeah. With energy prices, oil, inflation expectations.
This thing is ripping.
I think you have to have a view, right? And so
Swarmer.
And you want to, sort of wait and see. That's going to be ESCO. We've also seen flows into. We have a short-dated inflation product, ICPI. It's a 0 to 1 year inflation product. We've seen flows starting to come into that as well. More than likely because of the concern that inflation. We got some strong PPI numbers this morning. But I think you have these short-dated cash-like instruments which are attractive. And again, if you're like looking to just ride out the storm, laddering is a great strategy with I bonds. Continue to allocate to things like BINC Bank, just for that broad, diversified income theme. So there's no magic formula. I think you have to have a view on this, but there are ways to kind of ride out the storm.
I'm going to put you on the spot for just a second because you mentioned PPI, and it made me remember that portfolio management was the biggest contributor to the increase in the services portion of PPI. I was looking at BLS about that. And I was trying to sort of figure out what's going on there. So as somebody who's in the business, what do you think is going on there?
I don't know. That is interesting. I saw that too. But yeah, no, I don't know. I mean, I think you mentioned earlier just this boom in services advice. And I think investors are getting about portfolios in general, right?
All right, Swarmer has a big backlog.
It's more the sort of orchestra model. How do they all play together? To get a really good result. We're seeing a lot of conversations like that. So people are interested in tickers, but they're also interested in how everything can kind of come together in the right way.
Orchestra approach. I like that. I like that analogy. Thanks so much, Steve. And that's it for Market Catalyst. I'm Julie Hunnan. Thank you for watching. We got more Yahoo Finance coming up.
CRWB.
What you doing? We think it's a drainage issue. No, I know what they're working on. What are you guys doing? Young homeowners turning into their parents. Love a job.
Reinforced concrete.
Here we go. It's an incredible thing.
There's some work getting done at the middle school. Is this related?
inside
Okay.
there.
Progressive can't save you from becoming your parents, but we can save you money when you bundle home and auto with us.
Back, fellas. We won't.
Going against the federal government is going against a very large law that have a great deal of resources. And one thing that I do, and I tell clients, is we are going to outwork these employers. We're ready for any battle.
All right, so this looks pretty good.
Discover the difference of Eastman's exclusive, stronger, more durable materials that cost less than the rest. Over the past 51 years, this family
Option trade sizes exceeding open interest in the defense sector.
all products are proudly made
Big institutions piling into the software first defense name.
quality that lasts. These magnets of illegal immigration have to go. There is no upside to sanctuary cities.
ORIS.
Over 200 states refusing to hand over criminal illegal entry.
I will make it a federal crime for a state or local official to defy federal law on immigration. You can't have 12 liberal states choosing to ignore the law to make crazy people happy. It is time to end the insane policy of sanctuary cities.
Lindsey Graham leading the fight, ending sanctuary city.
Well, word on the street is you beat the big box stores on price.
Yes, sir. We're 100% employee owned and we beat any competitor's price by 10%.
I like it. We'll be needing a kitchen.
BWAB.
Oh, with some soft closing cabinets. Keep things quiet.
Absolutely. Right this way.
A kitchen for everyone at family-friendly prices.
FSLY.
The designs too.
NBIS.
Free of charge and we'll walk you through everything.
VX.
Home outlet, kitchens,
RWB.
baths, floors, and more.
SWMR.
FSLY.
CGTL. SWMR.
NBIS.
Okay, NVIDIA with a nice bounce. Okay, there go the futures. Futures are ripping here. Futures, congrats, Nick.
SWMR.
Big reversal here. Nice pop there for Nick. Got long at the low.
Increase and not do anything about rate conference today, but
LNGS.
meeting, we get a new dot plot, projection, there's some debate about how much credence we should give to that. There's always a debate about how much credence we should give to that. Even more today.
Okay, NVIDIA, nice bounce.
Things are sort of faster, but
WS.
feels like we're not going to see change,
FSLY.
but we're still going to.
Okay, Trace continues to rise. Okay, we haven't had a trend like this. Note.
First, I will save my present on this insistence that this is not an interesting Fed meeting, which is not just your take, but now it's coming from very small desk. But we'll save that. Just before, yeah, okay.
It's not interesting from the perspective of current setting the monetary policy.
We haven't had one like this in ages.
So I think surprisingly we'll set the table for the Fed meeting. And we were literally joking about it 40 minutes ago because the data came out 10 minutes later, which is the producer price index for February. Let's call it the junior inflation report, right? CPI, consumer prices, is where we spend most of our attention. PCE will be on consumer prices for the Federal Reserve. The first PPI this morning coming out, showing that prices rose more than forecast across a range of goods and services. And I believe we have a tweet from Kevin Gordon over at Schwab, who broke down some of the major increases across a variety of
AMTX.
services, which really kind of hammers home the
CGPX.
that I think are going to be challenging for the Fed to deal with, which is why this is both an interesting meeting and probably an interesting Fed in general. I'll pull it up here for my own reference. So in February, year-over-year increases. These are some notable categories, which feed into PCE, so we're likely to see them later, but I think they also speak to some of the pressures in the economy generally.
What's Fly doing? Fly. Fly dropping off today. Okay. VWAP, S&P turning back up.
Outpatient care up 1%, nursing home care up 2.9%, home health hospice care up 2.8%. Theme there, of course, we've talked about it, like the labor market, healthcare is a big source of
VWAP.
the only source really of
Okay, yesterday we had a hard time getting through VWAP as well.
pressure. And I would bracket something
Be nice to put in a higher low. S&P.
in January, talking about inflation, saying that elevated inflation readings largely reflect inflation in the goods sector, by tariffs, tax sentence. In contrast, disinflation appears to be continuing in the services sector. This is not totally contradictory to a disinflation narrative, but I think it challenges perhaps some of the idea that inflation, which we discussed with John Schaefer yesterday, is not like that's not the main thing that is related.
You left out the thing that contributed the most to inflation last month on the wholesale level. Financialization. That is portfolio, right? So it's, I mean, it says in the release, 20% of the February increase in the index for services for intermediate finance, so not the good stuff, the services stuff, was because of brokerage.
Yeah, I'm looking for the same thing, Micron, on Micron there, Frano.
This is something that a lot of economists have been flagging here. But I just thought that that was interesting too, because of this like increasing tilt in our economy towards financialization of everything into, you know, everybody being mortgage up. I guess that area of the market has pricing power.
Yeah, well, and that typically is a pretty mechanical representation of activity. Essentially, like there's inflation within the cost of the services sometimes, but it's usually just like how much more activity was there this February versus previous February. What was the nature of that activity? Obviously, the two of us, if we need to do something in a brokerage account, that costs essentially nothing now. So it's the more bespoke services that we can offer, or that firms are hoping to offer around the edges of that.
Yeah, Micron is gone. Can't find the trend on that one. That's gone. That's too strong. Looking for S&P 500 to get through VWAP. If it gets rejected here, that we could see a repeat of yesterday. If this time of day at 11 o'clock we push through, that would be excellent. An excellent signal. We'd like to see junk bonds also turning back up. Okay, junk bonds are starting to catch a bid. All right, let's see what VIX is doing. VIX, VIX, VIX. All right, VIX is holding at 22, 23. Okay, futures looks like I want to go again. Futures. SWMR halt. SWMR halt again. SWMR. Woo, look at that thing go. 59.
SWMR.
So not only will his comments yet another surprise in the Powell era be notable, but I think where inflation kind of what the send-off is for inflation economy-wide as Powell.
Yeah, I just meant as far as software.
That's the end of the markets receiving and kind of contemplating most closely his view on how he interprets
SWMR.
which has been largely a willingness to look through, and then it became a very quick willingness to not look through inflation. And you know, I think the market
Yeah, software group, I'd like to see that continue. Coming off the low, IGV turning.
whether that's late or not, it was a similar kind of pattern. And as we enter a new era of the Fed, where the inflation problem, as it were, does not appear to be fully solved, I think it's just worth noting, like, one for the road. Hey, here's what the consensus was. If you really care about the Fed, you want to be right, you want to be wrong, you want to be in agreement with, disagreement with the Fed, like, this is the last time, really, that we're going to get that view from Powell. And now we've got to kind of warm up to an entirely different way of communication, entirely different world Kevin Warsh, which will take some time for the markets to kind of get into. I mean, it's been 8 years. It's been a very long time that we've had Powell in that seat dealing with these dynamics, and there's a way that you can anticipate how he's going to approach some of these things that, you know, will take some learning with Warsh. You're not sold.
Not entirely convinced.
Wow. Yeah, that's cool.
It'll be interesting.
Oh, it should be 500. 500 easy.
I don't know. I'm not convinced on it. I mean, you know, and when you say like the market does, I sent a study to some 22B research where they asked.
Okay, short covering. Seeing a lot of New York fangs.
They asked what the market reaction would be to the Fed, and the majority of them, 79%, said the market reaction to today's FOMC will be mixed or negligible. In other words, there won't be much reaction. So that's
So you're kind of adopting my worldview in some ways, which is the only thing that matters is what moves the market. And so if it doesn't move the market, ergo.
It matters because we like to talk about it, but it matters more, yes, if it moves the market.
Sure. All right, couple cleanup items on the Fed before we move on here.
Do it.
Let's bring up Claudia Som's tweet,
Yeah.
her suggestion around how the Fed should or should not view their economic projections, which, to be clear, are expected to come out today. Claudia expects them to come out today, but drawing a parallel to March of 2020, when the Fed suspended
New York fangs, shorts are covering.
right at the height of the pandemic, and looked at the current economic environment and suggested that they consider saying that again. Claudia followed up and said they are definitely going to release these things. But it was a thought experiment around
Okay, IGV turning the corner looks good.
Well, and I mean, you know, there is sort of the knock on the S&P for a while.
Constellation Energy, CEG.
I mean, Jay Powell himself had said, like, don't pay too much attention to this thing, and the market doesn't take it.
Constellation Energy, top of the NASDAQ 100. Let's look at CEG. CEG going. Constellation Energy. Big day, higher low.
Suggestions for Kevin Warsh to what they said was depoliticize the Fed. They said get rid of these press conferences. Let's go back inside.
200-day next. Constellation.
But I do wonder about the actual utility of the S&P at this point. Is it, you know, is there such a thing?
I already sold my Constellation. Okay. A couple of weeks ago. So well. Oh well. That's fine.
Is it useful to us? And I'm not convinced that it is that useful.
SWMR may rise in 10 seconds.
Well, so I don't want to go back to the time when there were only 4 press conferences per year. I've always enjoyed the S&P. I think in theory, not having to show your hand as it were,
SWMR.
would give you
SWMR is killing it. Wow. Shit. SWMR. Woohoo.
to either lean into or steer away from gives the Fed and various Fed officials and market participants, folks like us talking about it, a lot more guidance and a lot more latitude, frankly, I think, to change your mind. Like, I think if you are a Fed official who is not publishing a dot plot 4 times a year, it's just going to be harder, I think, for both yourself and people listening to you to be like, okay, can you benchmark this for me? Where do we start from again?
So you don't like just rely on Fed speak for
Well, yeah,
speeches that they make.
I understand the idea of, you know, when you benchmark yourself to, I mean, people say it's like, okay, don't make a conservative goal because then that's going to be your ceiling. All these kinds of like, I don't know, life advice ways.
Yeah.
You shouldn't give yourself benchmarks, and so that's the idea that I think is appealing to policymakers in some ways. But I think that in practice, it just sort of leaves everyone, including the Fed themselves, those officials themselves and their teams, are just on board and out in space. And
But what's
not
my,
have a
where was
space
my
to-
remember what I think about, that's what it's very probably are. Maybe, I don't know. All right, do you have another item or can we move on?
Well, we have a perfect segue here.
We do.
You do it. You do it.
As we're talking about transparency,
Yes.
we might as well move on to the Securities and Exchange Commission, some stuff that they are doing and that they're reportedly doing. And really on the transparency side, there is the report from the Wall Street Journal that the SEC is considering no longer requiring companies to report 4 times a year quarterly, but they can report 2 times a year. And this is something that President Trump has floated before. This is something that some companies have pushed for. They say those regulations, the cost of reporting every quarter is just so onerous for them to do. In Europe, they only are required to report twice a year, so it would be, because we have been talking so much about wanting to emulate the European regulatory system and economy, why not follow them on this particular item? I think, like, we as journalists, it's obviously helpful to have a company report 4 times a year. I understand the allure, not so much like the regulatory burden of reporting 4 times a year. I get the argument that, this causes companies to not, and the market to not focus as much on the long term, they focus too much on the short term.
Yeah.
I get that argument. I think there's, I mean, I would be sad if companies didn't report
Well,
once a year.
it seems pretty clear that the rules will change, right? I mean, the report is that there's likely to be,
LNKS.
what is the word?
RCAT.
They formally put out the process, call for comments, essentially. Solicitation, I think, it might be the right word. So that's going to happen, and it feels like this is going to be a change that happens. Now, as I thought about this, I sort of don't think every company is going to follow the rules
No, they
right
won't.
away. Like, I think a lot of companies.
Or ever. There will still companies that report.
Yeah, because I think that and look, like, for all the downside, I've heard, I'm sure we've all heard
LNKS.
CFOs talk about this. You report 1 quarter, you basically take a week, you can go to the lake house or whatever. You start reporting the next quarter, like, right away. Like, you all of a sudden move into gathering all the data you need to, et cetera, et cetera, et cetera. You spend 4 weeks pulling a call, prepping your comments, et cetera. Like, it is a huge burden on executive teams. On the other hand, I think that well-run businesses have enjoyed incredible leeway
SWMR.
and seen tremendous returns for their shareholders.
Micron, nice little dip and rip here. Micron at the high of the day.
Being public companies and reporting 4 times.
Moving back up to the high of the day.
Things happening within their business. So companies may choose not to, do 4 times a year. They don't have to, but I sort of suspect that it will not immediately go away. And I kind of think it will end up being an advantage for some companies to continue to come out with.
I think that's right. And this argument that, like, companies don't want to.
Swarmer. We'll keep track of this one.
I think you're right that some companies are going to tell on themselves.
So I knew you were going to say that.
He's gonna love it. Are you kidding? Alex Karp, like these people who. I guess what I'm saying is what I like to think of as the faith-based stock. And that's not to say that these companies. I mean, Alex obviously has shown real actual growth.
Same with Tesla.
But like they don't need.
All right, there it goes again, Swarmer. Oh my gosh, look at this thing.
I guess here's the question. We'll see the role.
SWMR.
Could you do a quarterly report or an interim report that it doesn't have the same full auditing? It's not the same rep, right? Because I think that to use those 2 executives as an example, while they both like to complain and have complained and often, almost every quarter, complain about the ritual, they do like the platform.
They do like the platform. So maybe they'll still have
They
a call.
understand as much as anybody the value of having that communication channel. So I think they'll certainly have.
Well,
SWMR.
one of those guys has a communication channel that he owns and he uses a lot. But yeah, to your point, it's a different kind of tone. It's a different kind of communication with investors. The other thing that the SEC is doing, it's not
SWMR.
Paul Atkins, they issued an interpretation, and this has to do with cryptocurrencies, and basically they now are saying there are 5 different types of crypto tokens. Digital commodities, digital collectibles, digital tools, stable
Wow.
and digital securities. And federal securities law only apply.
New York Fangs are all seeing short covering, looking for a follow through. Futures are seeing a little profit taking at the moment, profit taking on futures. Let's take a look at that. Still nobody selling up here. Nobody's selling up here in the highs, 6,800. I was expecting to see more premium selling. Longer dated stuff, they're actually taking profits in what they had up here at 67.70. But no new. Okay, being a VIX expiration, probably not that big a deal. All right, S&P at VWAP got rejected. Like yesterday, like Monday. Swarmer.
Which is that Disney is the number one company that if you went and asked someone on the street, how's the stock doing, people would get it wrong. Because this is a company that has basically, in the last 10 years, doubled their revenue. They've roughly doubled their profits, roughly, a little bit less than double. And the stock has done nothing. Now, pay a little bit of dividend, and you've got some buybacks. Like, it hasn't been a total zero for long-term shareholders. But it has certainly underperformed the S&P 500 over that time, and the stock has not performed up to the perception and actual results of the company.
Yeah, I'm sorry, I'm distracted because I'm looking on my Wi-Fi interactive to pull up a chart of Disney, which I now have. Can you guys take a look at the interactive? So here's the 10-year chart of Disney and the sideways movement that we've seen. So here's the 20-year, and so this more clearly shows you that it's gone sideways over that. Like, so yeah, it has been a
Okay, futures pulling back in a little bit.
a sort of, little bit of a rally there that it had post-pandemic, but otherwise that's the movement. I mean, I guess like I was thinking about this a little bit because I was thinking about the discussion we had a while ago about retail and how like there are certain companies that you have an emotional connection with. And like Disney is the example of that from a consumer perspective because of that perception that that person on the street has. They take their kids to Disney, they're watching Disney Marvel movies and whatever else, and Moana and all the things. So like there are, there isn't that emotional connection. So I think that's why that people would assume that the company's stock has been doing a lot better than it is.
Yeah.
And yet they would have been wrong.
Yeah, I mean, I think it makes the case for, indexing. Like, it makes the case for indexing, and the reason is not because it's a bad company or it's a bad stock, but that you can actually be right. The business grew, the profits grew, the brand has and there's been some hiccups here and there, but like overall, an impeccable reputation in the market. Everyone loves Disney generally, and yet the stock did not, come to the index that you could have gotten basically free elsewhere. So that's it. That's my little soapbox on Disney.
Well, so then the question is, what are they like? I guess
They're gonna break the company up.
I think it feels like that's what
Feels like that's what's gonna happen.
Yeah.
Fiscal 2015, 52 billion revenue. Fiscal 2025, 95 billion revenue. 94 billion. So
pretty incredible. I mean, so do you want to talk about other CEOs?
yeah, let's do one more CEO.
Okay. Can I pick? Do I get to pick?
Oh, you're gonna pick the CEO. Okay, fine. I know which one, but we can table the other one for tomorrow.
Which one are we tabling?
We'll table 10 for tomorrow.
Okay, let's
do
talk.
Apple tomorrow. Let's do Lulu today.
Let's talk about where there's not a CEO.
Okay.
And that is indeed Lululemon. So Lululemon just put Chip Bergh on there, or they're nominating Chip Bergh.
Another chip. I was like, how many chips are going to be associated with Lululemon?
We got Chip Wilson, who was the early Chip, who then exited the company, and now we have Chip Bergh, who was former CEO of Levi's, who's being added to the board. He's not the Chip Wilson pick, by the way. He's different.
In conflict with Chip.
That's right. Chip v. Chip is what we seem to be having at
NVIDIA trade.
China's apparently doing great, but North America continues to kind of just stumble along, I guess, here. And the people who Chip Wilson wants on the board include people like Mark Maurer, who's the former CEO of On. Who knows if he's pushing for him to
SWMR.
the new CEO. But like the
KOTK.
bottom line is that Lululemon has lost its mojo. Is Chip Wilson the guy to bring it back? The original, the pants are not made for everyone guy? I don't think so. I mean, I think he's got an awful lot of baggage. And so the fact that he's the one who is now pushing for some of these changes at Lulu, I don't know what those changes would look like. But he's saying that the company there's a disconnect between the company's creative engine and the board's understanding for how brand power and product excellence fuel cultural strength. I don't know what any of that means.
Well, Chip Wilson's founder.
SWMR.
I think that brings back into play a different story for Lulu, both operationally and I think for investors. We have the founder back in the fold. If he were to momentarily come
Yeah,
back.
right. Because for now he's just like
With Swarmer, if you're up 100%, when you get up 100%, maybe you start to scale out a little bit at a time. That way, any halts down don't catch you off guard.
Oh, sorry. I'm just trying to figure out the right caption to post about this.
Maybe something like, I have protection, just need a life cover.
What about that emoji with the shock face? Or maybe flooded with emotion.
That's too much. Try it out. Great.
You know, technically, you don't post everything that happens online.
Life is meaningless without affirmation, am I right?
That's rough. But hey, with Safe Flight, you can get that fixed any way you want.
Hi, is now a good time to talk about your IBSD? No, maybe later? It's now a good time. Hey, because IBSD is often a multi-symptom condition and...
Okay, Bitcoin, still looking for that turn in Bitcoin that hasn't materialized yet. Netflix, nice turn off the low. Let's take a look at Netflix. Netflix going green.
And help relieve bloating and urgency. Think of it like a short-term treatment for lasting relief.
Don't take Xifaxan if you are allergic to its components, rifaximin or rifamycin antibiotic agents. Get help right away if your diarrhea worsens, as this may be a sign of a serious or fatal condition. Tell your doctor if you are pregnant or plan to be, have liver disease, or are taking other medications, as they may increase the amount of Xifaxan in your body. Most common side effects are nausea and increased liver enzymes.
The right time to talk to your doctor about Xifaxan is right now.
Swing. Strike. Slice. Adjust. One more. Good. Now again.
These magnets of illegal immigration have to go. There is no upside to sanctuary city.
12 states. Over 200.
Okay, Netflix looks good. Swarmer, a little bit of consolidation at the highs now at 61 and change.
You can't have 12 liberal states choosing to ignore the law to make crazy people happy. It is time to end the insane policy of sanctuary city.
Lindsey Graham, leading the fight.
S&P looking for a follow through. Needs to get above VWAP. Until we start trending in the other direction, I don't really see a need to get too aggressive on the long side, because we can see and we've experienced selling into strength. Okay, there are obviously stocks that are not heeding the trend, like Micron and some of the energy stocks, but generally as a whole, they've been selling into strength. So we need to see that reversal. A higher low would be a starter. If we could get a higher low here, if we got a higher low, something like that, that would be great. 200 days down there, 21 days overhead. So is a 50-day. So we're still in a bearish trend. Okay, USAR dropping off here. Meta turning back up. Meta turning.
These are not all the possible side effects. Tagrisso can harm your unborn baby. Ask your doctor about pregnancy, breastfeeding, and birth control. Tagrisso, I can live longer. Tagrisso, I can ask for the #1 prescribed medicine for EGFR positive metastatic NSCLC. Ask your doctor if Tagrisso is right for you.
I'm Mark Lynch, and I've built my debt-free business for 40 years here in South Carolina. Lindsey Graham's been in D.C. 30 years, confirming Obama's judges, pushing the amnesty for illegal aliens. I'm Mark Lynch, a true America First conservative who will fight for you. With your help this year, we dump Lindsey Graham. Click this ad or scan the QR code to donate now. D.C. needs businessmen, not career politicians. Donate.
Yeah, no kidding.
I'm Mark Lynch, and I approve this message.
We are moving in great stride this March at Seaside Furniture Gallery and Accents with great savings of 15 to 25% off our everyday low price on in-store furniture only. Mattresses and
S&P kind of stalling here, no follow through. Hedge flows are starting to back off. All right, so the buy program basically has slowed for now.
roundtable of guests, a few things I want to get off my chest right now. One, if I look a little tired, it's because I spent 50 minutes last night here doing circles to Jeremy Lair at the New York Economic Club. That was really fun. I'll have a story hitting the Alphine's homepage shortly on what Jeremy told me about his surging stock price, but I will say this bluntly.
Okay, so we're starting to see some profit taking up here. Expect some volatility and swarmer. People are getting excited, chasing it. Exxon Mobil fading off the high. Exxon.
I like seeing that the market is starting to slowly decouple from oil prices. What I don't like, City out this morning, not ruling out $200 a barrel oil price. This call out getting a lot of attention on my X account right now. I'm just reporting the news. I didn't write this research report. That's their call. Here on my opening roundtable, Victoria Fernandez, Crossmark Global Investments Chief Market Strategist, alongside Alpine's reporter Sheriff Sean Berger and Jake Collins. Jake, I want to come to you here. You're new to the opening bid roundtable. This city note that I got this morning, they didn't say, hey, look, we expect $200 a barrel oil prices, but they weren't exactly saying oil prices going back to $70.
Yeah, Brian. I mean, you can just look at the action today. Brent futures already up 7% since midnight, trade at 108. US WTI futures up 5%, trade above 97. Several different headlines moving this market. It's attacks on the gas fields in Iran by Israel. Iran has now published a list.
Still only about 150 stocks advancing on the S&P, 34 on the Qs.
Essentially, this conflict is not slowing down, and all the analysts I talk to say that we could see higher oil prices than we are right now. One thing I want to call out, if you look at the physical market, remember Brent, WTI, these are futures. You look at the physical market, barrels in Dubai, barrels in Oman are trading around $160 a barrel. That's a $50 premium over the Brent futures market, and the analysts I talk to say that could be a sign that the futures prices we're seeing and talking about could be far, far lagging what's going on in the physical market and could need to come up significantly to get there. Jen, good luck to
All right, Netflix is trying to follow through too. Netflix, people watching Netflix off the low. Netflix is going more. Okay, still building a base. Okay, Netflix is going here. Okay, looking good, Netflix.
And for that, I will also be looking to Chair Powell during the press conference to see whether they are looking through this oil spike or and how long oil prices will need to remain at elevated levels before they see that prices would need to take action accordingly. That said, he talked about the policy statement. We learned in the minutes from the January policy meeting that there were several officials who were already looking at making changes to the policy statement to make their language two-sided. That is to say that if inflation were to remain above the Fed's 2% target longer, then perhaps they should be factoring in the notion of a rate hike. I would imagine that's coming up in discussion again in the policy meeting today. The question is whether that ends up in the policy statement today.
Victor, let me get over to you here. It was amazing. Coming into this year, we were looking for
Okay, Netflix looking pretty good here, Netflix. IBM still a doji. Amazon at the low. Looking for Google to follow through. Meta's starting to look a little better. Meta. I want to see institutions push this back above the 50-day. If it does get back above the 50-day, then, you know, maybe we got a chance for a move back up to 743. Right now, Meta, I'm not doing much with Meta. Netflix, looking for this to get back above the 20 EMA and start to trend. Okay, starting to trend a bit. Let me just do this. Let me close this. Okay, so what I'm looking for Netflix to do is get this 20 EMA to turn back up like that and price to get above it and start to trend. All right, we're starting to see RSI turning back up as well. MACD looking for that to turn up as a function of price. And we just need more volume. Okay, that's the earnings pop. So we're looking for Netflix to continue. No hurry, no hurry. Still opportunities to probably get better prices. For now, it's moving off the low pretty quickly. Netflix, people starting to notice. Apple is lower. Microsoft is bouncing, a little short covering on Microsoft. Apple and Amazon are down, along with Tesla. No follow through in those.
could happen, but it's not really going to. This gives you another data point now. There's more people out here that are saying, wait a minute, this could be more reality than fiction. And I do think it's concerning when you look at college graduate unemployment rate and how high that's going. There's a deep concern there as to what that means across the board for our economy, because it filters through to everything, not just consumption, but household building, building families, what that means in terms of spending across the board. There's a lot of follow through to this. And so I think it is quite concerning and something that we should be looking at when it comes to growth expectations and what that means in terms of earnings expectations. Brian, we've still got 14%, 16% earnings growth expectations for this year and next year. I think that's going to have to start coming down based on some of these reports.
Yeah, I think those estimates are absolutely useless, but we'll take that offline. Victoria, Jennifer, and Jake, thank you so much. Appreciate it. All right, as we wait for today's Fed decision, poly market odds of no rate cuts this year are rising currently at 24%. For more poly market odds, you can scan the QR code on your screen to go to the Dow Funds Prediction Markets Hub, powered by Polymarket. Coming up, it's a big morning for Power Player Chats on opening mid. I have live next one of the giants in the retirement industry and a newly minted IPO company that's aiming to sell you a new sofa this tax refund season. I'll be right back.
Okay, fixing that burst pipe should be all set. Good thing you're protected 24/7 with your home and auto bundle from Progressive.
Oh, sorry. I'm just trying to figure out the right caption to post it.
All right, Netflix, just watching it closely. All right, starting to stall right here, just above green on the day. Swarmer is squeezing. Swarmer. Swarmer is squeezing. Let's see, do I have a Bollinger Bands here? We'll add B bands. Bollinger Bands. Okay, so you can see it's squeezing. Okay, Swarmer turning back up. The dips are likely people taking profits.
Not too much. Great question, Seema. Obviously, in the very large, most sophisticated shops in the world, some of which are right up here in the Wall Street area, they sometimes choose to build their own technology. But increasingly, most large organizations, I think, are going to be focused on how do they leverage this technology to build their business value to their customers, not the security that protects that. And so I think we see most of those customers tipping toward the vendor community. And frankly, we think SailPoint's very well positioned to help them address that issue. And simply the simple analogy sometimes helps, right? People are driving their cars very fast now, we think, to go fast and adopt AI. And there may be a few crashes where people go, I need good brakes, right? And so we're in some sense the brakes that say you can move quickly to adopt this technology. And if something goes awry, you can use our technology to manage it, stop it, protect your organization and its data. So we feel really good about where we're set up for that.
Mark, when you're trying to close, say, new business, I wonder, is the pushback, if there is pushback, about doubts that security is a priority? Is it about price?
All right, futures coming back in a little bit. Futures, hedge flows kind of topping out right now. Hedge flows are topping out.
I don't know how big and how fast it's going to get. And I want to be careful, honestly, as I contract, right? We all get questions about how fast this adoption is going to go. I think we're all somewhat stunned, honestly. I've been in the industry for 40 years. This is kind of unlike anything we've ever seen, right? Like the rate of adoption and change here is pretty amazing. So when you think about enterprise customers that contract not just sometimes for 1 year, but 3 years with vendors like ours, they're saying, I think I know where I'm starting kind of barely. I don't know how to predict too well where I'm going. We've set up some pricing models. We call it flex pricing model to address that concern. But it's less about competition lack of confidence in our company and its ability to deliver, or even the lack of needs that Steve mentioned. It's really how do we set up what the customer thinks
Amazon still making new lows. Yeah.
contractual financial model that makes them comfortable moving forward. And we seem to be kind of breaking that log down here at the beginning of the year.
Amazon.
What's happening with the war? Iran targeting critical digital infrastructure. I spoke to Palantir CEO Alex Karp last week, how he kind of made the suggestion that this is going to become a bigger risk. I'm just thinking through how that actually works. A state sponsor getting access to credentials that gives them access to these data centers. What kind of security are they breaking through?
It's a great question, and one of the things we say today, Seema, is that the old model of criminals or bad actors breaking in is someone shifting to them trying to log in, right? They're still going to try to penetrate a firewall, for instance, but they're also trying to get credentials in some method, and then, quote, log in, looking like a valid identity or valid user. And I think in the world of agents, that even gets more difficult to detect and protect against. So what we feel is, yeah, this increased threat landscape, whether from nation states or just criminals all over the landscape, is where our type of customers are worried. We want to set them up to have confidence they can detect and then, we call it respond and remediate when there's an identity concern. And it's well documented now. Most of the breaches are coming through an identity vector. Most breaches are by a compromised identity. So customers are very attuned to the need to protect all these identities.
Wow, incredible just to learn about how that actually works. Mark, thank you for taking the time. Became CEO of SailPay.
Thank you very much.
When we come back this morning, another top executive leaving Apple, adding to some concerns about a talent exodus. We'll talk about the impact on the company's hardware roadmap in a moment with the Dow down 400.
Okay, S&P is just chopping around here. Okay, hedge flows have topped out for now. So they shut off the flow. The flow being when dealer hedge flow line is rising, the dealer is buying a basket of goods, stocks, buying a basket of stocks. You can see that here. Those tapered off. Okay, so this S&P equities, this is a basket of stocks. I'm not sure the exact makeup, but we need to see the orange and the blue line turn back up. Right now, it's just kind of flattening out, a slight move lower, which is telling some profit taking. All right. Maybe this tells you what's in here. The basket of stocks, maybe it's in here. SNDK, Microsoft. I would think this would probably change, much like the S&P, like the Dow Jones. Whatever makes up this basket of stocks that they're using for reference. Okay, NVIDIA, Micron, Broadcom, Adobe. Or maybe it just references stocks that are most active. I don't know. I don't know what the basket is comprised of. Okay. So we want to see these lines move higher. Netflix is trying to push up. Netflix hedge flows. You can see that they took profits and puts, the blue line dropping. Orange calls are being bought. Netflix down below. All right, 3,500 of the 99 strike being sold for January. 3,500. $4 million. That's interesting. Let's see what trades are most unusual. Don't want to do that. I want this reports. Most unusual trades as of yesterday's close. Most unusual trades. Okay, so there's not a whole lot of them this time. BitDeer, we got buy to open, BitDeer, the 20 call. Affirm, 1,000 of those. BitDeer, buy to open, 10,000 of the April. Okay, let's see what happens there. BitDeer. BITX, we've got, what do we have here? Buy, sell to close. All right, somebody took some profits off at the close yesterday. BTDR, BitDeer.
Welcome back. Apple's head of home hardware, the latest high-profile executive to leave the company for a rival. Mark Mackenzie Sagalos has more on the growing concerns about a talent exodus in today's Tech Check. Hey, Mackenzie.
Hey, Carl. So Brian Lynch had been leading hardware for Apple's smart home display.
Netflix still hanging in there.
Times because the Siri redesign still isn't ready. Now, before that, he ran engineering for Apple.
Swarmer hanging out at $60 for now. Swarmer.
So this is deep institutional knowledge tied to two high-profile efforts that never shipped. Now walking out the door to Aura, the smart ring company that competes pretty directly in health wearables and has been systematically picking off Apple's talent. The chief medical officer, a key designer, now it's top home hardware executive. It's also the latest in a run of high-level departures. Over the past several months, Apple's lost AI chief John Giandrea, a key design executive, Alan Dye, its top lawyer, and in December, nearly lost its chip chief before a retention deal reportedly kept him in place. And this all comes as Apple turns 50 on April 1st.
Okay, S&P is still chopping around here.
And billions of dollars on a car that never shipped. Launched a Vision Pro that's largely struggled to find a market and is now reportedly betting big on a new generation of AI hardware that mirrors the family of devices that Johnny Ive, who was integral to the DNA of Apple's success, is now working on over at OpenAI. And perhaps the biggest overhang here is the fact that Apple still has
6430 is where that trough is in the S&P model. 6475, I believe, is the put spread that JP Morgan has. They offset it with selling a call overhead that creates a collar. They sell calls overhead to buy a put spread below. 6475, I believe, is that number. Neither here nor there right now. 6700. Okay, this March expiration is pretty large, as you can see. March 20th expiration is pretty large compared to what has been to this point further out in April and May. Pretty big expiration. $6,700. Definitely want to stay above 6,700. We need to get back above 6,700. Looks like a lot of calls selling overhead for premium. Okay, there's not a whole lot below in terms of support. You see this over here. This is at JP Morgan. No, is that not it? 6,000. I don't know what that is. 6,000? 6,000, yeah. 6,700. Netflix still rising. Swarmer hanging out near the highs of the day, just off the highs of the day. Swarmer. Netflix is fine. All right, stocks are just kind of taking a breather right now. All right, stocks taking a breather at the moment. Bitcoin could be turning here. Bitcoin, watch Bitcoin. Bitcoin might catch a bid soon. Bitcoin. All right, Netflix seems to be working the best at the moment. Go figure. Still basing. I forget who upgraded it. Was it Morgan Stanley? Netflix. Okay, futures are just sitting here. 60-minute is on a sell signal. So is a 5:15:30. Okay, here's Netflix. JP Morgan's got a 120 target. Citi's got a 115 target. Bernstein 115. Evercore, Argus, CFR 115. So it's like 115 is the average. 36 out of 44 major analysts maintain a bullish, strong buy rating.
Oh, I'm sure that's an aspiration of the next Federal Reserve chair to be, that basically the dots make the Federal Reserve more confrontational to the political class. It's one thing to say, oh, you're not going to act, the world is so uncertain, you're delaying, but it's another
Netflix still going.
to release a forecast to say, at best, another quarter point this year, take that. And I think that's the challenge. It may help inform market participants, may or may not, but it is also more challenging in the political sphere. What did you make of the PPI print today and how it's going to map?
All right, Bitcoin's coming off. Okay, it's trying to come off the low. Bitcoin. Watch Bitcoin.
3-month annualized well into the fours. I take it exactly like your lead. It was hot. There were two real messages. One is the sustained increase in the PPI was importantly service inflation is running hot still again. And that's the inertial part of inflation. That's what's holding up the whole price complex. Second is trade margins went up. That probably suggests that tariffs had been absorbed last year.
All right, Netflix is still pushing a bit. Netflix.
Businesses are clawing some of that back, i.e., consumers will be paying a little bit more of the tariff burden.
Yeah, and not to mention more at the gas pump, Vincent, as we try to understand how this specific oil price shock will affect.
Okay, Swarmer looks like Bollinger Bands are saying consolidation. Yeah, it makes a lot of sense up here.
Yes and no. The no part is oil prices are very salient. We pay it at the pump. We see it all the time. Probably overrepresented in survey measures of inflation expectation. It's just hard to get past the headline. So oil prices still matter, and it's not really a function that we're now a net exporter of energy. But that the yes part is about being a net exporter. We produce more than we consume in the U.S. now, and that means that when oil prices go up, we're no longer transferring income to abroad like we used to. We're keeping it at home. However,
Netflix, looking for it to move back up into the range.
oil prices go up, it benefits the producers, but everybody pays. And so it's that broad tax that's a drain on aggregate demand.
As how much is what's happening? What the Fed does next? Do you think?
The Fed moves slowly, and so I think it'll mean there's a sentence inserted in this afternoon statement that says uncertainty has increased. Boy, has it ever. It gives them more reason to wait. They're still trying to figure out
insurance easing of late last year has mattered. We're waiting to still see tariff effects. Now they have to wait to see what energy prices do and how much of that passes through. So it really slows up the Fed. But we're in a transition anyway. The Fed wasn't going to act until the next shares on board.
Meantime, Vincent, we did get that rate hike out of Australia. I think traders are pricing in 2 hikes from the ECB. But stateside, there's a V&A note today that says the labor market is nowhere where it was in the last energy scare in 22, that inflation's not going to seep into wages, and that the market's maybe pricing the Fed too hawkish.
I think the markets are pricing the Fed too hawkish. I think it reminds me a lot of 1990, first Iraq War with the first President Bush. Oil prices went up, completely doubled. People worried about inflation. They expected the Fed to follow through. But in the end, it was a demand problem. I think that what we're seeing around the world is a growing tension. Because while we're a net exporter of energy, a lot of our important trading partners are large net importers. So they're taking an immediate price hit. They have to worry about that transfer of their income to the Middle East. So you're going to see more opening up among central bank rates. And the last point to make is, where was the Fed? The Fed was inclined to easing for the last year and a half. And so you have to dislodge that inclination before you get them to go to the other direction. I don't think you do.
Yeah, we've been watching the CME Fed Watch Tracker. It has a little column there for hikes, which is a little bit of a new wrinkle. We'll keep our eye on this afternoon. As you mentioned, that spread between WTI and Brent, now the widest since 2019. Vincent, thank you, as always. Good to see you. Vincent Reinhardt.
Safe here. Thank you.
So we'll work our way through the Fed, and then after the bell, it's Micron.
Micron's a big one. Memory shortage doesn't seem to be letting up. That stock has done incredibly well, Carl, now up 62% this year. Pretty commendable if you take a look at how it's performed in comparison to the NASDAQ, which is down 3.7. 148% year-over-year growth in sales growth. That is what Wall Street is.
All right, Netflix set the high of the day. Expect to see ABCD patterns. Okay, we're looking for A pivot. Looking for that A pivot. Oh, Mike Santoli's on. Good.
Welcome all. Let's get a quick check on the markets. The S&P 500 down just over 0.5%. We've been hovering around these levels for a little while coming into today. S&P was up a little more than 1% for the week, kind of low volume drift higher over Monday and Tuesday. You see there WTI crude does have a bid. It's up about $2, above $98 a barrel. Had been over 99 a little bit earlier. It took some of the pressure off the equity indexes.
All right, we're still on sell signals, 5, 15, 30, 60.
Obviously, it's not going to be a complete dislocation from one to the other. But where do you think we sit? I mean, there's a lot of hope that the stage is set for some kind of a rebound rally in stocks this week.
And for sure, today is a step back in that regard. It continues to be a very frustrating environment. It's interesting because you mentioned yesterday a lot of people wanting the flush. I had a couple of conversations yesterday with a few hedge fund managers who all said the same thing. Like, let's just get this over with.
Right.
Let's do a V-shaped bottom, and let's recover.
Like April.
This is far more punitive because what we're really doing right now is we all anticipated this elevated volatility environment coming into 26. And I think we also anticipated a much
Futures pushing a little bit lower at the moment.
When you're in it, I said this to you before, when you're in the midst of it, it feels far more punitive. You're losing trends. You're really losing trends everywhere.
Yeah, there's no trends. Hardly any trends anyway. There are some stocks like Micron that have been trending. Okay, Oracle, Lulu. Lulu's at the highs. Lulu's been in a downtrend. Looking for it to reverse the downtrend. What's Walmart doing? Let's look at Walmart. Walmart. Okay, at the 50-day Walmart. Basically, we've got this support level right along here that Walmart's right above right now. Descending triangle. RSI down. MACD down. Stochastics down. Okay, for now, Walmart is not giving you much. Dollar Tree was up on earnings. Dollar Tree. They took profits in Dollar Tree. TJ Maxx holding on. Ross Stores trending. Okay, Netflix looks like it wants to go some more. Netflix still pushing.
While we have been range bound really since October between 6,600, which we bounced very nicely off the 200-day to that 6,900. I mean, investors are really getting a dose this year because the headlines. I mean, you walked through quite a few of them, but the headlines continue to really be scaring investors. I do think that the market.
Yeah, I like when the markets are scary because you know that what follows scary is complacency that could last, for weeks and months. We're looking for the March bounce. We haven't seen it yet.
I do think that right now we still have, we're obviously going to go into this quiet period for earnings. Earnings continue to be strong. And so I do think we have these, real headlines. Obviously, Iran is more than a headline that need to just work themselves out. And so I think we're going to continue to be in a trading range until we get a clearing event, really from Iran, which we just can't. I don't think you can just you can game theory, but you just can't. No one can know actually when that's going to end because Trump might want it to end, but the Iranians once again. I still think this is existential for the mullahs, so I think this is a very complicated situation for investors to sit through.
Sure, yeah. I mean, and I think that really anybody honest has to acknowledge nobody kind of knows anything, and the market's sort of trading accordingly to some degree.
Yep.
Although we are, Jim, still in the initial 4-week window, if we remember, that was kind of laid out there at the beginning of the attacks. So who knows if we're overdue for resolution or we're just impatient. The variation within the market, of course, remains pretty significant. The median S&P stock this month is down more than 5%, where you have the S&P down a lot less. It's also down something like 16% from its high. So are you finding things within the market that feel as if they're getting compelling, Jim?
The short answer to your question, Mike, is yes, definitely. The problem with the answer is I can't give you the short answer because if you're going to buy here, you have to understand.
We're still looking for this March bounce. Okay, the markets tend to bounce during this time of year. Obviously, we have additional catalysts with the Iran conflict and oil prices, but we are looking for a bounce.
Clearing event the way Brink puts it, but I don't think we will. I think we'll get a slow fizzle into some sort of normality where you start to see a slow pickup in tanker traffic through the Straits of Hormuz. I don't think there's going to be a signing of the Treaty of Versailles, so to speak. And in that context, one has to be aware that buying today may feel lousy tomorrow, but a year from now, or maybe not even a year from now, maybe 3 months from now, 6 months from now, it's going to be looked back on much the same way we looked back on Liberation Day. Not the same event, but, if you looked 3 months back on that opportunity, it was definitely a buying opportunity.
Yeah, I mean, who knows? In retrospect, maybe good. We're not going to get a Treaty of Versailles. It didn't really play out the way we hoped after that.
Yeah, SFM is trending there, Tony.
Yeah, John Maynard Keynes has something to say about that. Let's bring in CNBC senior economics reporter Steve Leishman knows all about that. Ahead of the Fed, Steve, and of course the Fed is looking at a lot of the same issues and influences that we're trying to hash out and perhaps doesn't have a clear answer of how it might proceed.
Yeah, I'm not sure there's any more insight than anybody around that table there.
maybe even less. I think there's three forms of communication that happen today. There's the statement, there's the forecast, and there is the press conference. And I think the surge in the price of oil will have an effect on all three. It's likely that you're going to get some commentary in the statement about geopolitical uncertainty, as well as some change in the forecast. And what we're looking for here, Mike, is the extent to which the dots signal one or possibly no cuts in 2026. You can see what's happened to the probabilities.
Lulu's still going here. Lulu.
Hotter than expected wholesale price report, in addition to oil ticking up closer to the 99 level than it was this morning, around $94. And Mike, I like your framing of this 4-week window, which we talked yesterday to John Kilduff, and he talked about this idea that if this strait is not open by April 1, there's another level or another leg up that's going to happen to oil prices that will be much more meaningful than it's been so far.
Hey, Steve, it's Joe. Good to see you. So the market has been troubled so far in 2026 by much more than obviously the challenges related to the Mideast conflict. And one of those trouble spots has been software and private credit. Any chance I get some comfort in this press conference where the chairman can convey to us that he is at least communicating with Wall Street lenders and they are on top of gaining an understanding of what the real valuation of these private loans actually might be to the software industry?
I was with you all the way to the end. I don't think the Fed goes quite that far. Joe, I think you have to appreciate that the interests of the Fed and the interests of investors are somewhat different here. The Fed wants to know if what's happening in private credit, and especially with software, is something that's going to infect the money center banks for which they're in charge, and create systemic risk that will.
Okay, Netflix is watching here closely.
Reaction, either in the markets or in policy. And I think what they generally have said about this is investors in private credit are free to lose as much money as they possibly want or make as much money as they possibly want. What they're not going to be free to do is to create some sort of big reaction in the banking system. And what I think he'll say, what he has said before, is that they're looking at this from the connections to the banking system. But I don't think you're going to get any sense about what the valuations are, whether or not the marks are right, which is the big question for investors.
All right, so I'll correct my statement there, and 100% I agree with how you eloquently explained that, but at least can we get a degree of comfort that the communication channels are open and they understand right now that there are questions surrounding a lot of these Wall Street lenders and maybe a degree of clarity is needed?
I think that's something that is definitely something that the Fed chair has said and will say again, that it's something they're looking at, it's on their radar screen. I think there was a lesson they learned from SVB, which is don't let those sort of things go unnoticed and take them very seriously when they happen. And I think also, Joe, coming from the great financial crisis, it's something that they're very aware of, this idea that there can be things that look like they're remote from the banking system, but end up being connected in ways they haven't figured out before. I think one of the questions you have is, well, what are the letters of credit of some of these private credit vehicles to the banks? And if they hit a liquidity crunch, can they draw on those lines of credit? And does that all of a sudden create this kind of danger inside the banking system from private credit?
Yeah. One of many topics we're going to have to cycle through in that press conference. Steve, you'll be there. You got to get going. I appreciate it this morning. Jim, everybody can kind of seize on their favorite example from history of how monetary policy interacts with a high oil price or some kind of an energy shock and the inflationary threat. So the 70s, everyone knows, didn't get control of it. There was easing into this shock. But you go to 1990, I've seen a lot of work there. The Fed was slow to ease, even though jobs were weakening and we got the oil price shock in the first Iraq War, in part because of the inflationary threat. 08, Fed went on hold for 6 months after Bear Stearns, right? So 2011, the ECB hikes into it, and that was a mistake. And then, of course, 22, you didn't want to let it go. And the Fed didn't get ahead of it when commodity and other prices started going up. So maybe that's not really a roadmap. So what do we want from the Fed today?
Yeah. Well, how about if I answer the corollary?
Yeah.
What do we not want?
You sure?
I don't want to hear any more talk about rate hikes. We had some talk about that at the last meeting.
All right, Netflix is still going here. Netflix still looking for that A pivot.
I can't take it off the table, Mike. So when you were
policy mistake to raise rates in response to an oil price shock. But the problem is we can't rule it out because we do have some hawks on the committee. And also, look at PPI today and look at other inflation indicators. Yeah. We don't have inflation under control, and we've kind of got a hot economy. So, I mean, that's what's kind of keeping me up at night. Is there a possibility that we not only back out the rate cuts? Let me just put it to you this way. At the beginning of 2022, late 2021, we were still talking about, we're not thinking about right. Whatever the expression was, sure. Rate hikes.
Netflix going some more.
Bryn, we came into this phase, before the Iran situation flared up, with the Fed already kind of on hold. Both the jobs situation as well as inflation were not quite at their target, but they also weren't emergencies to respond to. So I wonder if the market's okay with the idea we're going to be data dependent, we're going to get a new chair, right? There's going to be a different orientation, and so get some comfort for a few months that, if nothing else, hikes are not in the offing.
I think having a new chair is a game changer, and so I think that we will get rate cuts. It's not if, it's when. I think that if you look at the inflation that we have, the inflation is not demand driven. And so I think when you think what
Netflix,
Fed have to actually reduce,
nice trend in Netflix.
does raising rates do anything for housing? Does raising rates do anything for home health care because of lack of immigration? Does raising rates do anything for food? No. And so I think the Fed's toolbox in terms of raising rates would have a counter effect to it. And if anything, I think they're going to focus on jobs, focus on the uncertainty. And that's where I do think later on the year, when Warsh comes in, we will get rate cuts. But I do think it's important to understand this inflation is not demand driven. And so we're not having all these loans being created and the Fed can raise rates, then all of a sudden lower that demand. And so I think their really hands are tied. And so I agree with Jim. I don't think it makes any sense for them to talk about raising rates in this environment. I think it would have the negative impact of whoever would vote for that.
I agree with both Bryn and Jim. I will take it one step further. I actually think they should be cutting rates in this environment. I think sustained oil prices have a deflationary impact. I cited
Okay, futures turning back up.
11 and 13. If we could show the chart of oil, if we have it, during that period, we had the average price of oil above $90 for that 3-year period. What helped in that environment? You said yesterday valuations were sure. Totally correct. But also, we had QE effects. We had a very low and easy interest rate policy acting to offset that effect on consumers from sustained rising oil prices. And I really think sooner rather than later, if you tell me we're going to have a 365, you're going to need another rate cut.
Well, I mean, I would argue too, though, you were coming out of the biggest deflationary credit shock in memory at that point, and you had underlying inflation that was way short of the target, not above the target. So we can say it's analogous on some level. Certainly, that's a nominal price chart right there, which shows WTI crude in real terms is way lower right now, and in theory should be less of a drag on growth. But I just think it's going to be interesting to see how Powell and the committee frames it, how it all translates into the dot plot. I still think that they're coming from a place of thinking rates are above neutral, right? And therefore you're looking for the opportunity to get them down toward neutral. But we'll see if that thinking has been revised. Do you want to switch over a little bit to some credit sensitive parts of this market? We mentioned a little bit the alternatives, but I think the banks themselves are pretty conspicuous. They can't really sustain a lot of a rally here, and I just wonder if that's just Jim. I mean, I don't know if you're looking at individual ones and how they're acting.
All right, Netflix still looking pretty strong.
More or less a malaise around growth in the yield curve. Well, let me start with the curious answer to your question, which is, we all look at what we own first and foremost. So today I'm seeing that both Citi and Apollo are up. That sort of catches my attention on a day that's kind of negative, and they were up yesterday. Now, no question, there's been a little bit of malaise. There's been a malaise in the financials. I'm having a hard time saying that this is a real fundamental credit or economic growth problem. The reason I'm having a hard time saying that is because they were gangbusters last year, the financials. I mean, it is okay if in the first quarter of 2026 they take a pause, take a consolidation. Now, somebody may be yelling at the TV screen right now, hey, they're down. Okay, they're down year to date. 2025.
Lulu, I'd like to see a few more upside days on Lulu.
This is a consolidation pause. It doesn't feel good. We've been talking a lot about the private credit worries. I think I've been consistent in saying that while there is some fraud, there are some underwriting problems. I don't see a systemic credit problem. And in that environment, I think it's just a matter of time before the financials start gaining their pace again. Brian, I was going to just say, I know you think that, in general, things have been overdone in this area. B of A was out today saying it's an opportunity to buy, for example, Ares. Apollo was also reiterated as an overweight of Piper Sandler. So it seems as if people are trying to figure out whether the companies that run these strategies have been unduly punished. We can make our assumptions about what it means for asset gathering in the future.
All right, S&P trying to push back up. Watching hedge flows here.
Yeah, absolutely. And I think, when you go back to last year, this all really started with First Brands and Tricolor, which by the way, really was not a private credit. It was JP Morgan, Barclays, et cetera, are the ones, Jefferies that had exposure.
Lulu, Constellation Energy, Intel, those are the top of the NASDAQ 100. Let's see what Intel is doing here. Intel, just in the lower half of the Bollinger Bands. Bollinger Bands are tight. RSI is hanging out at 50. Intel seems fine, just not going anywhere. What's AMD doing? AMD, same lower half of the Bollinger Bands, above the 200-day, below the 50-day. RSI gradually rising. People are just hesitant to put money to work at this point. That makes sense. SMH. Let's see what's working today, actually. Sector-wise, what's working? Believe it or not, semiconductors. Huh. I would not have guessed that. Energy. I mean, we do have Micron higher. Wow, Lulu keeps going here. Watch Lulu. Lulu was a good call out by Scott. Lulu. Look at that. Look at that reversal. Lulu starting a new trend.
Yeah, I think you have a lot of things to kind of give consideration to, especially on the fundamental side. What's interesting is the big banks reported really, really good earnings, and there was a very muted response to that. I think what's favorable about the financial sector relative to some other sectors like energy, we suggest, okay, you want to make sure you increase your exposure to energy. Well, it's a very small weighting in the S&P. You have 76 financial names out of 500 of the S&P 500. Jimmy, real quick on the math, that's about 15%, right? Ownership. So there are places you could go to rotate as a portfolio manager. And what I'm seeing within the financial sector right now is you're seeing a rotation that's available to you. You can go to the exchanges. You could own CME. You could own ICE. You could own Interactive Brokers. You could actually go back to the insurance companies.
Oh, well,
that took a pause.
ICE and the exchange companies that AI is going to kill, supposedly, because of the index business.
But they're trading well. I mean, you could go back to the insurance companies that took a pause in 25 when everyone said, okay, let's own private credit and own the big banks. So the names like Travelers and Allstate and Chubb, they're working well right now. So you can make that rotation within the sector because the availability is there.
Yeah.
Lulu looking pretty good here. I wouldn't chase it up here. The next dip back towards 164, 165, that'll probably be an area to think about buying. Lulu, it's changing trend, so multi-day swing most likely, multi-day swing.
Then this is the consolidation, the pause that actually sets up for the next leg higher. Of course, I could be wrong. There's real risks here. I don't want to be blowing on the real risks. But if you're bullish on the economy, if you think that private credit maybe has some underwriting.
Okay, let's see what they're talking about on Yahoo. Yahoo.
Instead of controlling them one by one, so hence the swarm name there. Very early stage revenue though. 2025 revenue was.
Okay, I got to take about a 10-minute break. Okay, I'll be back in about 10 minutes. So around 12:30 or so. Okay, I got to take care of a couple of things. Got to make some phone calls. Okay, so
Substantially all of their 24-25 revenue.
Lulu.
From that customer going forward. So
Okay, let's look at the S&P. I'll keep an eye on the S&P. All right.
check out the charts real quick on the Wi-Fi Interactive.
Hedge flows turning up.
Another 33% today. Here's a max chart from the $5 IPO. It is up 731%. So
And by the way, make stop for it. Let me So dystopian. All right, let's talk about Lululemon. It is issuing weak guidance for the current quarter and the fiscal year. It's dealing with higher tariffs. It's dealing with declining sales in the Americas. And of course, it's also searching for a new CEO. Calvin McDonald exited in January. It's dealing with its founder, Chip Wilson, kind of poking at the company. Joining me now is Adrian Yee, Barclays Consumer Discretionary Analyst. Adrian, it's always great to see you. I love to talk about Lululemon, and it is so fast. I feel like I've been talking to you long enough about this company that, like, we talked when Chip Wilson was there at the company before. What does Lululemon need to do? And do we have a good understanding of what he wants them to do to sort of get back on track here?
Yeah, I think that this is, the case of companies that get very, very large. They become the number one in this space. And it's not that they become complacent, they become safe, right? Because they're now playing sort of not to lose versus to aggressively win. And I think what he wants them to do is get back into that kind of small kind of fighting mindset where they're basically innovating, they're taking risks, and frankly, they're kind of leading the charge on that leisure space that they frankly created.
That said, I just to linger on the quarter for a minute, the company's overall net revenue was up 1%. In the Americas, it was down 4%. In China, though, they're still seeing plus 20% revenue gains. Is it just that they're smaller there and that that's sort of an advantage?
Absolutely. So if you are kind of thinking about kind of what the problem might be, right, in the U.S. market, it might be that we are saturated, right, kind of in that particular space. Not that everybody, right, it's not Nike, so it's not like kind of everybody is buying Lulu, but for the target market in that women's technical apparel, right, we're kind of, at the peak, right, so you're looking for growth elsewhere. One of the other issues that has happened with Lulu is that new entrants have come into play in their space, and they are growing the most and the fastest in the U.S. market. So in the China market, they're small. They are the fighting competitor. They are the kind of one that is growing there. Lots of white space on the landscape there. And it's a new low brand awareness concept, right, in China that's very, very desirable. It's also priced quite attractively there, very differently than it is here in the U.S. So over in China, they raise their prices relative to the U.S. maybe 15, 20% for that market as they try to engage with the customer. Most other U.S. brands, when they go to China, they'll price up 50, 60%. So in the relative atmosphere of China, they are very, very good value, great quality for the value. And it's just a little bit different here with the higher, more intense competitive landscape.
I mean, Adrian, I remember where you could not get Lulu stuff on sale. It just didn't exist. Remember, we made too much. It was like a tiny portion of their merchandise they would sell at sale. Now they have sale. Now they have their Lululemon like new, where you can buy certified, pre-owned merchandise, so to speak. So it just shows how far the company has come here in the U.S. market. So what does the next leader of this company need to look like? Is it Chip Wilson coming back? Is it somebody like On Running's Mark Maurer, who Chip has nominated to the board? What do you think?
When you have these types of kind of dislocations, there's a little bit of operational and there's also a bit of the innovation. At the end of the day, what we always say is that product matters, right? So if you did put somebody that was more product oriented, you do want to have that strong foundation of operations to support kind of all the things they're doing. Obviously, there's an activist that had proposed Jay Nielsen. This is very public. And so to the extent that she might be the person, she's sort of more operational, but you can fix that, right? You can fix that by having a very strong product leader, a very strong merchant. We've seen Tapestry do this, very, very well, right? It's a very symbiotic relationship. So I think you could probably have from a CEO-ship either a merchant or an operational person, but it's really that person who strategizes and brings Lulu back down to its roots of innovation, forward thinking, right? And kind of like leading the charge, as I said earlier.
While I have you, I want to talk to you a little bit more existentially, I guess, about retail, because we've seen headlines recently about Eddie Bauer closing down. I was looking at some headlines say about Kohl's closing some of its locations. And I'm sort of fascinated by the idea that, you do have these retailers that end up closing down. In many cases, it takes a long, long time. Lulu's having some challenges. We're not suggesting they're anywhere close to that kind of an outcome. But as someone who really is steeped in the space, what to you is the differentiator between, a retailer that ends up making it and thriving and some of these that have that sort of long, slow decline?
Yes, I love that existential question. And I have, been doing this for decades, as you know. And what I would say is the enduring quality, right? And the one that causes companies to miss the mark and go off target, right? Out of the bullseye, is they forget that at the end of the day, this is an emotional experience. People talk about experiential retailing. That's fine insofar as you created, right, a moment for that consumer where they're leaving the store energized, they feel better, they look better. Whatever it is, you have to have an emotional connection to the brand such that when you utter the brand's name, people actually recall that experience. If you can do that, you will have an enduring brand. And I don't think that Lulu has lost that at all. I think for the moment, people are sort of shopping elsewhere. But if you can create that experience, and by the way, you really can only create that experience over the long duration, right, in a store environment. You have the right people, you have people, kind of helping you with the product. And then if you have the great product that makes them feel like $1 million, that's the winning combination.
Adrienne, it's great to see you. Thank you so much.
See you. Thank you.
Appreciate it. Coming up, we're going to keep talking about retail, what Macy's fourth quarter beat says about the future of that company. We're going to hear what the CEO had to say next on Market Catalyst.
Swing, strike, slice, adjust. One more. Good. Now again.
Any veteran that has struggled trying to claim the benefits on their own and been denied, they need to get with Veterans Guard.
Nice hit. Almost there. You win. Is it raining cats and dogs? No! It's raining cats and wins! Take a spin on kitty glitter for fluffy felines and jazzy jackpots. Not a cat person? That's okay too! With over 300 slots, authentic Vegas fun comes in all shapes and sizes at Double Down. Download now. Play for free.
Build a snowman. Go! Snow power! Snow power! Snow power! Snow power! Oh no! It is the last card. The wild card. Snow power! Join the fun.
say the house always wins, but that's about to change. Meet Novig, the commission-free exchange. Here you trade against real people, not a sportsbook. Build parlays your way. Take total control of the odds and get ready to win big. When you win on Novig, you keep 100% of the profits. No hidden fees, no limits. Download Novig today and use this limited time offer code BONUS50. Get $50 when you spend $5.
They're faster than us.
What's that? Over there. We need to restore power quick.
Greetings. My name is Maya.
What are you?
Holding. The original active extensions for VIX hands.
Get those torpedoes in here.
Witness news as it happens, 24/7, live, raw, and uninterrupted.
Just incredible video that we've been seeing.
Watch live now from Fox for immediate live coverage of the day's top stories, breaking news, and defining moments. Around the clock, live coverage as it happens.
Appreciate everyone continuing to join us all in real time.
Stay engaged, stay connected, stay tuned to Live Now from Fox.
MSTZ.
AI startup Aru, founded in 2024 by teenagers, is now worth up to $1 billion. Yahoo Finance's Josh Lipton spoke to the co-founder and president about how the company is transforming market research.
Maybe, Ned, start by just explaining a bit about your company's mission, the kind of problem you're solving for, Ned. In simple terms, I was reading up on it. It sounded like, Ned, okay, you created sort of an AI system here, and it could replace traditional market research. So surveys, focus groups with AI agents. Am I thinking about it correctly?
Yeah, well, first off, thank you so much for having me on. It's really great to see you and really appreciate it. As far as I see it, market research is just the start, right? At the end of the day, what we do at Aru is we simulate human behavior. And if you believe that humans are the preeminent species on the planet, which I think you and I probably both do, you can do a lot with that, right? So some of it might be a much more research use case where you're simulating the behavior and asking someone's A/B opinion on an advertisement, rather than you might have the entire other side where someone comes to you with a question about how do I mitigate churn of my customers? And that's a lot larger than just traditional market research, but it's still something that we solve every day with our systems, which is really cool.
Ned, what's the kind of data you're feeding into this AI model?
Yeah, no, it's fascinating. We are in the Valley where we're operating at this time when human data has never been more important. Right? You have companies building world models and large foundational labs that are spending hundreds of millions of dollars on PhDs to Lego math problems and all these sorts of things. And interestingly enough, we kind of operate at the antithesis of that, right? When you think about modeling behavior and simulating populations, one of the biggest core principles of what we do at Aru is that humans themselves are not accurate representations of what they actually do, right? People lie. Fortunately, both you and I are wearing clothes, and I highly doubt you asked Hugo Boss how much you were going to pay for that jacket before you purchased it, right? The truth is, at the end of the day, is humans lie. They have biases and all these sorts of things. And when we build these models, both in the way we make sure we're properly generating the agents who we are going to simulate, making sure we have the right race, age, income, all those sorts of things, we never speak to humans, right? We look at things instead that are ground truth building blocks and what makes you and I who we are, right? We might look at a voter file, a credit card purchase history, a statistic on how many people in a certain area have running water. And then on the flip side, to actually model their behavior accurately, we'll look at things like vote counts and click-through rates and sales results instead of things like polls and surveys, again, because they are not indicative of what people actually do. And so we kind of operate at the back of that. On a total reversal of using humans and instead looking at the outcomes-based data of what they actually do, which is really interesting.
Can you give us, Ned, like a hard example of your AI model at work, just to illustrate it?
For sure, yeah. I mean, you can go as simple as saying, "I'm going to launch a new product, right, for a soda brand, a very public partner of ours." Interestingly enough, is Spindrift, right, and they're just putting out this large, initiative around putting forward a still drink for the first time. It's actually a tea, which is something you haven't done before. Traditionally, they're sparkling drinks, much more in that sort of area. What we'll be able to do is simulate an entire population of consumers within the U.S. or whatever interested market they're looking at, and identify, hey, let's put these packages in front of it. Are you going to buy this? What price are you going to pay? What flavor do you want? Right? All sorts of things that'll be revolving around behavior to optimize a product deployment. And then even going on there from ads, right? And so on and so forth. So it's like a much, very consumer focused use case.
And for the company, then, for your customer, is the benefit also, am I saving money? Am I saving time? Can I move faster?
Yeah, I mean, traditionally in decision making, whether it's around products, for example, or some other sort of area, you're spending months and months and months to come to a conclusion around doing these things. If you're using traditional human research, if you're using traditional strategy consultants, sorts of things like that. And so, of course, there's a massive amount of time where we're able to generate these entire populations in a matter of minutes, right, which has been really cool. As far as like the saving money thing, absolutely, these things have massive economies of scale as opposed to traditional people. The more you ask, the cheaper they don't get. But I had a mentor actually very early on who gave me the advice that you can only save a business so much money, right? We like to tell our customers a value story, right? And so we operate the opposite end of that, which is, look, we're going to make you more efficient. We're going to do all these things, but we're going to help you make better decisions and grow your business a lot more, which is how I believe you should build an everlasting business. Yeah.
Yeah, I got to ask, I'm reading that you guys, you're young. I read that you started the company then just a couple of years ago. You and the co-founder, you're something like 18, 19 then. Is that, I'm curious, is that ever a challenge? Like you're talking to some CEO of some big company, and is it ever a challenge to get him to trust you guys, Ned, to really take the lead on what could be like a mission critical decision and project?
Look, I think it's a great point, right? I just became legally able to drink a couple of weeks ago, and we've been servicing alcohol businesses for the last year, so I think it's an interesting paradox. But absolutely, right? I think it is for every AI company, not just because we're young. A lot of people are putting out a lot of stuff. A lot of stuff sounds really exciting. So what we do at Aru, and the reason we've been able to grow so quickly, right? The business is exactly what you said, just under 2 years old. You're 19 when I started this company. My co-founder was 18, right? My other co-founder is even younger. I'm 21 now, and how we've been able to do this is just by making our value proposition so blatantly obvious in a pilot and in a first interaction with the business that if someone's executive who ends up hearing about that pilot being ran doesn't purchase it, we've literally seen people get fired as a result, right? What we pretty much do at first stages of entering a business is, look, people have sold predictive technology for a while. We say, let's prove it, right? I can try to convince you that magic is real, or I can show you. And so we'll ask a business. If it's a marketing use case, maybe I ask for an ad. And you know what research you ran, you know what decision you came to, you know what actually happened, whether A or B was better, and we'll run it blinded. We'll do it with product deployments. We'll do it with credit card perks, whatever it may be, right? We'll take something that you know about your business without taking any data from you. We'll run a simulation of that population, totally blinded, and prove that we're more accurate than whatever brought you that conclusion in the first place. So it's been this really, really cool thing of being able to prove from the outside in, demonstrate the capabilities of our system, and as a result, move very quickly into gaining the trust of our customers, which has been really cool.
Then I read that you and correct me if I got this wrong, that you and your co-founders, you dropped out of college to pursue this, right? And these like, just so viewers understand, these really good colleges like Harvard, Dartmouth. I couldn't get into these colleges. And I just wondered, do you think maybe we're entering some new era where, companies could be founded by even younger founders than we're used to moving forward? And then maybe AI could kind of lower the barrier to entry.
Yeah, absolutely. Don't cut yourself short. I'm sure you'd make it no problem. Yeah, I was at Harvard for about 2.5 weeks before I left, which is quite amusing. But no, I think at the end of the day, in my opinion, like these schools are great universities. It really is just about opportunity cost. Absolutely, to your point, the barrier to entry has been lowered, and I think that makes me as a tech founder think a lot about where do we want to spend our time to make sure our value proposition is so differentiated. To me, that's making sure the product is most usable to the customer, right? I'm in San Francisco right now at a friend's office. We made a very pointed decision to set up office in New York after being an SF for a short amount of time so that we could be near our customers, so that we can understand what a large enterprise actually needs out of a tech platform to use. So, and you know, people have always been creative, right? People have always been able to build things at young ages. I think that has been massively, expanded now with obviously AI making things a lot more accessible. But I think things will be just as hard to build around the product and making sure that things are tuned to the usability of customers, because that doesn't have as much to do with AI as much as it does to have with your ability as a founder and as a team to understand what the customer needs. So, yeah.
Yeah, Ned, it was so great to have you on the show today. Thanks for your time. I appreciate it.
Fantastic. Thank you so much for having me, and have a great day. Really appreciate it. See you soon.
Macy's shares are rising after the company
Futures,
expectations and issued a strong
little dip while I was on the phone. Bounce. Hedge flow still rising. We got a little bit of resistance overhead. Some of this built. Some of this has built since the open this morning. Looking at 6,700 right here, 6,700. We can see that that's built some longs and started to get some shorts right in here. People short, dealer long, indicated by purple. That's a dealer long, market short. If we can get back above this level, need to get above 6,700, ideally. Netflix, okay, looking for that B pivot. Okay, we're finally looking for that B pivot on Netflix.
He sort of turned it around and said that they're ready for all of, any sort of headwind.
Looking for a B pivot here.
He went on to say that he's had experience with the dot-com bubble burst. He went through the pandemic.
MACD's crossing.
As long as you have liquidity and a healthy balance sheet, they'll make
Sprouts Farmers Markets. If you find this kind of a stock setup, let me know, because these are really good trending stocks. Stocks that are above the 20 EMA on the 60-minute time frame. You find something like this, let me know. I mean, these look good. These are really nice trades. SFM, Sprouts Farmers Market, brought to you by Tony this morning. Looks really good. Into the Kirby overhead.
Retail analyst who's covered the industry for decades. And I was talking more about what differentiates retailers who make it and those that don't. We've seen some examples lately. Kohl's is closing stores. Not to say it's not going to make it, but it's closing stores. Eddie Bauer going out of business and closing stores. Like, what's the difference? And she said it really is about the emotional connection that a brand can build with its customers over years, right? It's not overnight. And so as we talk about Macy's, it gets me wondering, like, at one time I had an emotional connection with Macy's, I feel like. Maybe when I was a kid and I would go shopping there with my mom. That was one of the spots.
For me, that was JCPenney's.
Right. Yeah. But I wonder what that looks like right now and like how, because Tony Spring has made some changes at Macy's.
Yeah, and keep in mind, Macy's is not immune to these closures that we're seeing from department stores. They still plan to close about 60 to 65 stores in the next 3 years. So that's certainly still underway. But what he has done over the past 3 years is these so-called reimagined stores, where they're putting in more staff, more digital advertising, just more activation. So he was talking a lot about like this prom activation that they're doing. Also, their skincare lines are really working for them. Even young people, 12, 13, 14, buying more La Mer, which is a very expensive skincare. And he was even surprised when he said that they're sort of, appealing to these moms who are looking at their young teenagers who are wondering, where do I even begin with the skincare allure that they're all going through, right?
Do not begin with La Mer. If you're a teenager, I can tell you that. You could slather olive oil on your face if you're a teenager. Most teenagers can probably do just fine. Anyway, I'm no skincare expert. Disclaimer, I'm no skincare expert.
But certainly what he said is that we're sort of seeing this ongoing persistence of this E-shaped economy as opposed to a K-shaped economy.
What is that? That's a new one for me.
New one, I know. He said some will call it an E-shaped economy. E-shaped economy. He said that we're seeing the upper income continuing to trend well. They're continuing to spend. The middle income is looking for deals, and they're just sort of staying along, while the low income is just staying persistent, and they're just keep chugging along. He said specifically, low income pressured, middle income still trying to find opportunities to buy. Upper income consumer, though, still confident that
it would be
can
like,
buy.
it's more like a W on its side,
Right.
than an E to
With the
me.
two, with the W sort of edging down.
Right, like the one. Okay.
No, I totally get you. I totally get you. But nonetheless, Macy's continuing to pursue this uncertainty, and definitely interested to see what happens over the next few years with this brand. It's been almost 2 years since they announced that whole new chapter strategy, and it seems to be working. I mean, right now we're seeing stock move higher based on these results.
Thanks a lot, Brooke. Appreciate it. Coming up, we'll take a look at bond market ETFs. We've seen a lot of money come into those. We'll talk about it next.
It's time to watch his biggest things up. Boom.
All right, looking for a follow through. All right, NVIDIA did fall back off. Netflix is trying to hold on. So is Google. The New York Bangs are off for now. It'll take more time. It's going to take more time. Looking for a bounce.
And we should always use Game Time for tickets. They're dropping cool features like zone deals and price drop alerts so we can go to more games and shows. Finally, a ticketing app that actually gives a crap. Download the app today.
Do you play games on your phone?
Yes, when I have some time.
Yeah, almost every day. What if I told you there's an app called Tester Up where people get paid to play games?
Just a few levels and I get money.
Oh, wow, it works. I'm down.
I think friends.
Play on Tester Up now.
Stuck in boring apps? Tika's got a better idea. Play your card right and unlock the castle. Solve tricky levels and pull the key. Hurry up to warm Tiki up before he freezes solid. Can you do better? Download and play now.
G47, B13, O70, I26, O73. Bingo!
Hey there, come on in. I've got a show that's full of wins. Spin the reels and light the beam and chase that grand jackpot game. Wild and horses shining bright. Times like this, it feels just right. Stick around, we've just begun to make some magic just for fun. Boogie-doo, come on, take your shine. Jump right in the brand new show.
What's that? Might be some kind of pain. You need to restore power quick. I'm a former NASA mechanical engineer. I originally started on YouTube showing off some backyard science experiments, and now I'm doing experiments for viewers all around the world.
S&P.
The U.S. war with Iran is putting bond market safe haven status to the test. BlackRock, though, says this cycle favors a more income-oriented exposure with ETF investments.
flows than we were last year, and last year was a record.
So what, like, and it feels like that's happening across the ETF.
Okay, S&P, VWAP is overhead. This is not unusual. This is what we've been seeing lately. Selling the open, stay below VWAP all day, attempt to get back above VWAP. People buy down here for short-term trades. Wind up getting rejected most of the time at VWAP. So the trend is nearly straight down as far as the VWAP line is nearly straight is what I meant to say. So last week we had the same kind of situation. We bounced on Monday, Tuesday. We faded Wednesday, Thursday into Friday. The 200 days down below. We still haven't touched it. Looking for a higher low. If the bulls are in control, we need to see a higher low. That would negate the previous buy into Monday, Tuesday, sell into Wednesday, Thursday, Friday. If we break the pattern, we'd be looking for a higher low and then a higher high tomorrow. Okay, futures turning back up.
In other words, you know, we've seen a huge increase in registered investment advisors and wealth managers. The wealth channel has grown, and like they need stuff to sell to their clients. I mean, it's a little cynical, but like that also seems to be going.
I think this has happily coincided with just an increase in investor awareness. So if you think about it, there's and it is the investor base that you know, we're really seeing coming to the market. You guys are very familiar with this. The direct investor base really has discovered ETFs and bond ETFs in particular. And so, as an example, we're seeing really significant flows into our I-bonds suite, our defined maturity suite. Why? Through all this noise, you pointed out the 10-year, right? If you look 2 years ago, the 10-year was at 4.30. You look at last year, it was at 4.15. But in the meantime, you're pushing below 4%. You're pushing towards 5%. What works in that environment? Laddering. People love just a lock-in yield right out the storm, and those defined maturity ETFs, the I-bonds, are perfect for that. And so investors are responding that way as well.
Interesting. Okay, so what do you think? What do you sort of recommend? There's what's happening, and there's what you guys are. I mean, maybe they're just one and the same. Maybe people are taking your recommendations, but especially given that we are in a war, that we're in a volatile time. How, you know, and that there is that safe haven status usually, but it's not that although it's not quite working that way over the past couple of weeks.
Yeah, I mean, there's a lot of noise, right? With energy prices, oil, inflation expectations, et cetera. And so I do think you have to have a view, right? And so if it's uncertain and you want to, you know, sort of wait and see, that's going to be ESCO. We've also seen flows into, we have a short-dated inflation product, ICPI. It's a 0 to 1 year inflation product. We've seen flows starting to come into that as well.
Okay, trying to get back to VWAP. Netflix giving us another pivot. Netflix, higher low. Bottom line is taking less risk right now. There's always a possibility we drop off to the 200-day. There is an equal possibility we could see a rally into the 6,800 area. Now that VIX is out of the way, that's going to free up a lot of premium, as those were hedges mostly. Like we had the hedges going into this Wednesday that we bought about 3 or 4 weeks ago when we bought those put flies. Looking for a test of the 200-day. I am out of the put flies, by the way. I would like to buy some more, but I want to see a bounce first. I'd like to see a bounce back towards the 21-day over the next couple of days over here. If we get a bounce back towards the 21-day, I'm going to buy some more put flies, because once OPEX is out of the way, we lose a lot of support down below. Okay, I was looking at this before. Okay, so there's not a lot of puts down here compared to where, you know, above 6,700, there's a lot of puts and calls overhead. Support, good structure overhead, also resistance, but down below, you see this down here at 6,000. That's kind of crazy. The trough is at 6,430. The peak is at 7,000, more or less. down below 6,700. You can see we're in negative gamma territory. All of this right here is showing up as red on the screen. Okay, all of this red is due to that. All this red is due to this negative gamma that we're in too right here. You can see where it flips from above the histogram line, zero line, to below the zero line as we move lower, 6,600. Pretty big level at 6,600 right here. Okay, so we want to get back above this level. We want to get back above 6,700. Okay, we're looking for a Vanna tailwind. You can see how this turns up. We're looking for a Vanna tailwind into OPEX on Friday. We might get that. This keeps turning. SPY, Qs, below 600 Qs. Stupid commercials. All right, so see what they're doing. Santoli. Okay. Waiting for CNBC to come back. All right, S&P 500 pulling back now. No move back above VWAP. For the bulls to hold this, we need to see a move back above 6,700. I don't know if that's in the cards. Looks bearish. The 200-day is right below, so I assume we're going to test the 200-day in the short term. Netflix is off the high now. Okay, so today, JP Morgan. Yesterday, Goldman Sachs was up. JP Morgan trying to follow through. Caterpillar coming off that 660 area. Chevron making new all-time highs every day. Energy up 0.5%. Energy. Energy continues. Energy.
Hey, Kelly, the Vice President, J.D. Vance, has been speaking to voters in Michigan over the past hour. And as he talks to them, he's doing some expectation setting about how long the war in Iran will last and what that means for them in terms of gas prices. Here's what he said. We're going to take care of business.
Futures just rolled over pretty mightily. Futures just rolled over to this low from earlier.
There. One is
He says that a couple of announcements are coming from the administration in the next 24 to 48 hours in terms of ideas to lower gas prices. And then he talks about the overall time frame and expectations. He says we've got a rough road ahead of us for the next few weeks, but it's temporary. So an expectation setting from the vice president of that this war will last at least for the next few weeks, but calling that temporary and saying that oil prices and gas prices for consumers and the
All right, Swarmer turning back up from VWAP.
And we ease sanctions on Venezuela as well. So first on Russia for I believe it was 30 days. Then now we've suspended the Jones Act for 60 days, if I'm not mistaken. And now we've eased sanctions on Venezuela as well.
That's right. And then clearly there's a couple other ideas on the shelf inside the White House that they're getting prepared to roll out I would imagine along those lines. And each one of those, I think economists and oil industry experts can tell you better than I can. There's a dispute over exactly how much they could lower the price of gas at the pump that will affect those voters that the vice president's talking to. But clearly, there's an all hands on deck effort here inside the administration to do everything they can to keep those prices in line as best they can.
Right. Amen. Thanks for now. Appreciate it. Amen, Jabbers. Let's stay in Washington as we await the Fed's next move. Steve Leisman joins us with the final setup. And Steve, a big data point just this morning that could really impact their thinking.
Yeah, Fed officials greeted at the door on the second day of their policy meeting with a hotter than expected wholesale inflation price report, giving them more reason to leave rates unchanged and probably signal no immediate cuts on the way. But the historic surge in oil prices will unavoidably influence the statement, the Fed's forecast, and the chair's commentary at the press conference. Some of the keys to the meeting today: the dots, those forecasts of future rates likely signal one, maybe no cuts in 2026. We'll talk about that in a second. Future policy is going to be linked to inflation expectations and whether the oil price surge raises core inflation as well. The inflation outlook will rise higher, and geopolitical tensions and uncertainty likely added to the statement. Whether the Fed dots signal that one or no cuts depends on if hawks become more hawkish with the worsening of inflation data and the surge in oil, and if the doves have become less optimistic. Worth watching what Governor Myron does. He's continuously dissented in favor of more rate cuts, continues to oppose the consensus, and whether or not others will join him. As for the market, rate cut probability is taking another leg down after that PPI came out above expectations. A single cut remains priced into Fed futures markets, but the chance of a second cut becoming vanishingly small right now. The overriding question for the Fed, whether to look through the oil price surge and address potential economic weakness, the risk to that strategy with inflation running above target could undermine the credibility of the commitment to the 2% target, Kelly.
It's, Steve, you've been covering the Fed, everyone there for so long, and there was some, I guess, discord, even going into this. Just what's your sense of the importance you think they might assign to the PPI readings and to the fact the last couple months have seen, look at the core PCE, was it 3.1 in January?
Yeah, I mean, the Fed cannot argue right now that inflation is headed towards the 2% target. It's an argument you can't make. And I think you may throw out the dissents if it's just Myron. He has been sort of always, a lot of times dissents tell you where the panel's going, but that's not been the case with Myron. Nobody's really joined him. But if Waller joins, if Bowman joins, that's a different story. And it's a sense that what they're going to do is thinking about addressing the oil price surge more on the weakness side. I will say the Fed survey had a lot of that in it, where people said the Fed should look through it. But again, there's that risk that having looked through the tariff inflation, then you're going to look through the oil inflation, and then it's that old joke that once you X everything out, everything's flat.
Right. Life is much easier that way, I think.
Right.
Steve, thanks. We'll let you get ready. Really appreciate it, Steve Leisman. And let's get right to our first panelist now, who range from thinking we'll get 2 cuts to no cuts to maybe a hike this year. Steve Whiting is Chief Investment Strategist at CIO Group. Claudia Sam is Chief Economist at New Century Advisors. And Jim Bianco is President of Bianco Research. Who is in the possible hike camp? Jim, is it you?
I am in the possible hike camp. I don't mean anytime soon, maybe not this year, but I am in the camp that I think we've seen the last rate cut, and I think the next move will be a hike, might be 27 again. And I'll just point you to the ECB. That market is already pricing in that they're going to raise rates twice this year. Everybody's moving in that direction. The Fed's been a bit slow.
That said, Jim, I was asking some kind of different analysts about this in the last few weeks, and they said, well, the ECB was much quicker to get back towards neutral. I think their rates are pretty low.
And so their, I guess, reaction can afford to be a bit more hawkish than ours.
Oh, that's true. They can be a bit more hawkish, but I also think that Steve Leishman was saying, when you look at the inflation numbers and you look at what we're probably looking at, maybe a 0.7 to 0.9 for March.
Markets are not following through. So we got a few things that are working, like Lulu making higher highs, higher lows. Sprouts Farmers Market at the highs.
So has Ms. Som, who's sitting remotely sitting next to you. And I really took notice of that, Claudia, because of course we all follow your work very closely. And I think you're always very measured. And in fairness, you are very measured throughout this piece, saying this is really about risk management. They have to, the risks of a serious economic downturn, the risks of a worse labor market, but you also acknowledge the risks of a rate hike. How high do you think those risks might be right now?
So I think they're uncomfortably high. And what's important is they really shifted since the Fed last met in January. The war in Iran and the potential inflationary shock really does change the dynamic. It changes the risks that are on the table, the ones that are possible. I think, my base case, and I imagine many Fed officials, is this going to be a temporary disruption. While they will wait to see that, they will look through it largely, but there is a risk that this is protracted and, inflation really moves high. And this is such a salient price to go through gasoline, have it then maybe hit inflation expectations. So at this point, the Fed really can't take anything off the table. And it is possible the next move will appropriately be a hike, but it's far too soon to say that, right? It's just we've got to put all these scenarios on the table right now.
Steve Whiting, yesterday I was sitting with Steve Grasso, who thought it would be a terrible mistake to raise interest rates in response to an oil price shock, which I would generally agree with. I think a lot of people would, actually. I mean, the last thing you want to do is take something that acts like a tax on the consumer and double down by tightening monetary policy. That said, this report shows that we've had pipeline inflationary pressures building for a few months' time. Can you give us any clarity on why that is? And do you think a rate hike versus a cut? I mean, what makes sense in this kind of environment now?
I just want you to just imagine going forward. If the economy is in a recession, employment is contracting by a couple 100,000 per month after month, the unemployment rate is rising to 5.5%. What is the Fed doing? Yet regardless of what they can do and what they can impact, the Federal Reserve would be easing, and they'd be easing very significantly. We probably wouldn't hit zero again pretty easily, but the Fed would be cutting hard. And that's the problem with just focusing in on the immediate view of the economy. The opportunity to restrain inflation during a stronger period for growth, being a little hawkish when things are going well, that was the Fed that we used to know. Now they're not really going to do what they did in 2020, 21. We saw the mistakes that they made being excessively accommodative, but knowing what would happen to the economy.
Right.
They wanted to be very accommodative. So I think we're in a situation where, okay, 92,000 jobs lost in the month of February, probably not representative of exactly where the labor market is. But this is a weakening labor market trend. You can see this in consumer surveys that are telling us there is less demand than there is supply. And okay, the issue that we just had with energy, like the tariffs, yet another thing that constrains potential economic growth, should mean that the Fed can't do anything about it. But a lot of what we're seeing in the labor market now is roots all the way back to the tightening steps in 2022 and 2023. And the Federal Reserve, sooner or later, is going to react to this labor market, ideally when the inflation shock is out of the way.
So, Claudia, I have a bigger picture abstract question for you, which is, we're in a CapEx cycle right now. We're in you could argue we were in underinvestment during the 2010s in a lot of our physical infrastructure. Now we're scrambling to catch up, especially when you throw AI on top of that. If or as that drives up interest rates, what do you do with a somewhat weak labor market at the same time?
But the fact that we have a good capital expenditure backdrop, that is a plus, right? It falls right in there with, we have a consumer that overall has been relatively solid over the past year. So, whenever we want to go into a shock, like the energy price shock, on the best footing possible, I don't think, so I see this more, the CapEx spending, I see that as a buffer, not a challenge for the Fed at this moment, that we want to see those
expenditures. And I don't think whether you look at on the capital expenditure side, the consumer side, the labor market, there's not this like overheating vibe that we could have seen potentially in, coming out of the pandemic in 2021 when things were kind of really heating up. So that's not the backdrop that we have now.
Okay, and Jim Bianco, kind of same question. I also love to hear your response to the case that Steve was laying out there, which is, he perceives a weakening or a weaker labor market, that you should cut rates or lower rates now so that it doesn't get a whole lot worse.
Yeah, there's the other side of the equation, and that's the labor supply side. The population growth in the U.S. has been declining because of lack of immigration. And so even though we've seen jobs average 150,000 a month back in the middle of 24, down to around 9,000 a month now, the unemployment rate's only up 0.2%. The thing about this is we might be averaging 9,000 jobs a month over the last 12 months, but that might be all we need. And that even Chairman Powell said in his September press conference, we still might be in balance down at these low numbers right now because of the change in immigration.
Steve Whiting, last word.
I think you need to take a look at the total growth of the labor force, including both native and immigrant populations. And the shifts that we've seen in these surveys, what that's telling us is that we do have an imbalance, and the unemployment rate is actually going up. It will go up more if it matches what the survey data, if we read the Conference Board data, for example, is telling us, which for decades has told us that right now we are in a deficit of jobs.
Claudia, do you want to weigh in here as well? I mean, you know the unemployment, the way it behaves as well as anyone.
Yeah, I just want to underscore. I mean, we're facing two problems. There are downside risks on the employment side, and there are upside risks on inflation. Like this is a tough one, and honestly, the Fed is just going to point at whatever it thinks is the bigger problem and respond to it. So I agree with all these points, and that's what makes this so challenging right now.
Can they say they're both big problems? I know that,
I think that's part of the uncertainty of this moment, and part of their pause of being on hold today is to gather. Really feel confidently they're acting, and they could move pretty fast when they get that confidence.
All right, Steve Whiting, I know we have to go. I appreciate you guys just giving me a couple extra minutes here. The market is always, it doesn't like a hawkish tilt, let's just say. Just what do you think happens if the Fed doesn't come out and talk about what you're talking about and acknowledges that we just showed that chart, upward pressures in prices, and they have to kind of think about those risks. What would you say to the market if it is, quite upset at that outcome? You see this as a buying opportunity?
Well, look, I think dollar strength, some of the weakness in foreign markets, the big rise that we've seen in energy-related shares, it's a focus on the immediate. And at the same time, if you take a look at futures markets out a year, it's saying that all but $10 of this oil price rise is going to be erased. It's a little sad that the Fed is in this position. It's very hard. And if it wasn't for the overshooting inflation during the pandemic, they would be able to look through this one. So I think the market, again, takes it hard if it's going to be hawkish right now. But I think in the end, we know what the Fed does. Whether you want it or not, the Fed is very activist and will respond to the labor market when the signs.
Futures continue to step lower. Futures, bear flags.
Today, Stephen Whiting, Claudia Sam, Jim Bianco, and we'll see what happens in about 45 minutes' time. In the meantime, the president waiving the Jones Act for 60 days in an effort to steady the oil market. Is it a sign the White House expects the war in Iran to last that long? Maybe longer than expected. We'll talk about that next. Plus, the technical trade ahead of the Fed, the key levels to watch on the S&P, and whether the chip makers are flashing a bullish sign. The biggie today, folks, might actually be Micron after the bell. We're back with a lot more after this.
This is The Exchange on CNBC.
More expensive, and so you really have to have a real strong investment thesis around what area you're in and around the economy itself.
Joe, this seems to tie into the affordability that we were just getting at before the break. So sorry to cut you off, but maybe we can kind of tie all this together now.
All right, so the cool thing about that is I think travel the country and we're talking about the U.S. about the global. The last year has been very instructive. If you go out and you try to tell somebody or the public that they don't have an affordability problem, I've seen people get laughed at, mocked, booed, and heckled. What's going on out there is we've had 5 years of a price shock, and people are beginning to make up their minds about where they're at relative to the greater economy. And for many people, it's not good. So Jared, that affordability issue is front and center with what I call the post-pandemic economy and the regime change that we're undergoing right now.
But what happens after this bill spurs consumer spending? Because we're hearing it's going to lift companies like McDonald's and people are lower income consumers will be able to go back to them. But what happens when that check is paid? They don't happen anymore. Where are we at the end of
Just ran a scan, looking for stocks that are moving above the 20 EMA on the 60-minute. Applied Materials, American Mobile, that's telecom in South America. Carlos Slim, does he still own this? I don't know. Nice trend developing here on the 20 EMA. Multi-day swing potentially. Watch RSI. RSI is overbought at the moment. Arista Networks making higher lows, looking for a higher high. RSI still rising. Arista Networks. Bollinger Band's tight. Arista Networks. ARM Holdings pushing a bit higher.
Now, as an investor, you're going to be overexposed to the areas that you know are going to do well on the backside of this. Yes, money.
ARM Holdings pushing back to the top Bollinger Bands.
Matt, President Trump issuing a temporary waiver of the Jones Act earlier today in an attempt to stabilize oil markets amid the Iran war. The suspension will also allow resources like natural gas, fertilizer, and coal to flow freely to U.S. ports for 60 days, according to the White House. Not having a big impact on oil today, WTI reversing higher to 98 a barrel, Brent's at 108, as we mentioned earlier on. For more, let's bring in Michael O'Hanlon. He's Brookings Institution Foreign Policy Program Director of Research. Michael, it's great to see you with just kind of a pulse check here on where you think we are in the war. How far along? How many more days? If some are even saying if we suspended the Jones Act for 60 days instead of 30, does that mean we see a risk of more prolonged conflict?
Greetings. Well, that's a distinct possibility. Yeah, I think we're in the phase now where we've.
Okay, so ARM is trending. Look forward to pull back for entries like we did this morning. In the second hour, watching ARM Holdings. Upper Bollinger Band is resistance, 140. I don't think we get above that. Asset entities. Sorry, that just dropped below the 20 EMA. AST Space Mobile. Watch for a bounce here at 92, 93. If it gets back, if it continues to move higher, put a stop underneath 92. Look for a break above 97, 98. BWX Technologies, I believe they're out of London. Or out of England, I should say. Centuri Holdings, starting a new trend after a downtrend. Centuri, let's see what that looks like on the daily. Yeah, it looks good. Centuri CTRI. This is a 60-minute 20 EMA scan for crossover. CTRI. DraftKings looking better. DraftKings. Higher lows, higher highs. DraftKings DKNG.
Israeli strategy against Iran is working. Here is why. And one of the things mentioned in there is precisely the succession. You know, my understanding, this goes back a decade or so, correct me where I'm wrong, in Shia Islam is you don't want a line of succession. That was part of the dispute with the Sunnis. And so by choosing a son instead of having the committee able to choose their next leader, that's actually a sign of weakness and not strength. And this is a regime that's kind of behaving as if it is anticipating its collapse, the way that there's a centralized plan to just spray, artillery around the Gulf and that kind of thing. What would you say to the idea that ultimately we may have more of an upper hand here than the consensus or than most of us can currently perceive?
Well, not being a scholar of Islam myself, I'm a little hesitant to disagree with the Al Jazeera analysis, except to say that this theocracy has spent 47 years entrenching itself into power. And fundamentally, it cares about power and about its vision of an Islamic republic that's a revolutionary state throughout the region, taking on the great Satan, taking on Israel, destabilizing neighbors it doesn't like. I think that agenda matters more to whoever's in power in Iran than whether or not some theoretical Islamic precept about avoiding dynastic succession kicks in. So count me as a skeptic on that argument at first blush, not claiming to have deep authority on the subject. And I just think that the
Federal Realty Investment Trust, that one looks pretty good. MACD stochastics turning.
could be partly right, but count me in as a skeptic on that as well, because the top layers of the regime were always people that Israel was trying to track, and it's not so much. It's partly through AI, but it's also through hacking closed-circuit television cameras near the Ayatollah's house. Things that were not necessarily rocket science. They were impressive. They took a lot of very good tradecraft in terms of human intelligence, but it was not some fancy new technology that's going to now be reproducible for every next
Golub Capital, GBDC.
has militias that are not uniform, that are not overly centralized, that have been
GBDC.
first command and control for at least a year and probably
Golub
longer than that. And so
Capital, looking pretty good. Volume. GBDC.
Unless we can put boots on the ground along the Iranian coast to make sure that we've kind
FRT more.
them from being able to disrupt its passage. Then the president says, I wonder what would happen if we, quote, finished off what's left of the Iranian terror state. The countries that
There's like 200,000 ISRG soldiers, so got to figure out how to deal with those people. Can't just let them go. LPTH, LPTH.
where things seem to be going well, and then the presumption that somehow the politics of that region would work in their favor because anything was better than Saddam. We've been through this kind of thinking before. I realize Mr. Trump is not threatening a ground invasion or occupation.
Midcap Financial Investment Corporation, MFIC.
There were people in the George W. Bush administration who sort of favored the chaos theory. Just go in with a light touch of this.
Okay.
And maybe they feel vindicated in the aftermath, but President Bush and others thought that was
Nutanix, NTNX. Let's see what that looks like. NTNX, NTNX.
They were not consulted on this war, and the idea that they're going to fall in the minute that Mr. Trump demands they do so is a little unrealistic, but I believe over time they may want to help us because they do need the oil and gas themselves, and they are our ally, and they know that the Iranian regime that we attacked was not a good regime. So if we give some time for emotions to subside, for new strategic realities to set in, we may
Unipath, PATH, also looking good. PATH. PATH.
Yeah, that's a good point. And we should assume it's going to be a cakewalk to get ashore. And even once we're ashore, we're within drone and missile range. So the idea of going to that step, or as you mentioned earlier, trying to
Path looking pretty good here. PATH making higher lows.
fast boats and other things that could deploy mines or drones, these are daunting propositions that take us to a much higher level of risk than we're at right now.
All right. Michael, for now, thanks. Really appreciate it. Michael Hamlin of Brookings. Coming up, we'll pivot and talk some housing. The stocks are under pressure in March. LGI, TopBuild, Lennar, Masco, DR Horton, all having their worst month in over a year as we see rates back on the rise. And look at the latest numbers, what that means for mortgage demand. As you can guess, it's not great. We have the full details after the break.
All right, Path looking good. Let's see, 60 minute. 60 minute. 20 EMA. Nope. 20 EMA.
CGTL.
NET.
Welcome back as we see the market selling off today, largely after that stronger than expected PPI report, but also as developments in the Middle East have the oil price on the rise again. The Dow is near session lows, down 453 points. That's about a 1% drop. And you can see their pressure across the other major averages as well, about half an hour until we hear from the Fed. And keep an eye on Micron, hitting another all-time high, despite
Micron with earnings tonight.
ahead of its earnings later today, an all-time high today. The options market is pricing in an 8% move once it does report after the bell. The shares, of course, are 63% this year. Some say this is more important than NVIDIA when it comes to the next phase of this market move. And we'll hear from the CEO tomorrow morning on Squawk on the Street around 9 a.m. Eastern time. So again, the whole AI trade, really, a lot of this hangs on what Micron says after the bell. I think Jim Cramer's line earlier on was they better triple the numbers that people are expecting. Meantime, Williams-Sonoma is among the S&P leaders after reporting strong earnings and comps. Revenue missed estimates, but they are hiking the dividend by 15%.
Okay, so path looks good.
Saying they continue to gain market share, and that has WSM up 5%.
All right, what
The
else?
builders are struggling to post a fourth straight day of
Science
gains.
Applications International,
9-day losing streak to start the month.
TG Therapeutics, TGTX, Uber.
Well, Kelly, mortgage rates last week jumped to the highest
Uber trying to get above the 50-day.
year, and that hit refinance demand hard. Last week, the average rate on the 30-year fix for conforming loans with 20% down jumped from 6.19% to 6.3%. That's on the Mortgage Bankers Index. As a result, applications to refi a home loan plunged 19%.
Zito Express, ZTO.
9% higher than the same week a year ago when rates were 42 basis points lower, but that annual gap is shrinking fast. Now, applications for a mortgage to buy a home did manage to eke out a 1% gain for the week and were 12% higher than the same week 1 year ago. Mortgage rates did come down from Friday's high to start this week, according to a separate survey from Mortgage News Daily, but they did pop a tiny bit higher this morning following that hotter than expected PPI report. You can see, though, they are still significantly higher than they were just at the start of this month. Not a great look for the all-important spring housing market, which officially begins Friday. There is slightly more inventory than last year, but home prices are still higher nationally, and consumer sentiment in both housing and the economy is weakening. Kelly?
S&P still drifting lower.
Angelica Peebles now for the CNBC News Update. Hi, Angelica.
Hey, Kelly. GOP Senator Markwayne Mullin testified today in his confirmation hearing to lead Homeland Security that he would require judicial warrants for
Lower highs, lower lows.
homes and businesses.
Pulling away to the downside on VWAP. If you're bullish, you need to see this bounce. We got to break this downtrend. Got to break the trend that started last week. Up on Monday, Tuesday, down on Wednesday, Thursday, Friday. The 200 days down below, so I'm completely expecting a test of that. This will be the second time that looked like we're going to test it in the last week or so.
Natural gas imports for much of its power generation. And the country says its energy import bill has more than tripled since the war began to now more than $1.6 billion a month. And the trust responsible for paying restitution to the creditors in the collapse of crypto exchange SPX announcing it will distribute about $2.2 billion on March 31st. It's the fourth such distribution since the company collapsed, and founder Sam Bankman-Fried was convicted of fraud. Kelly, back over to you.
All right, Angelica, thank you very much. Coming up, the chip makers are trying to get back above their 50-day moving average. Sign of weakness, or is upside momentum building in the space? We'll check on those charts right after the break.
Okay. We got 2 hours and 26 minutes to go. 2 hours and 26 minutes. I'm your host, Cousin Vinny, coming to you from theclosingprint.com. It is Wednesday, March 18th. More of the same kind of price action that we've been seeing recently. Not able to get back above VWAP, trending lower during the day. Expect more of the same.
really looking at being data dependent, looking at what's happening in the rearview mirror. And honestly, as markets start to change, as we start to see, inflation, growth, the labor market, all those things happening on a forward-going basis, you're going to need someone who's in there who can forge consensus around where things are headed. So, clearly, different Fed governors are going to have different models, different ways of predicting the future, and everyone's going to have their own way of going about it. You've got someone who's very practical, been in the markets a long time, as Rick has. If you can get the respect of the fellow economists and other people that are on the Fed governor board, it would be great to see something that's a little bit more forward-looking and less data-dependent, month to month, quarter to quarter, because clearly, everything goes in a straight line until it doesn't. And I think we're heading to those periods where we're going to see some discontinuities.
Well, it's interesting, and I make this clear, is that the Fed chair is the Fed chair, but the Fed chair does not make the final decision. It is very much a committee vote, and it's a majority vote. And I think right now we're about halfway through. There's like half the committee is in this camp that rates are fine where they are at the moment, and the other half might be willing to have a conversation. So it's going to be interesting to see whether or not whoever it is, Rick Reeder, Kevin Warsh, whoever, is able to form that consensus, because it's got to be a consensus vote. It's got to be a majority vote. I'm in this camp that I don't think, though, that rates should be cut any further at the moment. I don't know where you stand. I'm kind of curious what you think, where you think rates are going to be, or whether or not you even think they need to be cut now or in the foreseeable.
Yeah, absolutely. When inflation was up around 9%, clearly rates had to be higher. Now that inflation's come back down, rates clearly didn't need to be left at the high levels that they were. I think they're right around where they need to be. You could do a little bit of fine tuning, maybe take one or two more rate cuts. Ultimately, you want to have those rates slightly above inflation. So if your overnight rates around 3 3/4, bring it down to 3 1/4. As long as that maintains a level above the current rate of inflation, you're right about where you need to be. I think what's more important going forward is where's the economy at? Is the labor market going to soften? Do we need to have
Just off session lows, the stocks look to be snapping a two-day win streak, but a lot still to happen. We're about to hear from the Fed, and the S&P and NASDAQ are still higher on the week. My next guest is considering taking some risk off the table. Jonathan Krinsky is Chief Market Technician at BTIG. Jonathan, good to see you. Are we in the red for all the major averages now for the year? The Russell as well?
I don't know offhand, but yeah, we're definitely weakening, I would say, making lower highs, lower lows over the last couple weeks, and we're coming into some pretty key levels for the major averages.
Let's talk about those key levels. What are you watching?
So for the S&P 500, we've been trading below the 20-day and 50-day moving averages, which are now inflecting lower. So those come in around 6,800, 6,870. So we've really been saying you need to get some closures above those short-term levels to regain that kind of short-term upside momentum. But barring that, we're kind of keying on the 6,550, 6,600 level in the S&P 500. That's kind of the November lows and the 200-day moving average. Yeah. And if you were to lose that after, what we would call a pretty decent period of distribution, that would suggest a potential breakdown towards the 6,000 level for the S&P. And I think when you take a step back, it's
S&P in a downtrend, expect rejection overhead. If for some reason it's broke to the upside, that would be highly unusual and something worth note. Hedge flows, believe it or not, continue to move higher. So what that's suggesting is that they're selling premium. They're selling puts down below. Let's take a look at the S&P. Pretty much all day they've been selling puts. Netflix turning back up.
Yeah, so tactically, coming into March, we thought the Middle East escalation was, like we've seen a lot of other periods, just very short-lived, kind of quick blip, and that would mean energy markets would revert back lower. But clearly, we've seen a sustained bid in the commodities. Gasoline futures actually hit a new cycle high today, and those energy stocks, which we also thought, initially were just kind of poised to hold back, have kind of held held those gains and continue to push higher. So I do think, the trend in energy clearly is more than just a little blip at this point. And then back to your other point about the semis, look, semis are the strongest part of the market.
You can see when this flow alert came off right here. This flow alert. Right there, that flow alert came and the calls started getting bought. Calls started getting bought right there. Good point. Good point. Need to see Micron deliver a good number. Fake laugh. Palantir, Doji Day. So this is day 10 for Palantir. All right, there's Micron. Palantir, PLTR. It's been consolidating at the highs for 10 days. Okay, 2 weeks tight. There is a pattern called a 3 weeks tight pattern. In this case, we'd be looking for it to break to the upside. So price action will stay in a tight pattern for 3 weeks, hence the name. Looking for it to break to the upside. RSI flatten at the moment. MACD stochastic, Palantir. So be watching Palantir for some more follow through potentially into Friday. Netflix is still looking pretty good here. Netflix. Okay, consolidating. Turning back up. Netflix turning back up. Okay, it's got the average target for some of these tier 1 firms is $115. $115. All right. All right, we see some more puts being sold. S&P, more puts being sold.
Egypt doing 9 p.m. curfews. Pippa, what does it all mean for international demand? That's right, Kelly. So we do follow Brent WTI so closely because they are the international and U.S. benchmarks with a lot of liquidity. But to show the extent of the current disruption, it's helpful to look at Middle East crudes. Both Dubai and Oman blend have now surged and are trading at over $150 on the spot market. That's according to Platts. Significant
significantly above Brent around 103 and WTI at 96. That's as of yesterday. And these prices are helpful to look at because it's not a market of speculators. These spot prices are for true buyers and sellers of crude. And CIBC Private Wealth's Rebecca Babin said that this is a clear warning sign from the physical market. Dubai is acting as a leading indicator of where broader prices could move if disruptions persist and inventory draws start to spread globally rather than remaining regionally constrained. On the product side, heating oil future is adding another 5% today as diesel prices in the U.S. top $5 per gallon for the first time since 2022. Jet fuel prices hitting records. The Middle East accounts for about 6 million barrels per day of refined product exports, and Asian refiners now don't have access to the usual flow of oil from the region, further tightening markets. And as you said, Kelly, Egypt now, cutting their electricity use, showing the real world impacts of these price surges.
And $3.84 at the pump here. And you mentioned earlier on that we had some pipeline inflation kind of going into this. Do you think now are we just tracking with the price of WTI pretty much? Or I hope we're not tracking with the price of Middle Eastern crude.
Definitely not with Middle Eastern crude, given that we do refine a lot of the gasoline that we use in the U.S., although we do import gasoline on both the East and West Coasts. But I think the trend higher is just certainly higher, but maybe a slower move higher. We had that initial surge from that backup that we had to get with to match up with RBOB futures. But Kelly, prices are not going down here. So while there aren't as wild swings, the trend is certainly higher. And $4 is within range now.
Okay. Pippa, thanks. Appreciate it. Pippa Stevens coming up. Staples are the worst performing sector today as oil and rates are elevated. Inflation is sticky and ag prices are climbing with the Strait of Hormuz more or less closed. Bank of America sees, quote, material upside risk to grain prices in its base case for the Iran conflict. We'll talk about the impact on grocery bills after the break.
Okay.
SCO. RCAT.
Whether that's tech names, higher data, things that we think will have a higher return, but potentially have more volatility versus other parts of your portfolio, whether that's dividend-paying stocks, more high-quality bonds, even treasuries in some cases. To the extent that your portfolio can ride out the volatility, and you will see those higher quality, lower volatility components of your portfolio maintain their value, or in some cases increase in value. That's really your source of funds. So it really all comes back to what are the liquidity needs of your client, how high a risk tolerance they have, and most importantly, what's their time horizon? Because all of those factors together will help you determine what portfolio makes sense for that individual client. And it is during those times of volatility, if you can avoid from selling those parts of your portfolio which are moving down much more quickly in the market, and those are hopefully also the parts of your portfolio that will grow the quickest over longer periods of time, that's really make volatility your friend, as opposed to be in a situation like we talked about before, where people are selling some of those really good names because their portfolio's just gotten too risky.
Right. Talk to me about SPINs. What do you think about the SPINs this season, right? Small and big cap, right? Otherwise known as the SPINs.
Yeah, so I think we talked so much about large cap stocks, and you mentioned a number of the mega cap stocks, and they're all household names that blue chip stocks. Small and medium sized companies, I think, are an important part of people's portfolio. As you'd expect, it should be a smaller portion of your portfolio, and really, how much you allocate to either small and mid caps, whether it's 5, 10, 20%, really will depend on your own risk tolerance and again your time horizon. But I do think if we look through the cycle, if you look at small and mid-cap stocks, they have gotten very inexpensive versus large-cap stocks. Typically, there is a discount, but that discount has gotten pretty wide. But I think it makes sense at this point in the cycle, especially seeing what the S&P has done. S&P is trading at 22.1 times earnings. Typically, it's around 17.1 if you look at the 30-year average. So it's 29% more than it typically is. So small and mid-caps, when used in the
S&P
proportion, are a great way to diversify.
trying to get back up to that trend line, probably gets rejected here. It's in a downtrend.
Welcome back. About 10 minutes from the Fed decision, and here on the exchange, we've been following not just the rise in oil
Netflix looking for more upside. There goes NVIDIA.
The futures have soared 30%, and they're sitting near record highs.
NVIDIA catching a bid. Microsoft,
both fuel and fertilizer could mean 20 to 30% upside in
Netflix,
15 to 20% in wheat. That's the base case now. Let's bring in Peter Galbo, talk about what that means for the
Lulu. What's Lulu doing? Lulu. Lulu. Lulu hanging out at the highs. SWMR.
At the same time, we have a strike at a meat packing plant. At the same time, you're telling me that corn and wheat prices could go up 20%. At the same time that my delivery service just emailed and said the price of yogurt is going up 33%. So I'm like, what is there a common thread behind all of this?
Yeah, hey Kelly, I don't want a common thread of all of those factors. I think
Netflix. Sounds like the tariff conversation all over again. In this case, oil and the Iran conflict is the topic.
think about what corn goes into as a feed cost for things like meat, particularly in chicken, and so that's probably where you're going to see it show up first. If in actuality, that's kind of what ends up flowing through.
So in other words, when you say that corn prices could go up 20%, you're also saying that chicken prices could too.
Typically what happens in an instance when corn prices go up is that the chicken producers will pull back, that the economics are not as favorable on a per chicken basis, and so you see supply start to get constrained, and that's when you can see an increase in price, basically to compensate for the increase in feed costs. And there's a little bit of switching they can do between things like corn and soybean, right? And we have a plethora of soybean as well, so that can help offset some of it. That's typically how you see the flow through on the protein side.
Back in 2022, 2021, the whole COVID era, we had tons of liquidity sloshing around, and all the price hikes were passed right on along to consumers who paid them and are still stunned by the numbers they're seeing. This time around is a little different, as I understand it. How much of these price increases do you think are going to be passed along, and how much is going to fall on the companies to take it out of their profit margin?
Well, yeah, Kelly, think about the number of companies that are talking about price investments, and we've just gone through that cycle over the past few months of some of the largest food companies talking about having to actually reduce prices. So are they really about to go out to consumers, roll prices back, and then kind of come back a month later and say, hey, actually, we have to come back? They've worked too hard to try and get their price points in the right spot, I think, to do that, kind of suddenly.
That's great news. I mean, it's not great news. This might explain why the consumer staple stocks have been under such pressure, Peter. But what you're saying is that the consumer staples companies have been focused actually on decreasing price. We've seen this with Pepsi and these other companies talking about price cuts for the first time in years now. And now they're being hit by a supply chain issue. So they're saying, we're just going to eat that, basically?
Probably still too early to tell, but I think if you look at what happened in 21, 22, 23, Kelly, you had the confluence of exiting COVID, kind of stock up demand, and then you had an inflation super cycle in terms of grain costs moving up. It's a different scenario this time around. Again, we'll see. It's a little bit different than Ukraine. Again, Ukraine was a really big exporter of grains, and it still is a very big exporter of grains, and so that's what threw the grain markets kind of into haywire at that point. With this conflict, yes, there are derivative effects and things.
All right, S&P is trying to do something.
But it's probably not as powerful.
Hedge flows continue to rise. Why is it doing that? Because they're selling premium down below the 200-day. Looks like. So long as they're selling premium, it'll create positive gamma. We're seeing some call buying as well. Not sure why the markets aren't responding in kind, but anyway. Sprout Farmers Market, nice 20 EMA trend. Ran a scan a few minutes ago. Let's see, it should show up now. Huh. Where'd it go? Where did it go? Let's see. Interesting. Let's look at the IBD 50 that they had for this week. BD50. A lot of these stocks failing. ANAB trending. Arch Rock. Let me do a chart list, candle glance view. See what's trending. All right. So DocuSign, no, DOCN, DigitalOcean. Big move on DigitalOcean, DOCN. Wow, nice move. Anyone in that one? DigitalOcean? Two p.m. All right, we're looking for Jay Powell. Yeah, nice job. You're in that one, Frano? Oh, you're not in it? Okay, cool.
And welcome to Power Lunch. I'm Kelly Evans alongside Dom Chu this afternoon, who is in for Brian Sullivan, as we are just about 4 minutes away from the Federal Reserve's decision, its next move on interest rates. The odds of a rate cut are less than 1%. The market is basically expecting no action this meeting, but the path of future cuts will certainly be in focus. And it's Chair Powell's penultimate Dom press conference as head of the Fed. Ahead of it, here's how your money and markets are setting up. Scores on the doors, maybe they would call this. The Dow is down 442. The S&P is down 42. The Nasdaq's down 138, and the small caps are down 15. Bond yields, the last check was about 422 on the 10-year and 371 Dom on the 2-year.
All right, of course, the big mover, Kelly, these days has to be in the oil markets right now. U.S. benchmark, West Texas Intermediate, WTI prices, you can see $96.52. It's up 1/3 of 1%, by the way, and that is way off the session highs at this point right now. World benchmark Brent crude went as high as $109.95, on pace for its highest settle since July of 2022. Both are up roughly 50% since the conflict in Iran began. So keep an eye on those oil prices. The U.S. dollar, by the way, up fractionally today, just about 1/4 of 1%, trading just below that psychologically important 100 level. The greenback strengthening against major
VOO. Okay.
and the latest read on the AI trade, by the way. Let's go microeconomic here. Micron reports quarterly results after the closing bell. Shares hit a record intraday high just today. They've soared more than 350% in the last year as the supply shortage pushes memory prices higher. So this is where we begin.
Mention that the Micron app. If you had to go,
Thank you, David.
Micron would be up there.
It would be, because it would set the narrative. We kind of know.
See RSP, RSPCT.
We do not yet know if that AI trade still has legs, and if Micron tells that tale, it could be big. Well, let's get right to the all-star panel we have assembled as we
RSP.
are just minutes away from that Fed decision.
Doesn't look like the end of the world here. RSP, Doji. All right, we got the Fed coming up.
Thank you all for being here right now. I'll start with a bigger question right now first for David, because I'm staring right across the table at you. The Fed is not expected to do anything. Should it do something?
No, I think.
Yeah, I don't think the Fed should do anything either.
Where we are right now, I think there's a lot of uncertainty. I think what Jay Powell's going to talk about is uncertainty of both sides of the mandate. The thing that I'm going to be looking at mostly is what do they think inflation is going to be like this year? Because they're going to have to put some number down there. We're going to get their economic forecasts. So will they actually raise that from 2.4% at the end of the year? Will they pull it back?
Okay, here goes the S&P starting to go. S&P.
Commentary is key. So many people have already said it on our air today. People all over Wall Street are saying it. What kind of commentary would you be looking for?
So for me, I'm going to focus on their growth outlook, right? So inflation, we know it could be a transitory shock. We have a temporary, potentially temporary spike in oil. Ultimately, what is this? When does this
Okay, Microsoft turning. Microsoft turning.
from an inflation shock into a growth shock? I want to hear what the Fed has to say about that. So I'm going to be really focused on what their growth numbers are and
Here goes Meta.
And Sarah, the risks out there are
Apple turning.
are the geopolitical ones. But some of the other ones around the macroeconomic story in the US here are nuanced because of the many factors affecting it right now. What's going to be the most important thing that the Fed has to watch for in your mind vis-a-vis all of those externalities being brought to bear?
Well, we're going to be watching the developments from geopolitical issues with the war going on. In their summary of economic projections, I'll be watching for whether they're going to upgrade their view on inflation, downgrade their view on the economy, given that fourth quarter GDP came in sub 1%, and what are their views on the employment market. Now, the bulls and the dovish members on the Fed are going to say inflation's here today, but slower economic growth is here tomorrow. We can still get
Okay.
rate cuts into the books later this year. Markets
All right, Fed.
predicting only 86% chance of one rate cut in December 2026. Of course, the hawks on the Fed are going to say that inflation is now here and it's chronic, and we can't cut rates or maybe even raise rates sometime this year.
I don't know if we can show this in the next 5 seconds. Kalshi's odds for the next Fed.
The Fed.
60% before 2028, 37 before 27. Steve Leisman has the decision. Hi, Steve.
Unchanged. Federal Reserve leaving interest rates unchanged in a range of 3.5 to 3.75.
Okay.
It was an 11-1 vote with Fed Governor Steve Myron again dissenting, preferring to cut rates by 1/4 point. The Fed saying very up high in its statement today that the implications of developments in the Middle East for the U.S. economy are uncertain. But other than that, pretty robust or actually positive economic outlook. It continues to say, as it did last time, that the economy or the economic activity is moving at a solid pace. Say job gains have been low, but the unemployment rate.
All right, so S&P. There goes ABCD pattern on Netflix.
And one cut for next year, another additional cut for next year at 3.1%. The long run, something that's been ticking up over time. The long run neutral rate is now see at 3.1. That is up a tenth. On inflation, the median Fed official now looking for 2.7 on headline inflation. That's from 2.4.
Netflix.
Going back down to 2.2% in 2027. On core, looking for 2.7, up from 2.5, so 2/10 added there. Interestingly, GDP actually taking a tick up to 2.4 from 2.3 and 2.3 from 2% in 2027. So not seeing much of a GDP hit from the higher inflation forecast that is now part of the outlook. As for the dots, 7 officials want to hold, 12 want to cut.
Okay, NVIDIA going. NVIDIA's going.
5 of those want 2 cuts or more. The old range, guys, was a funds rate from, if you take all 19, the bottom was 2.1, the top was 3.9. It's come in a little tighter. Now it's 2.6 to 3.6. So a little bit of give on the dovish side, a little bit of give on the hawkish side, and now you have a little bit more centered around this 2.6 to 3.6 area. But again, the Federal Reserve emphasizing uncertainty. Interestingly, I would point out the idea that they up their inflation forecast. But also
Okay, we had a little pop there on the futures, turning back down now. S&P. S&P hit VWAP as anticipated. We did get the VWAP. Are we going to follow through or not?
Markets that are relatively stable right now, maybe not unexpected. We're all waiting for the press conference. Let's get up to Chicago for the reaction in the bond markets right now. Rick Santelli has that story, Rick.
Yes, Dom. If we look at all the intraday moves, $2 index, what jumps out at me right off the bat is that the fixed income markets, 2s, 10s, the whole curve, we started to see yields drop even before anything was read and straight up to
RSP.
So investors were buying treasuries in front of the statement, and after the statement, it had just a minor follow through. We're at 370 in a 2-year before anything was read. We're 269 now. We're at 421 in a 10-year, exactly the same. So you're correct. Not a lot of movement in the markets. But let's put a face on this. If we look at where we've been, on the 12th of this month, we saw 2-year yields at 3.74. The high yield close going back to August of 25. And if you looked at 10 on the 13th, they had 427, a high yield close for the move post-conflict. But they couldn't even take out their 429 high yield close earlier in the year in January. So really what we're seeing here is the 2-year yield seem most sensitive to the notion that we're not going to potentially get any more rate cuts.
Netflix, S&P. Let's see what happens on the S&P. Netflix looks good. Netflix. Hedge flow still going.
We hit 100.36 on the 13th. That was the high watermark all the way to May of 25. So to summarize, listen, the conflict is an awful thing from a humanity standpoint. From the market standpoint, especially treasuries, it's been mostly well behaved. Obviously, higher interest rates, but maybe the poster child for how it's dealt with this is that the 10-year couldn't even get a higher yield close than pre-conflict, and of course the dollar index. I'm not sure it's a flight to safety. I think it's more a function of the ECB. We're talking about our central bank. ECB tomorrow, most likely they're going to be looking at aggressive tightening because the energy situation outside of the U.S., whether Europe or Asia, is changing all the dynamics on potential inflation and central bank activity. Back to you.
Thank you, Rich. Just want to turn to the panel here, David, for some reaction. It's amazing. The statement, this is almost the most unchanged I've seen a pair of statements. The January to March one had virtually no change whatsoever, despite saying the situation in the Middle East is uncertain.
Well, yeah, because the uncertainty is on both sides. I mean, they've changed their growth forecast, they've changed their inflation forecast. I'm not surprised by what they've done here, but I do think there are two things. One, I think both numbers are now too high. I actually think that if we get some sort of stabilization in Iran, I think we're going to have to, in the course of a few weeks, and then oil flows, and then I think inflation by the end of this year will be below 2.7. But I also think that it is ambitious to say that we're going to be over 2% growth next year if we don't have any further fiscal stimulus. And you've got this, this very tight labor market. The working age population is actually falling. I do believe in a huge amount of AI productivity if you're going to get over 2% growth next year. So my guess is that eventually they pull both those numbers down, and that doesn't change rates outlook that much for this year. But maybe next year we do get some rate cuts if we go into next year with both growth and inflation falling below 2%.
Cutting, I look at the price index. It's almost like, why do I bother looking? Does it matter? I'll let you jump in here, Jim. But you have a PCE that has gone from like 2.2 to 2.8 over the past 18 months while the Fed's been lowering rates. We're looking at 3% plus for CPI. We were at 3.1 for core PCE last month. Does it matter? I mean, I'm sort of like, if we're just ignoring all of this because there are downside risks to the economy, I'm struggling to kind of bring this all together.
So the way I look at this is, what's the read through to asset prices? So the question I asked before the meeting was, what's the Fed's view on an inflation shock? The Fed just upgraded their view on growth. So what they're telling you is that this is a price shock right now, but it doesn't necessarily translate into a valuation shock because growth is still based on what they're saying. And now, why did they say that? Is it because we had relatively strong momentum coming in, and now we're in the middle of some type of a speed bump? And then do we get back on course? And I think that's my look through in this. As I think about what the Fed has just said and what they've done with their upgrading and growth, is that they're telling you that valuations are going to be okay as long as growth stays relatively stable. That tells me as an investor that as we see a potential drawdown in markets, this might be an opportunity to buy once we get through this, providing the Fed's correct. Now,
all right, let's see. We're still hovering here.
A price shock, temporary, versus a valuation shock, which has more permanent.
He said this is a one-off. The oil price shock.
Netflix looking good. Nvidia having a good day. Off the low, Nvidia. Still got to get above this level, the 50-day. Nvidia. We'll see what they say. Conference at 2:30.
There are special factors that are causing inflation to be high right now. But what I think the Fed learned from 2022 is it was actually transitory. 9% inflation didn't hang around, and this inflation won't hang around either after you get past oil and fiscal fiscal stimulus. So they need some confidence in that, but eventually they're not that scared.
9% inflation was in June of 22, which is the month they started hiking by 75. You don't think that kind of
Throttled it back.
Yeah.
No, because it didn't slow the economy. I mean, the transmission mechanism for rates, there's only one way they can kill inflation, that's by killing the economy. If they didn't kill the economy, then inflation fell, but they had the perfect alibi. It wasn't us, because we didn't kill the economy.
All right, so speaking of transmission mechanisms, I just want to bring one thing in here because the asset prices Jim talked about is something. Tim, I know you watch it because Innovator manages these funds and ETFs. Tim, I want to bring you into the discussion here. Has there been anything surprising with regard to what's been happening in your mind geopolitically in the markets, vis-a-vis oil, vis-a-vis rates, the Fed? The market seems to be taking it all in stride in a very orderly fashion, even if there has been a move lower from the record highs.
Well, Dom, I think we need to be cautious here of higher rates and how we're managing our portfolios. If you look across markets, you look at the oil futures curve, it's very clear the market is pricing this conflict in as temporary. We think that is our base case as well, but we also want to be careful because the reality of it is the longer oil prices stay at these elevated levels, the more of a chance we have where inflation becomes sticky. And that's not what we want to see. So we really want to be cautious about how we're managing portfolios right now, making sure we're preparing them for that threat of higher interest rates, the typical defensive playbook, whether you look at long duration bonds, defensive sectors. We don't think that works in this environment. So you have to be looking at other things. We think shortening duration on the bond allocation makes a lot of sense, shifting up in quality with our equity allocation, and then looking to more reliable alternatives like dual directional ETFs that give us the ability to generate a positive total return even if the market continues to sell off. We're seeing a lot of advisors implement that trade right now. We think it makes a lot of sense at this point.
Steve Leisman, standing by down at the Fed. Steve, you want to jump in here?
Yeah, I want to tell you a story, Kelly, and I want to see if you believe this story.
All right, Netflix, NVIDIA, pull them back in.
Powell's going to leave his last meeting in April, 98% chance.
All right, profit taking.
You get to June, ostensibly Kevin Warsh is the chair, 84% chance, no cut. A little bit of the summer goes by, you get to the end of July, 69% chance, no cut. Get to September, you come back from Jackson Hole, 54% chance, no cut. It's not until you get to October and December of next year that you start getting an odds-on bet of a rate cut. That's the story the futures market's telling. I'm not sure I'm buying it. I guess it was David Kelly talking about the idea that maybe the market is a little too hawkish on the Fed. I think that might be right. If everything remains the same, I don't think it happens.
Song remains the same.
A surge in oil prices, I think somewhere along the way, the market is a little bit too hawkish on the outlook for the Fed. I'm not buying that story.
Okay, so I got a question then for Sarah about that. I would like to know, given what Steve just said, Sarah, in your thoughts, how much of that future
Micron tonight.
That mechanism, the trading
Micron tonight.
is reflecting a handicapping of just how long the conflict in Iran goes for and what the lingering effects are. There has to be some kind of at least influence of what that's going to do to the rate picture over the course of the next 2, 3, 5, 6 months.
Well, that's the key question for the markets, because the longer that the war continues and the higher that oil prices stay, the more chronic inflation will become. What we've already seen with today's PPI numbers and recent inflation numbers is that disinflation has stalled. So we're not in an environment where disinflation is continuing, and now we have to worry about, is current oil-generated inflation going to be a one-time bump to markets, or is it going to cause a serious economic slowdown? Now, our view is still that you can maybe get 2 cuts later this year because the economy will slow if the war ends in a reasonably timely manner and oil doesn't stay above something like $120 a barrel for an extended period of time. Inflation will move behind us. So I think you can still get maybe 2 cuts this year and early cuts in 2027.
I want the good cuts, the kind where inflation comes down, not the bad cuts because we're losing, 92,000 jobs and so forth. Mike Santoli is down or with the NASDAQ, I should say. Mike, market response, and you heard what Steve just said there. He thinks this market may just be a little bit too hawkish about what goes on here with Fed policy for the rest of the year.
Yeah, obviously the market is going to get repriced according to where it thinks, headline PCE is likely to trend in the near term. I think that, the fact that we came into this period, even before...
I like Santoli. This guy's good.
With a kind of wait-and-see Fed. And so the market had absorbed this idea. We weren't looking for a quick inflection. I work under the premise in general that a Fed on hold is, all else being equal, a positive thing. because it means they're not responding to any particular emergency. Fed has cut 175 basis points in a year and a half. Maybe some of that still is acting as insulation. And if you look at the projections, look, the stock market can live with 5% nominal GDP growth if that's what we're going to get. I mean, that's your kind of working assumption. I think the question, maybe this will come out in the press conferences, the market probably doesn't have full confidence that these projections by the committee are kind of fully stress tested for all the different scenarios as we know them right now. They might seem a little bit based on a stale set of assumptions and inputs, because by the way, economic surprise index has been fine. A lot of the forward-looking indicators of growth look okay.
Yep.
And so, we're able to look past the one negative job month that we just got. So all of that mixed together, market doesn't see a lot to react to in the immediate term. I do think the market has to root for pretty good economic numbers, because if you're going to be pinned in place, if you're the Fed, by these higher inflation readings, you don't want that to happen. Deteriorating. And you have
I thought he was Irish.
case as to why the labor market is the way it is, right? You have to sort of know or think what the normal sort of maintenance level of job creation is in order to decide if we're falling short or not.
Jim, you're nodding and kind of looking at the same time to some of the comments we've heard. That implies, if you kind of put Mike's kind of comments in context, that means that we want to be in a regime where good news is good news and bad news is bad news, and not that good news is bad news and bad news is good news. If that makes any sense.
It does, and I think we have to take a step back and we have to look at the pricing here. So what do we know? If we believe the Fed funds futures curve, rates are just going to be a little bit higher than what we thought they were going to be in the past. What does that mean? It means that when you discount your future cash flows, you're going to get a different present value. You're going to get a lower present value. So effectively, what we're saying today is we're just having a repricing. I'm not seeing default risks meaningfully tick up in the credit markets. I'm not seeing earnings growth rates necessarily fall dramatically. Earnings growth rates are certainly earnings surprises.
All right, the S&P just pulled back.
So it's really
All right, so markets, I don't know. I just don't. The market's not doing what you would want to see.
There's not a really clear picture right now in terms of how it impacts valuations for assets.
All over the place. All over the place.
The signal to the market is that if we get through this, I don't know if it's a week, 2, 3 weeks, 4 weeks, whatever it is, this may be an opportunity to start to think about buying things on the cheap. Problem is, they really haven't cheapened all that much, and maybe that's a signal too.
David, jump in here.
Yeah, I think first of all, on the inflation issue, I mean, 21st century inflation is made out of Teflon. It won't stick. And it's going to.
So everything's transitory in this new regime.
Well, yeah, but it's transitory back to sort of a tourist kind of economy, which I think we'll see next year. I think we'll avoid recession this year, avoid a recession next year, but it's going to be slow growth with inflation coming back down. And I think the Fed will have an excuse to be allowed to cut because of low inflation rather than about any particular growth scare. I do recognize these job numbers are really weak, but the Fed should care about tightness, not strength. And this is a tight job market, but not a strong job market.
There's a striking difference between this decade and the 2010s, where right now we have this huge CapEx cycle.
Yeah.
Do we not? AI layered into and on top of that one big beautiful bill. Look at the scramble for physical resources everywhere. Look at the energy stocks. Look at materials. Look at the price of metals, the price of commodities. I feel like Iran is just on top of that, but that was already taking place. I'm just curious if you're right.
All right, back to this choppy market. All right, 230, 230.
So I really think that American workers and
Jay Powell will speak.
can't get a break and can't get a raise. That's the first thing. And the second thing is we are seeing significant productivity gains. Now, we don't know if that's AI or not, but American businesses are getting people to work more efficiently one way or the other, and that is an antidote to inflation.
You would say if we have, let's just call it 5% PPI. Let's just call it that for the year, just to take a number. You say if we have 5% productivity as well, then ultimately inflation will settle out to something in the I'm trying to put the math problem together here.
Absolutely.
And a Fed can say, we match high for high.
Yeah, productivity is what allows you to have strong real growth without inflation.
Yeah.
All right, Steve, let's get back to you. What else do we have now? Do we know?
Well, I disagree a little bit with David. I agree on the AI part. I think, though, that he's talking about a pre-2016 world in the sense that it's in that world that you could have a lot of global supply coming in and offsetting internal or domestic price pressures. But in a world of tariffs, there's less flexibility for global supply to address whatever deficits we may have on the goods side.
and address inflation. I would say this though. I think that what the key to me is whether or not Fed officials are seeing this oil price impulse as a negative thing for growth or for inflation. And if it's on the growth side, then it matters what happens to jobs, most importantly. If it's on the inflation side, it matters what happens to core and inflation expectations, as well as trying. See if that remains the case after Fed Chair Powell speaks.
Hey,
Go ahead, Don.
no, I was going to say, Sarah, I was going to go to you anyway. One of the things that Jim brought up was we haven't seen a massive or significant revaluation of certain types of assets out there. But one place we have seen a relative amount of revaluation has been in places like private credit, like places like high yield debt, where we have seen prices come significantly lower over the course of the past 2 to 3 weeks, vis-a-vis what happened to certain equity parts of the market. Should we be worried that maybe that high yield collateralized loan obligation private credit market is telling us something that the equity markets just aren't caught up to yet?
Well, it's something to watch. Now, first of all, in the private credit markets, that industry has evolved from fewer players to a whole lot of new players coming in. So this is part of the life cycle of an asset class over time. As more players have come in, they've had to go for lower deals, get into areas like software. So you do need to be aware and know what you own in private credit. If you're invested in areas where there's healthy exposure to software, given the AI risks, you could run into issues with that. But I don't think it's a painted brush across all of private credit, because when you look at the sector as a whole, it's still fairly stable and high quality. Now, second, turning to equities, why have equities actually performed so well or not as bad as we thought they would during this geopolitical crisis? What we've seen is the typical buying the dip. So many flows, over $100 billion about a week ago, coming to the market from retail, target date, foreign buyers.
All right. Not expecting much. Maybe we'll get some more movement after Jay Powell speaks. Right now, it's just markets just languishing down here at the low.
Look, I mean, I think we have a pretty broad spectrum here. So one of the things that we were looking at coming into this whole Iran event was the market was broadening. It was a cyclical broadening. So there's a lot more things to start to look at. It's not just about the Mag 7. However, the Mag 7 has actually done reasonably well over the past few days. So now we're starting to see some semblance of, well, if you were underweight, those Mag 7s, then, you didn't do so well over the past year, but you did, more recently. Now the cyclical broadening says that there are other things to buy. There are other quality places to go. So yes, you can be in investment grade credit. You can be in high quality bonds. You can also look for opportunities abroad outside of the U.S. into the European markets. There's a lot of different things that are going on, but I still think that the U.S. is going to come out of this the strongest, which is a little bit of a reversal. Because Europe did really well versus versus
at least the medium term.
Yeah, sure. Because of oil, right? Because the U.S. now exports.
All right. NVIDIA back down. Man, NVIDIA can't make up its mind what it wants to do. All right. Here's NVIDIA pulling back below VWAP. Doji now. It's a Doji on the daily. Doji daily. No follow through. More frustration. People getting frustrated.
It doesn't really work in terms of slowing inflation. No, the central bank should focus on keeping interest rates at a fairly stable, sensible, long-term level. They should deal with financial crises, and they should not try and micromanage an economy that they are clearly not capable of micromanaging.
Single versus dual mandates, by the way, also.
In Europe, absolutely. So that's they have to respond to that in the energy crisis. But I can only imagine they said, you know what? But we don't want them to make the mistake they've been making. Look how well their markets have been doing. Do you think it's over?
I don't think it's over necessarily, but I do think that on a relative basis, the U.S. can actually catch up pretty well because it exports energy. And rates are probably going to stay lower or more likely lower in the U.S. And I just think that the U.S. has a more competitive or comparative, maybe comparative advantage is the right way to say it, relative to Europe. And everybody's kind of gone the other way. So I think it might be an interesting opportunity.
All right. Thank you all. Really, really appreciate it. Rick Santelli, Mike Santoli, Jim Karen, Sarah Malik. We're going to keep a couple of you guys around. We're just a few moments away from Chair Powell's press conference that begins at 2:30 Eastern time. Before that happens, a quick break and some final thoughts going into it.
Yeah, it's been really frustrating trades. Break it down. Break it down. If you're frustrated, no surprise. Oh boy.
Welcome back to Power Lunch as we count down to the Fed Chair Powell's press conference. Starting in just a couple of minutes' time, we have David Kelly here on set with us from JP Morgan, Tim Urbanowitz of Innovator Capital, and we have a market guys near session lows. Don't want to make too much of it, David, but sometimes the first move is to tell, sometimes it's not. A lot of people are bracing for more hawkish commentary from the Fed chair. Do you think we're going to get that?
I think probably we will. In the sense that I think he's going to say, look, the economy really looks pretty good. All the indicators, no matter how low confidence is, the actual indicators of the movement of the economy looks pretty good. But I'll be really interested to see what he says about the tariff outlook, because they have to have some assumption here. And I think as you go from IEEPA tariffs, which were high, to now some sort of replacement tariffs, it's not even clear how much they're being implemented, something else down the road, it does look like the tariff fever is setting here. And if tariffs come down, that does improve the inflation outlook for next year.
You know, Tim, what do you see from your side with the markets either have it pretty right or pretty wrong?
Well, Don, prior to the war, we had this big capital rotation that was taking place. You had a shift into small caps, the S&P 500, equal weight, international. Those were all areas that were doing very well. And I think a lot of that had to do with the growth backdrop we saw and the idea that we were going to get Fed cuts in the back half of this year. Now, a lot of those have been priced out. That trade has been put on hold. We need those cuts to be priced back in to see that trade start working.
You think that's true, that they're that one for one? That's exactly what Jim Karen was talking about, that we would now lean towards U.S. instead of, Europe or international.
Well, I think there's two ways to think about it.
Yep.
One way we're looking at this is if you continue to see
The longer you try to trade this market, the more you're going to get chopped up.
index selling off 5-10%, that's an area we want to step in and start nibbling, start adding some more of that. Because the reality of it is, if this conflict does wrap up and it wraps up quickly, we start to see oil prices coming down. That backdrop is still very, very nice for stocks, and particularly those pockets of the market.
How did Trump put it? He'll drop like a rock? Didn't he say that yesterday?
Right.
From the White House?
We did have this one dissent from Governor Myron, and David Heath has talked a lot about how it's just, to use your word, transitory or one-offs. Like he talks about the portfolio management.
But that's right. But there's nothing wrong with an interest rate of 350 to 375. I mean, it's a myth to say that long-term interest rates or short-term interest rates are too high. The real problem we've got, home prices through the roof, is because rates were too low for too long. The Fed needs to set rates at an appropriate level. They're actually at an appropriate level. Leave them there, rather than try to then cause another artificial asset bubble in home prices by pushing rates down to zero
We
again.
heard this yesterday, this argument that they can't cut rates because it's just going to push up home prices. But what if the economy's, what if we are losing 92,000 jobs a month like we are now?
We're losing 20,000 people out of the working age population every month just because of demographics. So that if we change the immigration policy, we suddenly have millions of more immigrants coming in, then I'd be really worried about that. But right now, it's still a tight labor market. I don't think it's going to get any looser given the lack of labor supply.
All right, Tim, we got maybe just 30 seconds before we have to go, right? So your final thoughts here. What does the economy need to get for it to kick back up into real growth again?
Well, I think we want to start seeing those cuts priced back in. And I think it is going to be a hawkish pause today, but I think the market's going to look through that a little bit because they know we're getting Kevin Warsh here in July, and the tone's going to be much different.
All right, here we go. This is Fed Chair Jerome Powell.
Fed Chair is speaking now.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer.
IBM.
Job gains have
What's IBM doing? IBM.
A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wages, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. From last September through December, we lowered our policy rate 0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue
All right.
to work our jobs with objectivity
As you would expect, we dropped off.
to serve the American people. Thank you, and I look forward to your questions.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 4 years now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net, we didn't make progress. And if you look at total total core inflation, it's about 3%. And some big chunk of that, between 0.5 and 0.75, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the SEP, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? Just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions. And if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do.
NVIDIA, new low here, NVIDIA.
The forecast is
Apple, new low.
we'll be making progress.
Microsoft going back to the lows. Amazon at the lows. Everything is pulling back. There's just no one interested in buying. That's what it feels like to me. Momentum traders are playing stuff like Swarmer and a few other names. Micron with earnings tonight. I'm not trading Micron earnings. This thing's likely to blow up more than expected.
Is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen the progress that we had hoped for on core goods and on tariffs and on the rest of it. So for whatever reason people did write up their inflation forecast, that will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion?
All right, S&P making new lows now. Markets don't like what Powell is saying, basically. Either that or there's no buyers down here, so they keep pushing this lower. And we're below levels of support, below the 70, 67, 6,800 levels. So we're risk off at this point. Junk bonds. Junk bonds, it doesn't look that bad. It's just there's nobody there to buy, it looks like. Lack of interest. Yesterday I had a pretty decent day with still looks okay. Breath still looks okay. NASDAQ is kind of flat. We did pull back after a big move on Friday into today. So we had a 2-day rally.
Something quite different than that. We might have much lower than expected pass through. So people write down this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down, and so. We don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And also, what you've written down before you'll be reluctant to move too far away from that, just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs with little growth in either demand or supply. But the U.S. economy is doing, pretty well. It's just we don't know what the effects of this will be, and really no one does.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increases to domestic production. wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So your question was
what the staff is saying about, and has said in the past.
Yeah. So there'd be an offset.
Offsets, yeah.
So that's true. We have we're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period, but meaningfully higher. So I wouldn't say there's much of that happening. Not much will be happening now. Some of that could happen over time if you see that, but so the net of the oil shock will still be some downward pressure on spending and employment and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that having looked through tariff inflation and tariff inflation running above target and looking through the oil price shock would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully, but of course that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let color our decision making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be actually, and it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can cause trouble for inflation expectations, and so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%, and I think it's important that we do that. Very important.
Nick Tamboros, Wall Street Journal. Churchill, you described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay, so I would say that the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months a year to go through the system. And we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system so that goods inflation will return closer to what it's always been. I mean, it used to be, for many, many years, it was negative. And then, the year before tariffs came in, it was 0. And it's running at like 2% now. So, and so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks. And we feel like where we are now, which is kind of on that borderline, the higher borderline of restrictive versus not restrictive, we feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Labor non-housing services they basically moved sideways for a year. They're at the same level. We do expect that they will come down, but it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary. At the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services. But we're not seeing progress there. So we do, what we expect for next year is continued, what we want to see for this year rather, is continued progress on housing services. Finally seeing that, the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we like to see. But it's a good question why we didn't see much of that last year.
Thanks, Chip. Everyone is with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation CPI is close to 2%. PCE has ticked down.
Lulu after earnings, it's near the highs. Lulu's near the highs.
It's clear at all that one is more risk than the other. So you can point to the unemployment rate being.
Lulu having a pretty good day today. On the right.
For workers have come down very, very sharply over the course of the past year due to immigration policy.
IBM inside day, no follow through today. Looked good earlier.
And the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, you can. We're 3.0% for inflation, 2.8% headline. So we're well above the 2%. That amount, whatever it is, full percentage point above 2% for some time, and that's a concern. We need to get back down to 2%, and we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard pressed to say that one of them is obviously more risk than the other.
And if I may, what happens if there's no Federal Reserve Chairman confirmed on May 15th? Would you say?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet. And I will make that decision based on what I think is best for the institution.
NVIDIA making new lows. All right, the market's, there's no bid. There's no bid in the market. Likely won't be one until the 200-day.
Thank you very much. Claire Jones from the Financial Times. We've drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today? Thank you.
It's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of
disinflationary progress that we expect to see due to tariffs that I mentioned. I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story to a large part being a supply side story has changed, despite the quite negative number in February. Would that be the right take, and was there anyone else in the room who thought differently and that the February jobs report was cause for concern?
So I think you have to take the two together. You know, in a way,
NVIDIA dropping off rather dramatically here. There's just no bid in NVIDIA. NVIDIA dropping off. Headed back down to the 200-day.
So what do you see? Take a step back overall. There are a number of indicators that suggest a degree of stability, but the thing that I think a good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually,
yeah, I just don't see any reason for anybody to do anything until, you know. Yep.
Non-existent really growth in the labor force, which we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now that's balance, okay, but you know, I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So you know, we look at that, we see it, we get it, and I mean everybody understands the arithmetic, and that's you can say the break even is zero. But nonetheless, it's something we're watching carefully, and you know, are concerned about. But ultimately, though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there, and but nonetheless, something we watch carefully.
Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common, and does the central bank need to start taking account of the risk of supply shocks as a more common problem?
You know, we did go through a long period where the shocks were all demand shocks, and you know, so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years for sure. It's just a very different thing, and a very much more difficult thing, because it does immediately raise the question of tension between the two parts of our mandate. But you know, it has the world changed. I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And you know, the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But you know, people have written that paper and that speech a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that.
You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but you know, I guess, you know, what would you change about Fed communications if you had the time?
What happened about that was not much. And I'll tell you why. So, you know, we looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that I had some things that I wanted to do, but they didn't attract
broad support, and we already made all the changes.
Yeah, Paolo, it doesn't help. The refiner is leaving California.
We didn't, and I wish we had been able to do some things, but we didn't. So maybe the next year.
Yeah, I'm not buying until I see institutions.
Michael Keefer, Bloomberg Television and Radio. The minutes show in January, some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy warning would there be?
So it did come up today. The policy that the possibility rather that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case, and of course we don't take things off the table. But you correctly characterized what was in the minutes that several participants indicated something very much like that conversation did happen. What was your second question now?
Oh, that was just one question there, but follow-up would be, there are a lot of goods besides oil that are trapped in the Strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing, that kind of thing. The truth is, it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens.
People didn't really expect a rate cut, right?
The current situation lasts, and then what are the effects on prices, and then how do consumers react, and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
I wanted to ask you, you said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service and business.
Yeah, there's a lack of buyers, Jeff. A lack of people expecting at this point a test of the 200-day. Then we'll see what the institutions do. Do they buy? Do we overshoot it?
So at this meeting, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot. I understand well, but long-term expectations, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of the public,
NVIDIA, S&P 500.
pretty solid on longer-term inflation. A lot of conversation about that. I think everyone.
Oh boy, look at this market. Nobody's interested. Hedge flows turning down.
Discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most members are penciling a slowdown in any discussion of the risks of stagflation at this point.
So people actually wrote up their growth forecast by a tenth, and that's probably to do with confidence in productivity. But so sorry, and your second question was just
if there have been any discussions about the risk of stagflation scenario.
Yeah, so as I mentioned, there is tension between the two goals, right? The upward risk for inflation and downward risk for employment. So, and that puts us in a different situation. When we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index index was super high, add them together, get the misery index. And that's not the case right now. We actually have unemployment really close to longer run normal, and inflation that's 1 percentage point above that. So calling that stagflation, it's not. I would reserve the term stagflation for a much more serious set of circumstances. That is not the situation we're in. What we have is some tension between the goals, and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s, and I reserve stagflation for that, the word for that period. Maybe that's just me.
Thanks so much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends. Do you agree with that?
I don't have a forecast on that.
We're thinking about the impact on American households. As you know, they've been facing these higher prices for years. They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food now?
We don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time, and of course people will feel that, but I don't want to speculate about what that might mean, because honestly that would sound like I have some idea of what's actually going to happen, and I don't think anybody really does. We're going to see how this works out, and I just would leave it at that.
Hi, Victoria Guido with Politico. I just wanted to ask, for purposes of the next meeting, how the Middle East war develops between now and then, how are you thinking about what might guide action at your next meeting? I mean, if we have oil prices, above $100 a barrel the entire time until the next meeting, is that going to change your wait and see stance? Like, what would lead you all to move, or are you on hold pretty indefinitely?
We'll have to wait and see. We always say we're going to learn more by the next meeting, and usually we do, but in this case we're going to learn a lot, because we're going to learn 6 weeks to the day till the next meeting, and we're going to see whether what happens is it's going to be very important.
I don't know. I kind of like the guy. Kind of reminds me of a cool grandpa.
The way the outlook evolves with what happens in the Middle East, that's going to be a big factor, and we'll know that then. I don't know how it's going to affect our thinking. I really don't. And we did talk about alternative scenarios a little bit, but it's just, I wouldn't bring that in here. It's very uncertain, and I just want to remember that we don't know, and we shouldn't assume it's going to be one thing or another. We're going to see.
So is it a matter of you don't know how the situation itself is going to evolve, or even if things remain as they are, the economy can still remain relatively durable in face of them?
Yeah, that's true too. The U.S. economy has just, it's been strong through a whole bunch of challenges. I mean, if you go back,
All right, nice little bounce. S&P, nice bounce.
a lot in 22 and 23, and close to 100% of economists called for a recession, which didn't happen. In fact, 2023 was a really strong year.
S&P 500,
The U.S. economy has
S&P.
just doing pretty well through a lot of significant challenges over the past few years. It's been amazing to see. And I don't know what's going to happen in the next intermediate cycle.
S&P, you can see this RSI set up here. Nice change in direction.
Hi, Jamal. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court tariff decision, and it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So I suppose I'm curious, what would make you question this certainty that tariffs are going to be a one-time price effect?
Well, I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time increase in the price of a good, right? And what inflation is ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be, in theory, unless they cause people to start expecting still more tariffs the next year and still more tariffs the next year. They should be a classic one-time thing. People say the same thing traditionally about an energy price spike because traditionally prices go up and they come back down. And by the time monetary policy would react, it would be over. So I don't have tons of confidence on that. I mean, I think the theory is probably right, but as usual, the time it takes to get all the way through the economy is very uncertain. And we found that coming out of COVID. The inflation did go away, and largely for the reasons we thought it would, but it took 2 years longer than we thought. So I think we have to be humble about knowing how long it will take for tariffs to go all the way through the economy. And so what we've been doing, as our staff's been doing, it's very interesting. They started off with just an estimate because there wasn't a real history, and then they built based on the history that they're seeing of tariffs coming through in prices. They can now have an arc, and for all the tariffs, they can say, well, so we have, I think, a slightly more confidence that we will see tariff inflation coming down, not prices, but you won't see further increases, and we should start seeing that more and more in the middle parts of the year. We do expect that. And you're also right, though, that the level of tariffs came down fairly meaningfully in the wake of the court decision. But what the administration said they're going to get that rate right back up to where it was. So, and we assume that they'll do that over time. So that's how we think about it.
Okay, so poly markets looking at Micron's potential today.
You talked about the shortcomings of the SCP in this environment. I wanted to ask about, or throw in an additional thing, which is the fact that it is happening before transition. And if there's still some
Analysts expect a beat and raise. HBM capacity is already sold out.
The SEP is never, people are more than happy to change their SEP dots. They're not bound by them. It's your opinion at a moment in time, which can change based on events, sometimes very quickly. So it never locks people in. People are more than happy to be proven wrong in either direction. And so I just think we do it. And, I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think. But we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one, though, I think it's even more than usual. We're going to take the forecast with a grain of salt because it's subject to just very high levels of uncertainty.
Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that they're a big driver of overall economic activity?
I'm not sure what that's all about, but I'll tell you what I think and what we see in surveys, and that is, there were big price increases all around the world, by the way, everywhere in countries like the United States had basically the same kind of thing. It was a global inflation coming out of the pandemic, and everywhere people are feeling like real wages have been going up in the United States now for 3 years, roughly. But people are not feeling they're not feeling good about it yet, and it will take some years of positive, real earning gains for people to feel good again, we think. But you're right. When you talk to people, they do feel squeezed, and there are areas where prices are still going up, like insurance. Various different kinds of insurance are getting more and more expensive, and that's just catching up really from inflationary pressures that take a while to get into place. So we take it very seriously. We don't dismiss it at all. It's a very real thing from the standpoint of what people are experiencing, and what it does for us is, it makes us even more committed, if that's possible, to getting inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs, and stable prices is half of our mandates, one of our 2 mandates, the maximum employment being the other. I mean, look at every advanced economy that looks anything like the United States, anywhere in the world, in a market economy, in a democracy, and you'll see, pretty much central bank independence that looks a lot like, in some cases, stronger than what we have. But it's critical that we have that so that we can do the things when we need to do them to preserve price stability. And it's an accepted standard practice, and I think has a lot of support, certainly in Congress, which is where our oversight is in Congress. And you see that among Democrats and Republicans in the House and the Senate.
Hi, Chair Powell. Richard Escobedo, CBS News. Thanks for doing this. I have 2 questions. One, how high would oil prices and broader inflation have to go, and for how long, for the committee to consider hiking rates? And then secondly, diesel prices are rising faster than gas prices. How concerned are you that the increase in diesel might drive up food and goods prices and lead to broader inflation?
I'm not going to give you an example or a specific answer on the first question. We're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that might be. In terms of diesel prices. So your question there is, are we concerned about it? I mean,
how concerned, and whether or not it will drive up, the cost of food and other goods that really rely on it to.
It's a more general concern than that. It's diesel prices because that's transportation of food and things like that. There's lots of ways that oil and derivatives of oil get into the production and transportation of many, many things. So, and those, the big effects on in headline inflation, but things like that leak into that as well. And the effects may not be as big, but they're quite real and they're material. So we are aware of that, and we're watching it, but we're right at the beginning of this, and we don't know how big you just don't know how big this will be and how long it lasts. It may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see.
Thanks very much. Just to sort of stare into the future for a little bit, I was looking at the longer run bits of the SEP. I noticed that the growth estimate had been revised up a good chunk from 1.8 to 2, and the kind of long-term Fed funds rate as well. It'd be great just to hear, is that AI productivity or what's going on there exactly?
Yeah, I think it's just productivity. We actually started seeing meaningfully higher productivity some years ago, 4 years ago, 5 years ago, and that's not because of generative AI. We won't know for years what it's really due to. But it could be due to the kind of things that people did during the pandemic to economize and somehow become more productive because it was an incredible labor shortage. But I think the economic forecasters are very skeptical of periods.
Okay, we're not following through. It's just this market is just overtired. Not enough people interested in buying. Who's going to buy here with 43 minutes to go? Looks like we're going to forget about this. Looks like we're going to test the 200-day.
Disinflation story, and you believe that productivity thing that should also weigh down inflation at the time. Maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you should think about where the rates?
I think you have to be cautious about that, in particular if you're talking about AI, about generative AI. So remember, in the short term, what's happening is we're building data centers everywhere, and that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, probably raises the neutral rate. So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what higher productivity does, then it actually can be. But I think it's an empirical question because it's really what is the demand growing faster or slower than the supply side, and I think we just don't know that answer ex ante going in. We'll just have to wait and see. Thank you very much.
That was Federal Reserve Chair Jerome Powell wrapping up his news conference there. Stocks at session lows here following the pressure. Let's send over Jared Whitley. Market reaction, Jared.
Yeah, it's a bit of a bearish reaction there. We didn't really get much of any jump off of the 2 p.m. release, but as is usually the case when Powell starts talking, that's when you see the movement. Here behind me, we have the Dow Jones Industrial Average now off about 650 points. It was down about 400 before we got all the announcements at 2 p.m., so 1.4% to the downside. NASDAQ Composite off a little bit less, and then the S&P 500 just over 1% there, but that drop to session lows there kind of standing out like a sore thumb. The other thing I was looking at here is in the bond market. We saw a reversal of yields from earlier in the day. So here's a 10-year T-note yield. It is now up 6 basis points to 4.26%. Here's the 30-year yield. That is up 3 basis points to 4.88%. And so this isn't a huge movement given what we've seen over the last few weeks, but it's kind of going in the wrong direction. And when the 30-year gets up to 5%, that's when we've seen stocks roll over, at least short term. U.S. dollar index, this is another huge one. I was looking for a move above 100 as a sign of tightening financial conditions. That is now here. So the dollar pain trade could be on, and that could be contributing to some of this weakness that we're seeing in equities. Also want to note what's going on in gold. Gold already cracked 5,000 earlier in the day. When we started at about 2 p.m. here, it was just off of the lows, but it's sunk down. It's retesting the lows, 48.65 per ounce. And finally, let's take a look at crude oil futures. This is not a market perspective off of the Fed, but it's a huge factor. We were talking about, or we were hearing about those oil prices and the pass-through in terms of inflation several times over that press conference. So crude oil futures up 1% on the day to 96.66. That's WTI crude. And now just getting a quick look at the sector action. Energy, still the only green one. We had, I think we had one more green sector before, but to the downside, staples accelerating the loss down 2% now. Consumer discretionary and also healthcare, materials, communication services, real estate, all of those off more than 1%.
All right, we're making new lows here. Markets don't care.
Looking at just about 1 hour and 20 minutes ago when that report first dropped. So
Okay, 200-day looks like it's going to be tested here.
And also pretty similar situation in the Dow, where we have Chevron and JP Morgan up in the green, but for the most part, this is kind of a sea of red there, Joe.
Thank you, Jared. Got by the book of Thomas, made by with a breakdown of the Fed's new summary economic projection growth.
That's right, Josh. The Fed holds rates steady. The stop will have a chart of policymakers projections.
All right, 200-day looks like it's in play.
In 2026, now taking benchmark rate down to a range of 3.25% to 3.5% by the end of this year. Let's take a closer look, though, at the dot plot. In 2027, policymakers do expect 2 rate cuts now, where projections remain unchanged over the course. And if you take a look, the consensus of 2026 is 1 rate cut. By 2027, looks like 2 rate cuts. And a new projection for 2028 as we make our way towards that 3% as well. But there was some indications that there was a lot of uncertainty swirling around the summary of economic projections, especially when you take a look at what we saw with unemployment that did remain unchanged. We saw the summary of economic projections for when it comes to unemployment remain at 4.4%. That was in line with what they had previously projected in December, showing that they don't expect that we will see a weaker labor market ahead, and that largely will continue to see a strong labor market persist into this year. That remains unchanged, but still up about 0.2%.
Valero turning up. Valero.
Longer run target. Also, keep in mind here that Fed Chair Jerome Powell was asked about stagflation, and he said we're not seeing unemployment like we saw back in the 1970s. And so he said, use that word for a case like that, but we're not quite there yet. But when we take a look at what they forecasted for inflation for 2026,
All right, we're probably a day or two away from maybe a nice bounce. Get this to all line up. Let's see. S&P is still dropping off here. Looks awful, S&P.
They rose that projection as well, now forecasted to rise to 2.7%, up from 2.5% back in December, really trying to understand how
200 days, 66.15. 66.15.
You know, we're heading into this one. There were some notable economists who were saying, they were not going to put too much weight on this dot plot. There's too many big questions. They don't know when this war is over. They don't know when the world disruption is over. Too much uncertainty. What do you make of that?
Right, well, Claudia Zom, an economist, she was one to go out on X and certainly say that in her tweet, she largely said that she said that they should not publish it ahead of this report because this is sort of baseline forecast and they can't really understand fully the impact of this war in Iran will have.
Wow. 200-day. They're just going to sell it right down to the 200-day. There's nobody in their way. 36 minutes to go. Under 36 minutes to go.
Welcome back, folks. Right, I'll start with you. So some highlights of the press report. First question right out of the gate: should the Fed look through an energy price hike? How kind of cautious there. The question of looking through when it does arise will be one to approach not likely. He said. He talked about how progress on inflation should come towards the middle of the year. If progress doesn't come, he suggests you won't see a rate cut. Emphasize nobody really knows the full economic impact. Kind of higher energy prices on inflation. Actually joked about skipping the dot plot.
YPF, Soledad, and Anima. This one we've traded before. It's the Argentina-based oil and gas stock. What is gold doing? Gold dropping off. Gold. What about silver? Silver pushing lower. Okay.
Were you surprised, Greg, how much tariffs were mentioned in this press? I mean, people calling it was notable.
MKS Instruments. That one's back above the 50-day.
Stephanie, let me get your take on it, Professor. And then what do you make of it?
I think that what the Fed is doing right now is standing up straight in the face of another real credible threat to inflation. Like they talk a lot about tariffs because that was the first shock that they were looking at. And what matters the most about these energy prices
VSAT.
is really the environment in which they
Okay.
and the fact that this is coming on late.
KRMN, Carmen. No. AAOI. Stock's just not seeing much here. Palantir's flat day 10, day 11. Yeah, it's about 11 days just moving sideways, Palantir. We could get a nice pop out of Micron.
let's bring in here our very own Jennifer Schonberger with her takeaway. Jen, you were in that room, my friend. What did you think? What were your big takeaways?
Yeah, I think there are three words we can use to sum this up, Josh. Wait and see. Chair Powell basically saying that, look, it's just too early to know the scope with which the war in Iran is going to impact the U.S. economy. And he said also, basically, don't put too much stock in that SEP. And he said there were a lot of officials who commented, look, if there were ever a time to throw out the SEP and not use it, today would have been the day. Of course, he was questioned on the fact that
200 days right there.
for inflation, not just on a headline basis, but on a core basis, and still see one cut this year. So how
Following the pattern we saw last week, bounce Monday, Tuesday, fail Wednesday, Thursday, Friday.
from what they were in December, there are fewer cuts that have been penciled in.
Can we get some short covering? Short covering?
The forecast is that we will be making progress on inflation, not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that.
At one point, we had about 200 stocks advancing. We're down to 90 stocks advancing out of the S&P. That means 406 stocks declining.
Come down, even though they have raised their outlook for inflation for the end of the year, is because of tariffs. And that's interesting because we know that the president has reissued a 10% global tariff in the aftermath of the Supreme Court having struck down the use of his emergency powers to issue tariffs. And we know that there are pending investigations right now under Section 301 where we expect new tariffs to be issued. And we expect further investigations on that front. So if you have rolling new tariffs coming out and the prospect that they replace or eclipse higher, you have to wonder what that means for the Fed's inflation forecast. And of course, this coming on top of the oil shock that we are experiencing from Iran. And then lastly, Josh, I just want to
Just above they're going to take it down to the 200-day, no? We are so close. The 200-day will catch up at this rate.
If my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and that's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality.
Notice Chair Powell also said, Josh, that his decision of whether he stays on the board after that investigation is wrapped up hinges on what the future of the institution looks like. So you gotta wonder if he is going to remain on the board, if he's concerned about central bank independence.
Jen, I'm curious how you think Trump might respond to this. I mean, you would assume response.
Volume oscillator starting to turn up.
He's one, he's saying, if the DOJ wants a fight, let's go. And two, he's saying those rate cuts you want, I'm in wait and see mode. And I'm just curious, how do you think the president might respond here?
Yeah, I mean, he's certainly not going to like the fact that the Fed
Below the zero line, advanced decline, making lower high.
And he called him again too late, Powell, and said if third graders should know to cut rates at this point. The fact that Powell is digging in further and really placing his stake in his claim certainly escalates the collision course, if you will, of what we've seen between this current Fed and the president and the Oval Office. It's going to be interesting to see how things play out if and when Kevin Warsh is in place and he is not doing what the president wants. Expect some angry tweets perhaps later this year on that front.
Greg, back to you. So let me ask you this kind of broader question. You got the presser, the state introduced in Jay Powell. What's your basic case for this economy in 2026? When clients ask you right now,
All right, we got 28 minutes to go.
what are you telling them?
Well, we're telling them to be cautious because it's a highly uncertain environment where the economic paradigm has shifted to the supply side. It's no longer a demand-driven economy, it's a supply-driven economy. And in a supply-driven economy, you get counter-cyclical forces, higher output and lower inflation. You get a positive supply shock, like Stephanie was talking about.
Yeah, I'm just talking to my wife about the markets right now. Why would you buy? It's like going to the store. You know, you go to the store, you see something that's I don't know, $500, and you can see a trend for whatever reason. You can see the trend in prices have been moving lower. You know, you're gonna wait. You're gonna wait for prices to come back down. I'm waiting for a test of the 200-day. I think that's what everybody's waiting for. All right. I put my headset on.
And the fact that the other 493 are expected to see 11%, this gap in earnings growth, it's no longer this monopoly of just the Mag 7, but you actually have other areas on hard infrastructure, on energy and power that
Just go down and test the damn 200 already. Jeez, it's right there. 15 handles away, 200-day.
We can have this sort of like very almost academic conversation, but there could be a lot of folks listening, and they may not.
15 handles to go, 200-day. Do it, do it. Just freaking do it already.
I think we're all investors in the sense that most of us have a retirement account, and so the market developments do affect us, even if indirectly.
15, 66.15. That's the 200-day. 200-day.
One thing is going to be true, that we're going to be in an environment where interest rates are going to be persistently higher than they've been in the past. Two, we're unfortunately going to see an inflation pass-through, and that will force Fed policymakers to be more cautious. And three, we're going to be in an environment where there's going to be pressure, unfortunately, on real disposable.
Oh, boy. Either we go down and test it, or the moving average is going to catch up with price. We could stay right in this zone, I guess. That's possible, too. You know, I'm thinking maybe that's going to be the case. Right, so we'll just like chop around right in this area. I'll chop around this area for the next few days. Put in a few candles right there. Right? Put these candles in right here. Just like stay here. You know, just keep bouncing around this area until the 200-day catches up.
Start playing with real people. Play the official WSOP poker app. WSOP. Respect the game. Play for free now.
Yeah, that's what it feels like it's going to do. 200 days catching up right there. Right at this rate, the 200-day is going to do that. We're just going to keep going here, and we'll eventually catch up with price action. Base in this area. Just base all in here. And then eventually take off to the upside, right? Eventually it'll get this to take off to the upside. That's what I think is going to happen.
What if I told you there's an app called Tester Up where people get paid to play games?
Stupid commercials. That's what I think is going to happen. Going to catch up with the 200-day. Do something like that. Speculating.
Jackpot wins can happen anywhere, at work, in the coffee shop, on the go, or from the couch. Get in on the action at Double Down Casino and join a community of players winning big from all around the world. Download now and start the fun.
Can you find the bingo balls? N44, B10, Gold 73, I-19, G51. Ready? Go! Bingo! Bingo!
Busy parents need a cooking break. Get yours with Nurture Life. We ship fresh, healthy kids meals right to your doorstep. With kid-approved flavors backed by registered dietitians, it's a parent's dream come true. Life is better with Nurture Life.
Witness news as it happens, 24/7, live, raw, and uninterrupted.
Just incredible videos.
Around the clock, live coverage as it happens. Stay engaged, stay connected, stay tuned to Live Now from Fox.
Donald Trump is still trying to unblock maritime traffic along the Strait of Hormuz today because it waived a long-standing shipping law that requires
There we go, dropping off. They're going right for the 200 day. They're going for the 200 day. Some point we're going to get something going here, I would imagine.
Ben, my friend, we'll start with you because you got a great story out, a new one, when you're looking at the traffic, the drop in traffic through Strait of Hormuz. So I guess, Ben, start there. Like, what is the data telling us, and to what extent, Ben,
Absolutely, yeah. So this data is from the IMS. It's called Port Watch, and what
Yeah, looking for what happens here. What happens here?
Offered an update through the 15th of March, so basically the first 15 days of the war. And what it showed is just how low the traffic has been consistently throughout it. We haven't seen a single day with double-digit ship passages through the Strait of Hormuz, according to this data. This comes after it was about 95 a day in the month of February. So it shows how tough this drop-off is.
200 day, we're just dropping off here. Jeez, look at that. It's just so close.
The ships that are getting through are clearly with Iran's permission. Iran said they're going to allow energy transports to India to pass through, and that's happened. We even have pictures of a tanker arriving in India after passing through the Strait of Hormuz in one of these ships. But the overall numbers here are sort of a remarkably consistent and low data getting through, even as the Trump administration is trying all these different measures, ensuring talking about these, as well as the ongoing war to
All right.
decimate Iran.
Not much to do. Just waiting.
Are holding back their gear off, and even up until recent days, this number is not budging, at least for now.
Jake, how much of global oil supply is being disrupted?
So you see usually about 15 million barrels per day of crude go through that strait, 20 million barrels per day of petroleum products, but about 14 to 15 of that is crude oil. Now, the East-West pipeline across Saudi Arabia can take up to 7 million of that. It's not taking that right now. They're trying to get it there. But the point is, you've still got several million barrels per day of crude oil disrupted that's going to get blocked off because Iran is not letting really anything except its own oil and some other single shipments from India through that strait. Most of that Iranian oil is going to China, so it's not really going to impact the global market. You still see just a huge impact from that strait getting cut off.
Then what would it take to normalize traffic in the Strait of Hormuz? Like, is it military escorts? Is it boots on the ground? What do you think?
I mean, I think that's one of the sort of the million-dollar question here about this conflict. I think there's an increasing sense here that it requires some sort of ceasefire between the U.S. and Iran. That's I think the outcome that the Trump administration has been trying to avoid. That they have to get to a ceasefire here. But Iran's capabilities here and their sort of consistency aspects.
Wow. I didn't think it would spill off like this. There's no reason to buy, but you know, and the 200 days right there. What the hell? Good thing is we're close. Good thing is we're very close to, I won't say a bounce. I will say, oops, sorry about that. Just smacked my microphone off the stand. I'm not going to say we're going to bounce, but what I will say is that we'll have an area where we could definitely look for institutions to show up. And from what I understand, they're all waiting for a test of the 200 day. So Downtrend accelerated. 200 days right there. Okay. Wow. That's pretty crazy. Pretty crazy.
Wondering what happens if his military, in his words, finishes off the Iranian regime, then they kind of let the countries that are responsible, or dependent on the Strait of Hormuz, handle it themselves. Again, that's a lot quicker to do. There's a lot of goods that do come to the U.S. through the Strait. I point to things like helium, which is important for semiconductors, fertilizer, which is important for farmers, but even global energy, global prices, we felt those effects there overall. One sort of interesting tweet I saw online today counted 7 different responses to Trump and sort of how he's going to talk, how he's going to approach the foreign help, we don't need foreign help, maybe we'll leave
Wow.
all these different approaches.
Wow, wow, wow. Everything's falling off now.
From the administration here about how they're going to deal with this
People not interested in holding on to shares right now when they see the markets plummeting. Well, NVIDIA just like a haymaker. Tesla. Oy, oy, oy.
What the Jones Act does, it requires that shipping between U.S. locations has to be on ships that are U.S. built, U.S. owned, U.S. flagged, U.S. crewed. All that makes it more expensive. What this could do is take a little bit of price pressure off oil, and gasoline, and diesel, really refined products moving from, say, the refineries along the Gulf Coast to the East Coast.
It's like the bears have no fear. They just, let this keep dropping. Look at the volume coming in. Mm-hmm.
Even so, all the analysts I talked to say this really is not going to have much of an effect and is looking more symbolic than really material in terms of the gasoline prices, especially that the U.S. Americans are paying at the pump and also global crude.
By the way, the other headline, okay, you saw this, Jake. The Israelis hit this natural gas processing facility in southwestern Iran. Axios did report that strike was coordinated with and approved by the Trump administration. What did you make of that?
So this is a big escalation. That strike was on the South Pars gas field in Iran. It's part of the biggest natural gas field in the world. That is a very, very big escalation because up until now, the U.S. and Israel have really refrained from striking Iranian energy infrastructure. You saw a few strikes last weekend on fuel depots in Tehran by Israel, but up until now, the U.S. has largely kept Iranian infrastructure off the target list. This is a massive hit to Iran. Iran came out right away and said, here are a list of targets in the Gulf, energy infrastructure, that we could now hit now in retaliation. You then saw Tehran order evacuations from those sites in other countries, saying if you don't want to die, essentially, you need to clear out of these facilities because they're going to be hit in the coming hours. Throughout this entire conflict, the question of energy infrastructure has kind of been a red line because it's so disruptive on top of what is already an energy crisis. Remember,
all right, we've got a little bit less than 12 minutes to go.
This is months to years to repair damage.
Trend down day again.
One more step forward in escalation that's only going to back Iran more into a corner. And so the question I've been hearing is, what is the U.S. and Israeli goal here? Is this a war of attrition, trying to wear Iran down? Is this symbolic to say we can do what we want? Where this goes, hard to say, but this is a significant escalatory step by the U.S. and Israel.
Jake, Ben, great discussion, guys. Thank you both. Coming up, SetPoint CEO joins us live to talk about the company's latest earnings report. That's coming up next.
Let's face it, with everything going on in your life, there just isn't always time for the gym. That's why there's Body. With over 140 complete at-home fitness programs, Body has fitness that fits real life. At bodywithaneye.com.
Jackpot wins can happen anywhere. At work, in the coffee shop, on the go, or from the couch. Get in on the action at Double Down Casino and join a community of players winning big from all around the world. Download now and start the fun.
Childhood wonder can inspire a lifetime of discovery. Designed.
Oh boy, it's been a rough couple of weeks for sure. If you've been holding on to cash and waiting for good positions or buying stocks down here with, you know, more than a day of foresight, you know, if you're looking out 2, 3 weeks, a month, end of year, and you started building some positions, we did see Bitcoin stop moving lower. So Bitcoin, maybe it starts to turn back up. We'll get some short covering now. Shorts are starting to cover right at Monday's low, or excuse me, Friday's low.
Welcome to the House of Fun, where the thrill of Las Vegas never ends. Experience excitement with over 200 slot machines, each offering unique themes and awesome features. Dive into our captivating mini games and enjoy all-day entertainment. Join now and make every moment unforgettable at the ultimate destination for nonstop fun. You will be entertained all day long. Play now.
Stupid games. I don't know how anybody sit there and play games all day long. You definitely don't want to get caught by your employer. VWAP. Okay, nothing. I don't see anything on the New York Fangs. No short covering on any of these at the moment. Okay. Okay, we got 8 minutes, less than 8 minutes to go.
Full-year revenue forecast are below the street's expectations. Some analysts say it's disappointing outlook is on the conservative side. Healthy growth will continue. SailPoint founder and CEO Mark McClain joining me now to discuss. Mark, it is good to see you. Maybe just start on that print, Mark. What you're seeing in the quarter. What are you seeing in the business?
Look, we feel very happy with where this business is and where it's going. I think we're in an interesting time, as you know, Josh, in the markets where there's a lot of noise out there, I guess, around software and AI, and are you a beneficiary, are you going to be damaged, et cetera, et cetera. I think, you know, up through what we just reported, very strong full year, 28% ARR growth. Within that, we're mostly dollar.
Yeah, I'm trying. You know, you after a while, you just get to the point where you don't get emotional with the markets. If you're emotional with the markets, you can't sleep at night, whatever. I mean, there's no sense fighting this. The 200-day is right there. I thought we were going to do it last week on Friday. Thought maybe we would get down there. Instead, we bounce again on Monday, Tuesday. We sell off on Wednesday. Exactly what we did the previous week. Bounce on Monday, Tuesday. Sell off Wednesday, Thursday, Friday. Do we overshoot it tomorrow? The 200-day? I got a feeling institutions are going to be down here looking. It's only 6%. That's the problem. Or won't really say a problem, but that's what I'm looking at, is that it's not that far. It's not like a 10% drawdown or anything. It's only 6%, but everybody's acting like it's a big deal, you know? I mean, it is a big deal. Don't get me wrong, but 6%, less than 6%. We're there, 200-day. Yep. Yep. Let me get rid of Keltner channels. That's kind of ugly. Keltner, don't need the Keltner channels anyway. Keltner channel. Range low, range high.
The 2027 guidance, they say, did come in below expectations. They say across the board, except EPS. That was
Okay, we're still pushing lower. Okay, we got less than 6 minutes to go. Less than 6 minutes to go. Distribution. MACD's trying to turn. Stochastics is oversold now. So we could come in tomorrow and see perhaps a gap down again and a rally Back above the 200-day.
Experience of beating and raising expectations as you go through the year that the market expects, and we did that
200-day. That is the 200-day. 100-day.
So in this case, we thought we're kind of in a condition where there's some unknowns. We feel very good about the signals we're getting. I call them the qualitative signals we're getting around our potential to be a beneficiary of customers adopting AI and needing identity security to help them secure and manage all these AI agents. But we also felt like it wasn't necessarily prudent to build all that into an aggressive guide perspective. So better in our mind to be conservative, to set ourselves up for a good, solid performance, and hopefully an even better.
It's right there.
As we go through the year, and that's the way we decided to.
That's the way we do it. You know, 2 or 3 days from now, next week, week after that, we get a bounce like I'm anticipating. You know, everybody will be back into the whole risk on mode. And we'll forget all about this pullback, just like we did with April, the February, March drop due to tariffs. This too will pass. Okay. Mm-hmm. All right, so the 6600 put fly is touching that wing.
On behalf of some human, ultimately, right? They're doing things that a human would have otherwise done to try to get work done in business. Well, there's got to be a couple different flavors of these things, right? One is there's going to be the agents that are delivered to the big software vendors, ServiceNow, Salesforce, Workday, etc. And customers, I think, are going to be reasonably aggressive about adopting that agentic capability within those well-known platforms because they probably trust that those folks have put the right guardrails in place, security, etc. Then the mid to large customers, which is where we focus, not say down market, small, medium business. Well, those customers have their own internal IT development shops, and they're also doing a lot of work for bespoke features, right? Things that are more unique to their business. And I think that's where there's sort of a mixed bag of people moving. What we would have said last year was the year of pilot. This year is the year of adoption. It's sort of the rate and pace of that adoption that's very difficult to predict. These customers are moving forward.
We're still dropping, huh? Come on, let's just go ahead and do it. Man. Ay. Looking forward to getting this over with.
Stay tuned. We have all the action on the closing bell come up next.
Hi, is now a good time to talk about your IBS? No, maybe later. It's now a good time. Hey, because IBSD is often a multi-symptom condition and talking about it can help. How about now? There's a short-term treatment for lasting relief. Okay, let's talk. It's called Xifaxan. Xifaxan with an X. It's a 2-week treatment for adults with IBSD that provided lasting relief from both abdominal pain and diarrhea and helped relieve bloating and urgency. Think of it like a short-term treatment for lasting relief.
Don't take Xifaxan if you are allergic to its components, rifaximin or rifamycin antibiotic agents. Get help right away if your diarrhea worsens, as this may be a sign of a serious or fatal condition. Tell your doctor if you are pregnant or plan to be, have liver disease, or are taking other medications, as they may increase the amount of Xifaxan in your body. Most common side effects are nausea and increased liver enzymes.
The right time to talk to your doctor about Xifaxan is right now. Xifaxan.
High electric bill? Get the monkey off your back and call Air Mechanical. We provide installation of Amana heating and cooling units, repairs, and 24-hour emergency service.
Let Air Mechanical help get the monkey off your back. Call us today.
Oh boy. All right, we're about to close here. Okay, that was a closing bell. I just missed it. All right, that's a closing bell. All right, folks, pretty close to the 200-day moving average, I guess. depending on if you're using TradingView or stock charts. Stock charts is showing us at the 200-day right now. Okay, so we're right at the 200-day. Okay, so might as well be. It's only 5% though, 5.5%. It's not that big a deal. If we can get a bounce now, it'd be nice. All right, so we're looking forward to that in the short term. 200-day. Okay, 5.5%. All right, that's it. That's a wrap. I'll see you guys tomorrow, first thing. Have a great evening, everyone. I'm your host, Cousin Vinny, coming to you from theclosingprince.com. It's Wednesday, March the 18th. Have a good one. We'll see you in the morning. Ciao.